Good morning, everyone. I declare open this public hearing of the House of Representatives Standing Committee on Economics for its inquiry into card payment schemes, digital wallets and emerging payment technologies. I begin by acknowledging the traditional custodians of the land on which we meet today and pay respect to elders past and present. I also extend that respect to any Aboriginal or Torres Strait Islander people joining us today. I want to welcome all witnesses appearing before the committee, as well as members of the public and media in the room or watching online. Payments are an essential foundation piece supporting all economies. The costs, access, settings, the competitive dynamics of this system affect every household and every small business in the country. Likewise, the trust and confidence in our payment systems are crucial. Changes in technology, industry structure and consumer behaviour are altering the way these systems operate, including the number of participants involved, the technical arrangements used to process transactions, the type of costs that arise along the payment chain, and the ability to offer new types of economic and commercial activity in the country. Today's hearing is an opportunity to understand how these systems function, how they're evolving, and as they evolve, it'll be important to gauge their impact on retail prices, productivity, innovation and the ability of new entrants to compete. We'll be hearing from key regulators and some of the larger operators in the Australian payments sector, including banks, major banks and global card network providers, along with firms such as Apple and Australian Payments Plus. I want to thank everyone who made a submission to the inquiry. We've had a lot of interest that we've attempted to harness in the time we have, especially over the two-day hearings that we've set aside. In accordance with the committee's resolution of 31 July 2025, this hearing will be broadcast on the Parliament's website and the proof and official transcripts of the proceedings will be published on the website. I remind all present that, as Chair, I'll ensure the proceedings are conducted in an orderly, respectful and courteous way. Those present are advised that filming and recording by the media is permitted during the hearing. However, we ask that members of the media present or listening report the committee's proceedings fairly and accurately. Media present are also asked to conduct themselves in a way that doesn't interfere with proceedings and must not encroach on the committee's work area or film or photograph documents or devices of committee members, witnesses or others. I'll now begin by welcoming representatives of the Reserve Bank of Australia, ASIC and APRA to give evidence to the committee. For the Hansard record, can we please have you state your full names and the capacity in which you appear before the committee? So it'll be in order: Reserve Bank, ASIC and APRA. So Reserve Bank.
I'm Ellis Connolly, Head of the Payments Policy Department at the Reserve Bank of Australia.
Rhonda Law, Senior Manager in the Payments Policy Department at the Reserve Bank of Australia.
Thank you. ASIC. Hello, ASIC. I think we've got a COVID throwback. Okay, I'll go to APRA and then come back to ASIC. APRA.
Forgive us, is that better?
It's much better. Perfectly smoothly. Okay, so ASIC, do you want to introduce yourself?
Good morning.
Yep.
Good morning. My name's Karen Rourke and I'm one of the ASIC commissioners.
And good morning, Reece Boland, Senior Executive Leader, FinTech at ASIC.
Thank you. And our friends at APRA? Still can't hear you, I'm afraid. Okay, well, no, we can't hear you, but if I understand correctly, we've got Mr. Daniel Chippick, Senior Specialist, and Mr. Ian Beckett, General Manager. We'll come back to you, and if there's been any alterations to the appearances, you can correct us. Before we proceed, I should advise you that although the committee does not require you to give evidence under oath, the hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. I'm going to invite each regulator to make a short, if I can emphasise, opening statement before we proceed to questions. In the round table, you can appreciate we've got a number of members that are present physically and online, and I'm trying to accommodate all that. So if you can limit the length of your opening statement, I think we'll get a lot out of this. Thank you. I'll throw to the RBA first and then to ASIC next.
Thank you, Mr Hussey. The RBA welcomes the opportunity to appear before the committee. The RBA has a mandate to promote the efficiency, competitiveness and safety of Australia's payment system. We aim for a payment system that is both resilient and innovative. In September 2025, the Parliament passed amendments to the Payment Systems Regulation Act 1998, the PSRA. These amendments expanded the RBA's remit to a broader range of payment systems and participants. These amendments are a key plank of broader payments regulatory reforms, including the proposed licensing regime for payments and the digital asset reforms. The RBA will consult in mid-2026 on the issues that should be prioritised under the amended PSRA. This consultation will include consideration of three-party card schemes, mobile wallets, buy now, pay later providers and e-commerce platforms. The committee's inquiry is a timely opportunity to consider the role that these entities and domestic and international card schemes play in the Australian payment system. Our submission provides information in these areas that may assist the committee. We'd like to highlight two additional initiatives that may be of interest to this inquiry. First, the RBA is engaging with Treasury and the payments industry on the future design of Australia's account-to-account payment system. This workstream supports modernisation and further innovations in account-to-account payments that will benefit Australia's consumers and businesses. Second, the RBA's Project Acacia is exploring how new forms of digital money and financial infrastructure could support the development of tokenised asset markets in Australia. Project Acacia is being undertaken alongside industry, regulators and our research partners at the Digital Finance Cooperative Research Centre. The project has drawn strong interest from a wide cross-section of industry, and we're very happy to answer your questions.
Tremendous, thank you. ASIC, then APRA.
Good morning. ASIC also welcomes the opportunity to appear this morning. We don't have an opening statement.
Okay, thank you. APRA.
We don't intend to make an opening statement either. We're happy just to go straight to questions.
Tremendous. Okay, thank you very much for that. I just want to ask just to open up, asking questions in this space. I'm showing my age here is like barrel of monkeys. I just don't know where to start and what gets pulled out. So I'll start with merchant service fees, and I suspect others will join in from other perspectives. I noticed in your submission that scheme fees have become a significant and growing component of the cost of accepting card payments, and you've reported that Australian acquirers and issuers paid operators of card schemes around $2 billion in scheme fees after rebates in 24-25, representing about 11% increase in the previous year, and I note the growth in the fees has outpaced transaction growth since 21-22. So I've just got three quick questions of the RBA, if I may. First, given that SMEs are rarely able to access scheme fee rebates, can you explain why there's no gross number for scheme fees being published at all? What are the primary factors driving the recent growth in scheme fees? And finally, can you just also give us a sense of what those scheme fees are paying RBA?
In terms of the first question regarding gross scheme fees, you're correct, we've provided the committee with the net scheme fee numbers. That the rebates are primarily provided to the issuers of cards. We would be happy to make the data available to the committee on the gross scheme fees.
Right. Okay. Is there a? Can I just ask? So very happy to hear that. I've got those other two questions, but just on the publication of the data, is there a decision? Is there a deliberate decision as to why the gross fees have been published? Haven't been published?
Because the rebates offset part of the gross fees, we think the most economically relevant concept is the net fees. So if because the rebates are primarily involving the relationship between the issuer and the card scheme, if there is a higher gross fee but then it gets rebated, we think that the net fee is actually the relevant economic concept. But we would be happy to provide you with the gross numbers as well.
Yeah, I get that. One of the things that's been impressed on me is the fact that the bigger the business, the higher the volume, they have more chance of getting a rebate, and so there's a fairness element to it. I take on board the logic that you've applied, but I think that's the issue. I won't dwell on it, and I appreciate your answer. I did ask just very quickly, what are the primary factors you think that's driven the recent growth in scheme fees, and can you just explain also what you've discovered the scheme fees generally pay for?
In terms of the factors contributing to the growth of scheme fees, I think we would need to take that question on notice. It's a very opaque area, scheme fees.
Yes.
There's a tremendously large number of different scheme fees, so I think it would be difficult to summarise briefly exactly what drove increases in scheme fees, and I suspect different participants in the system would also have different views on what had driven those scheme fees. You'll get to discuss this with the card schemes later today, but in our discussions with them, they do emphasise that they're providing further services to issuers and acquirers, and that justifies the increases in scheme fees. There are other views in the industry about what could be driving those increases in scheme fees.
Sure. I'll leave my questions there and then I'll open up to Mr Violi next. The thing in terms of having a deeper engagement in this issue, what strikes me is there seems to be an excessive amount of complexity. I don't expect this to be a simple process, but it just seems to me, if in some cases I saw there were like 400 different scheme fees, and it just seemed like complexity is baked into the system and is really the enemy of transparency and better understanding of how things operate. Have you had has the RBA inquired as to the multiplicity of these scheme fees and why they have to stand the way they do?
It's the complexity of scheme fee arrangements is of concern to us. It's an issue that we raised in the current review that we're doing on surcharging and merchant card payment costs. In the consultation paper that we issued mid last year, we did raise some proposals regarding ways of reducing the complexity of scheme fees, and that's something that the board will also be considering on the 5th of March when it comes to its final set of conclusions for this review. So it's an issue that we're looking at, and one that will be part of the conclusions paper that the RBA is aiming to publish by the end of March.
Thank you. So Mr Violi and then Mr Axal.
Thank you, Chair, and you covered the questions I had on scheme fees, so I'll put those to a side and move to a few other topics. So I just want to confirm for all three regulators in regards to timing and announcements. On the 15th of October in 2024, the Prime Minister and Treasurer issued a joint media release stating that they were, and I quote, prepared to ban debit card surcharging from the 1st of January 2026. It's now the 24th of February 2026. Can you confirm that the Albanese Labor government has missed its own deadline to ban debit card surcharging in Australia?
I believe the statement made by the government did refer to the RBA conducting its review on merchant card payment costs and surcharging. That review was intended to be concluded by the end of 2025. However, given the volume of feedback that we've received during that review, we needed to extend it till the end of March. And the plan is for the conclusions paper to come out by the end of March, and that would include the Payment System Board's final position on the issue of surcharging. So the statement made by the government was conditional on this review taking place.
And was the RBA consulted on setting that deadline? Do you believe that that deadline was realistic at the time it was made?
The RBA had been looking into the issue of surcharging prior to the government making that announcement, and it was the government's decision to set that deadline.
But did they consult with the RBA when they set that deadline, given you were already looking into this issue, to make sure that that timeline was realistic?
We were engaging with the government in the lead up to their announcement. The decision as to the timeline was one that the government made.
So given that deadline has been missed, and the reason this is important is that we get press releases and we get headlines telling consumers that something's going to happen and it clearly hasn't happened. So where does the fault lie for missing that deadline? Is it with the RBA or is it with the government?
The RBA needed to conduct this review of surcharging and merchant card payment costs. Under the existing standards, the RBA prevents the card schemes from imposing no surcharge rules, which is what allows surcharges to occur. So the RBA needed to conduct a fulsome review of this issue to be able to consider whether or not to remove that prohibition on no surcharge rules. That process should be coming to an end by March, and then the conclusions paper will come out.
Respectfully, I understand the process. What I'm trying to understand is that in October of 2024, the Australian people were told that by today, in February 2026, they wouldn't be paying surcharges, subject to the RBA review. What I'm trying to understand is, was that a realistic timeline given the information that you had at the time? Because it looks like, at a very top-line case, the Australian people have been misled.
The process that we've gone through is the one that we needed to go through, and unfortunately, the process was not one that was able to lead to a decision by the 1st of January 2026.
No problems. Let's move on. I just want to get to, I guess, the principle of banning surcharging, which I understand the principle you want to ban that. However, would you agree that there is still going to be cost in the system for businesses in terms of payments? They're still going to absorb a cost from their providers, and that essentially leaves businesses with two options. They absorb that cost, or they pass the cost on to the consumer anyway under a full unit cost of good model. So essentially, we remove the surcharge and the cost ends up still being borne by the consumer, just in a full unit cost, not with the surcharge on top.
I think your description is accurate in the scenario where the only thing that is done is the removal of surcharging. This is why the RBA brought together the issues of the surcharging of card payments and also the merchant card payment costs that are being paid by merchants, particularly small merchants in Australia. What our review has been seeking to do is exploring ways that we can put downward pressure on those merchant card payment costs, for instance, by potentially reducing the interchange payments that merchants effectively have to pay via their acquirer through to the issuer. So in the consultation paper that we put out, the proposal there was removing surcharging at the same time as significantly reducing those interchange costs, which means that for all merchants, they'd be having lower payment costs. Now, for those merchants that are surcharging, the reductions in interchange would not be enough to make their payment costs free. They would definitely still have payment costs. And as you described, they would need to pass that on to their customers by the advertised price or absorb the cost. So I think your description's accurate, but we've tied the issue together with trying to put as much downward pressure on merchant card payment costs. We think that's how you can promote efficiency and competitiveness in our payment system.
Now, Aaron, last question, just because I'm
Last
got to
question.
obviously balance a number of things. And then what I'm going to do, just to let people know, if we get through and we've got extra time, then I'll open the floor to follow-up questions. So last one.
Yeah,
and
one
then
last quick question. Thanks, Chair. Yeah, just based on that, bringing the costs down, what confidence do you have that you're actually going to be able to sustainably bring costs down and actually improve operations for businesses and for consumers, bringing their price down?
The reductions in interchange, assuming that the Reserve Bank's Payment System Board does decide to reduce the interchange, that decision hasn't been finalised yet. Were there to be reductions in interchange, they would be lasting reductions. And then there is competition in the acquiring market between acquirers. As you've been highlighting, small businesses would be facing their payment costs, so they'll be very motivated to be looking for the best deals out there. And we think, given the amount of competition in the acquiring market, that those reductions in costs should be passed through to the merchants.
Mr. Violi, I would add, as part of the consultation that the Reserve Bank published in July last year, we also included some proposals to improve transparency and disclosure of information about some wholesale fees and merchant fees. So together with the proposals about potential interchange reforms that will be going to the board, we have also been considering and receiving evidence about whether providing further information and making the information published in a format that may help the merchants to understand where the costs are coming from and how much different types of payments are costing them. It may also help merchants, including small businesses, to shop around and find a better deal.
Thank you, Mr. Luxon.
Thank you. Thanks, Chair.
No worries.
Thanks, Chair. I guess my first question is to the RBA, but very welcome for ASIC and APRA to pop in at your whenever you need to, so don't hesitate to answer. Just to the RBA, you mentioned at the top there that efficiency, competitiveness and safety are a really important driver of what you do on the Payment Systems Board. And we see from submissions that Visa and MasterCard together account for roughly 85 to 90% of all Australian card transactions, effectively a very strong duopoly there. How are you meeting your goal for competitiveness when the market is completely dominated by two international tech companies like Visa and MasterCard?
I would divide the market into several segments. In terms of card payments, you're correct that there's a very high share of Visa and MasterCard payments, and that's particularly in the credit card segment. In the debit card segment, we've been for many years pushing competition between not just Visa and MasterCard, but also the domestic scheme FPOS. We've promoted that by requiring all the large issuers in Australia to issue dual network debit cards, so that on these cards you have not just one network but two networks, and that means the merchant should have the choice of which network they wish to process the transaction through, and they can choose the lower cost network. We've been promoting least cost routing, and that's been reasonably effective for in-person payments. When you present a card at a terminal, the rate of least cost routing in the most recent data we've published is up to 80%. So 80% of merchants have least cost routing turned on. And we're going to continue to look at this in the online environment. The online environment is more complicated. There are more players there. The amendments to the Payment System Regulation Act are quite helpful for us to be able to consider how to promote more competition in online payments. So I'd say it's an area we are continuing to focus very heavily on. We've had some successes, but there's more work to be done on promoting competition in the card payment space.
Is that level of concentration, noted the two distinctions you made on debit and credit, still I think that, you know, from what we've seen in submissions, the numbers are still very high. Is that level of concentration a concern to you?
It's a high level of concentration.
Yep.
We would welcome and support alternative means of payment for Australian merchants and consumers. A good example there is account-to-account payments. And more use of the NPP through services such as Pay2. Unfortunately, in recent years, there's been some teething problems getting Pay2 to be a fully functional competitor to the card schemes. Those issues are being worked through vigorously by the industry, and we would hope that services such as Pay2 on the NPP can help to provide more competition there.
Apart from the teething issues, why do you think that there has been a slow uptake, particularly at the point of sale level, to alternative payments to Visa and MasterCard?
A practical challenge, particularly at the consumer level, is that card payments have become extremely convenient to the point where you can just tap a device and your payment is done. So the challenge for, say, account-to-account payments is to come up with a proposition which is as convenient for customers, and that is challenging to put together. And also, you need that what the card schemes have done very well internationally is they've created within their networks a tremendous amount of interoperability. And the challenge is to achieve the equivalent level of interoperability around, say, account-to-account payments, where you have a very similar experience regardless of which bank is your provider, and depending on which terminals are used, that you have a very similar experience. So there's more work to be done there on that user experience being consistent across the ecosystem, the way that the card networks have achieved.
I might say, or some might say, that they've been able to achieve this system they've got at the moment because of their market share, because banks can't effectively drop them, because there's no effective competition. And again, I just go back, like you mentioned some examples where you've sought to achieve competition, but the numbers are still very high for Visa and MasterCard. Like, I mean, how seriously is the RBA going to tackle that dominance of these two major providers? Like, I mean, you talk about LCR, 80% of LCR, but blended rates basically defeat the purpose of LCR with payment service providers scooping up the difference between the lower costs and the higher costs, so that the savings doesn't flow through. So, like, I mean, what do you see it as your purpose to reduce the dominance, or as one of your purposes to reduce the dominance of these two major card schemes in the payment system?
Yeah, to open up competition. Yeah.
I mean, our purpose is our mandate to promote efficiency, competitiveness and safety in Australia's payment system.
Sure.
We do want a vibrant and innovative payment system with a range of different means of payment that consumers and businesses can use. So we will continue to seek that outcome. It's been a big focus in the review that we're currently undertaking. Inevitably, some of these issues will be involved in the next review that we're going to be undertaking using the broader powers under the PSRA.
But 85 to 90%, that competitive is not there, I would argue.
Yeah.
Right?
Mr. Luxor, I just add to what Ellis has said in that the RBA looks at competition in retail payments in a number of different ways, and the committee will hear from other providers such as digital wallet providers and the account-to-account payments network operator later today. There are other payments innovations that have potentially made it easier for consumers to pay with other means. For example, in some online wallets or digital wallets, it is possible to link up your account to a wallet and therefore make payments in that way. So This is why we don't simply look at competition between card schemes. We also look at competition, enhancing competition efficiency more holistically across the different ways that consumers and merchants can pay.
Yeah, I need to move on to Ms. Situ. Just make the observation, I hate to be a politician that engages in overreach, but I think we've reached natural monopoly status with these two big firms in terms of being able to have competitors use that platform for the very reason that Alice said earlier around the convenience factor. I think we might come back and explore that if time permits, if that's all right. Ms. Situ, over to you.
Thanks very much, Chair. And I did want to just pick up on some of the points that Mr Luxauer has raised about least cost routing. And I know that for the RBA, that was seen as a way to bring down some of the fees. Can you talk me through why, or the decisions that RBA has taken around whether or not mandating least cost routing was a path for us to go down?
Thank you very much. Yes, we have been very supportive of least cost routing for it's approaching 10 years now. I think it was about 2017 or 2018 that we put the idea on the table. The practical challenge here is we want to promote efficiency and competitiveness. At the same time, we recognise that if we come up with very, very specific standards that affect the technology that is being used by payment service providers, that can impose significant costs in the system. And least cost routing starts to get into that territory where if we're going to be very specific and set a standard and mandate least cost routing, we'd have to say exactly what that is. And then it would be imposing on all the payment service providers in Australia a very specific model that they would have to then incorporate into their payment systems, into their payment services, which could be very expensive. So we're having to balance promoting least cost routing while minimising the costs. And we have received evidence over the years that if we were to go and mandate very specific forms of least cost routing, it could cost the payment service providers a lot of money, which they would then, of course, pass on to the merchants, which would potentially offset some of the benefits of least cost routing. So the path we went down was to strongly encourage payment service providers to provide least cost routing in the lowest cost ways for their payment systems. So for some of them, that's a binary choice between schemes. For others, they put a threshold in where above a certain threshold, it's cheaper to use one scheme, and below the threshold, it's cheaper to use another. There are some more innovative payment service providers that are providing what's known as dynamic least cost routing, where for each transaction, their software works out what's the cheapest scheme to use. Different payment service providers have different capabilities in this space, and we're just very mindful that if we mandate it, then we have to sort of pick a model there, and then that could impose significant costs on the payments industry. So that's the balance between the costs and the benefits that we've been having to grapple with over the years.
So in lieu of mandating it, how do we encourage, what is the RBA doing to encourage more uniform adoption of least cost routing, particularly dynamic least cost routing, as you suggested, was a really great way of driving down prices across all payment platforms. You mentioned that there was better uptake in person, less so online, but what are you doing to try to get a more uniform uptake?
So the key thing we found that was very helpful was transparency. So we asked each of the large acquirers to give us permission to publish how they're going on least cost routing, and we've been publishing those reports every 6 months. And the financial institutions at the top of the list trumpet that to their customers, and the ones further down the list find it quite uncomfortable, and that has been motivating them to do the necessary investments to provide their merchants with least cost routing. So we have found transparency there has been very effective for in-person payments. We've also been providing transparency for online payments. The story there has been more mixed, and I think that's because there are more players in the payments chain, such as gateways in between the merchant and the acquirer. We're going to have to look at this issue in more depth in the next review that we're planning to start in the middle of the year. The additional powers under the PSRA will be helpful for exploring this. There are more issues that we need to look at in the online card payment space to make least cost routing as effective as it can be at reasonable cost.
I was taken aback a bit when you said that it's even more complex in the online space, because I feel like it is already a very, very complex space. I do have a final question, if I may, Chair, to ASIC. I was particularly interested in the role that you play in trying to encourage more innovation in the payment space, and wondered if you might walk us through that sandbox that you look after, where new payments are able to play in there with a lower threshold of regulation. Can you just talk us through quickly what that is, but also what you do to ensure that there is some level of consumer protection?
Yeah, thank you. Very happy to assist with that. So we have what's called the Enhanced Regulatory Sandbox. It's actually a statutory creation, but ASIC administers it. So it has those parameters that you're referring to, including with respect to consumer protection, sort of baked in through the statutory framework in terms of the sorts of activities that can be conducted, the scale, the length of time, and that impact. So I'm pleased to say we haven't had circumstances in which there has been people exercising or trialling things in the sandbox in a way that has created consumer harm. They've been effective in achieving that protective element to it. So how the sandbox works is that people can apply to be a participant in the sandbox, and we have an innovation hub that receives those applications. As described, I think you've picked up in our submission, we have seen quite a number of people who've applied having a payments emphasis. So I think it's 12 out of the 19 that have been accepted for testing in the ERS had payment services as part of their offering. So it has been an area of particular interest for those participants. Having said that, we are conscious that the overall participation rate has been reasonably low in the sandbox, not wildly low compared to internationally, but not really high. And similarly, that the number of people who apply versus the number of people who come in, and then of those that come in who then graduate to actually being a licensed business again, has been lower than it might have been. And so this sandbox is currently the subject of a review. That, again, was part of the statutory setup of it. It was a statutorily required review. And we've been really pleased to participate with the review, which is underway right at the moment, to understand how the review is thinking about, well, what have other jurisdictions done? What are some of the ways that you could adjust a sandbox? Because we do think it's a really important part of the system as a whole that all of the agencies have to see if there can be new ways of doing payments or payment services and providers using that as a mechanism to trial things.
Thank you, Chair.
Thanks very much. Thanks, Chair.
Thank you, Chair. And just following on from Ms Situ's questions, you said that there are more players in that payments chain space, particularly online, and there's no doubt that we've seen more and more players in the landscape. Given that we've got card schemes, digital wallets, BNPL, given that we've got a whole range of online models as well, can you take us through what the approach has been to that wide range of feedback, and particularly how you've been weighing up the different feedback from such a broad array of different players in the space?
That broad range of players is going to be particularly relevant in the next review that we're going to be starting mid this year. we'll commence with an issues paper that outlines at a very high level some of the key issues that we've heard regarding efficiency, competitiveness and safety in our payment system, many of which involve those players that you refer to. We will be seeking input from all stakeholders on whether those are the right issues, whether there are other issues, and views on how we should be prioritising this. Because as you highlight, there are a tremendous number of players. There's a lot of complexity in this space. So we're going to need to, from that feedback, be quite judicious in working out what are the biggest problems for competition, efficiency and safety in our system, and address those first, while some other issues may be lower priority. So it's going to be something that the Payment System Board will be considering very carefully over the remainder of this year, with the intention then of starting to address some of those issues once they've been prioritised.
Well, and just in terms of, we've spoken a bit about competitive this morning. It strikes me that digitisation lends itself to the potential for more risks in losing economic uplift to going offshore. What's the RBA's approach been to that?
So our mandate is to promote efficiency, competitiveness and safety. There's not a jurisdictional or a sovereignty element to that directly. So our focus is very much on promoting efficiency and competitiveness, which doesn't of itself focus on the domicile of the payment system participants.
No.
There have been reforms as part of the Payment System Regulation Act that adds a national interest capability for the Minister to be able to designate a regulator to look at issues in the national interest. So there is an alternative avenue for issues of sovereignty to be explored under the PSRA.
Just on, your point around competitiveness being one of the key points that you're looking at, what are the practical ways that you've been approaching increasing competitiveness in this space?
We've been, a competitive environment is one where there are a multitude of players playing on a level playing field. So that continues to be what we're striving for. An example of that is in debit cards. So having not just two schemes, but having a third scheme operating there can help to provide more competition. I think we highlighted that in our submission. Say when FPOS moved into online payments, there was downward pressure on the scheme fees, for instance, in that space. We've been working with industry for a long time on promoting the development of the new payments platform as an alternative means of payment, which can provide fast payments and data-rich payments, and seeing whether there are ways that can help to provide more competition in the card payments space as well. And in the most recent review that we've been conducting, we've been looking at ways of promoting transparency. Can we be more transparent, say, around scheme fees? Can there be more transparency around the fees that merchants are having to pay to their payment service providers to help, say, merchants make more informed decisions about their payment service provider? So we're looking at competition in a range of ways. We want to see infrastructure, a broad range of infrastructures that are competitive, and we want the right information to be in the marketplace to help participants, end users make good decisions.
I'm interested in the level playing field that you're talking about. And given that we have very different technologies, different models, as we've talked about a lot this morning, what does a level playing field look like to lots of different technologies and lots of different models that are all operating at the same time? Is a level playing field, is there a singular level playing field that you're working to, or can you take us through what the level playing field actually looks like?
So it's a really challenging issue. I think a way to help promote a level playing field would be for there to be more interoperability in the system. That is, when you're making a payment, you can put it through a card rail, or you could put it through an account-to-account rail, for instance. Then it's a question of how do you achieve interoperability? Sometimes it's in the messaging standards. Should there be consistency in messaging? We've been doing a lot of work on that internationally for cross-border payments, which is a notoriously expensive area, trying to, around the world, get a consistent format for cross-border payments, messages to be sent, whether you're sending it through SWIFT or whether you're sending it through a domestic fast payment system. And we've been getting global agreement on that, which I think is progressing well. So we're looking for some of those opportunities in the Australian market as well. Can we promote more interoperability? Because that's a great way to create a more level playing field. At the same time, we've got to take into account that interoperability costs money. If providers have to change their systems, that costs money. So we've got to try and find that balance point where the benefits outweigh the costs. And that's why when we do our reviews, they take time, because we listen to a very wide range of participants. We collect a lot of evidence to try and assess whether a particular proposal is going to actually promote efficiency, competitiveness and safety without undue cost on participants.
And my last question is, government has obviously been doing a lot of work in this space, the payment strategic plan, the digital assets legislation last time we were here in Parliament, and the payments regulatory changes. I was going to ask, what's been your approach to essentially working with those new pieces of legislation and regulatory reforms to make sure that they're being fed into what you're doing at in this space right now?
We strongly support those reforms. The payments licensing reforms are really important because they'll help to provide more regulatory certainty for some of the up-and-coming pay tech companies, and that will enable them to be able to directly connect to some of our payment systems, such as the NPP, which will give them, that creates more of a level playing field for them to be able to compete with some of the larger, more established players in our market. That also the stored value facility reforms as part of the licensing reforms are really important too, for helping to provide alternatives to ADIs that can be used for payments and storing value. So there's a tremendous lot of value in these reforms. We've been supporting Treasury's work on that. Rhonda, do you want to add anything on the digital assets side?
I think on the digital asset side and on other payments reforms that Alice has spoken about, the Reserve Bank of Australia regularly has engagements with the other regulators, including ASIC and APRA, as well as with Treasury. So ahead of formal legislation coming in place, we're already building the relationships and the understanding of each other's mandates and regulatory priorities so that when the reforms are implemented, we are well placed to do our bit to avoid duplication and gaps.
Thank you very much.
I was wondering if you could tell me more broadly where you think market power is concentrated in the payment system. Is it schemes, wallet providers, acquirers, integrated platforms? Like, where are the big mischiefs we're looking to resolve here?
I guess the different parts of the payment system, as Alice said earlier, there are different segments of the payment system. And I think...
So where do we think market power is most concentrated within that system?
I think there's a wide range of views out there on that.
Well, what's yours?
Well, we take a lot of evidence in from the industry and from stakeholders. So we maintain an open mind on that. It's also a fast-moving space. So where the market power is one day may not be where the market power is the day after. Clearly, you can see where the big players are in the Australian payment system. Inevitably, schemes and payment infrastructures are right at the core, so they're important. You've got large players, large domestic institutions, large international institutions. It's quite a diverse spectrum. As you know, it's crossing over into some of the big tech companies as well that are involved in this space. So I think in a broad sense, there's many sources of market power. It's a complex ecosystem. So it's very hard for us to make sort of blanket statements around that. And it really depends on which segment of payments you're talking about as well. So whether it's commercial payments or personal payments, account-to-account payments or card payments, where the market power resides can actually be quite diverse across those different ecosystems. But I think that the committee is talking to, over the next 2 days, a very wide representation of the industry, and you'll get a variety of views on that question.
Yeah, I anticipate most players will indicate that they're not the problem. Another way of looking at it would be, which component of the payment costs have we seen grown fastest in the last few years?
I think there's been, as we've already discussed, there's been growth in scheme fees. There's also been some growth in acquirer margins too over time. The interchange fees have been capped by the RBA for some time, and there's further proposals currently on the table which the board will consider and will be finalised by the end of March with regard to scheme fees. With regard to interchange, there will also be aspects regarding scheme fees as well.
And the committee would hear further evidence over the 2 days about are there newer entrants that are adding to cost in the system. But these are exactly the kinds of questions we want to look at further in our next consultation.
That is all fair enough. In terms of kind of evolving account-to-account payments and other alternatives, would it be fair to say that there might be some commercially driven inertia within industry, that if you're kind of making money from the existing model, then your rush to find cheaper alternatives for the customer might be inhibited? Are we seeing maybe a bit of a go slow or some resistance to changes, introducing things that we see overseas like QR code payments and other platforms?
I mean, inevitably, players in the Australian payment system have their commercial motives, and it's not in everyone's interests to engage in the substantial investment that's required to provide a new service if they feel they're getting an adequate return on their existing service. So yes, that's an ongoing issue. We see it in the account-to-account space and in other areas. Financial institutions do have substantial backlogs of investment that they're having to do for a range of areas, including in payments. So it is a challenge for them to prioritise all these investments. So it's a tricky challenge, but yes, sometimes the profit maximising option for them is to not invest in a particular new alternative to an existing system. We are working with industry to try and coordinate as much as possible on promoting alternatives such as fast payments. But it's as you can see, it's been a bit of a long, slow journey.
More than understandable. Thank you. And thank you, Chair.
Thank you.
Thank you, Chair. I just want to pick up on looking at the evolving products and services, particularly driven by technology, and just get your views on what impact tokenisation and digital assets will have on our Australian payment system, but importantly, what consideration is being given to future interoperability across markets in relation to the transfer of assets, etc., and payments.
So we've been doing quite a bit of work, research work with industry as part of Project Acacia, exploring how different forms of money and different forms of settlement can help to promote the efficient and innovative development of tokenised wholesale financial markets, for instance. So we think that's an area of tremendous promise, and We've been working with industry, with the other regulators represented here on Project Acacia, and the findings, I believe, are expected to come out in April. And we also then want to look at further work in this space. So we do see a lot of potential on the wholesale side for tokenisation and for new forms of money to help to drive innovation and efficiency. On the retail side, we haven't yet seen a really strong business case. I think it goes back to the point the Chair highlighted around the existing system for retail payments actually provides consumers with a pretty seamless service. When you go to buy something in a shop and you can just tap a device and the payment's done, it's difficult to provide something even more seamless than that. So it's not obvious that some of the tokenisation developments are as likely to take off in the retail space as they are in the wholesale space. But there's lots of financial markets where there's a lot of potential for tokenisation, particularly some of those ones that are reliant on old technology, such as fixed income, private equity markets. There's a lot of potential there, and we've been exploring that with industry and very much support these developments. In terms of interoperability, I think it's an interesting area, and in some sense we've been touching on that in Project Acacia, because we've been looking at how different forms of money can be used to settle these assets. We've been looking at whether you have the value on the ledger or off the ledger. So we're exploring these issues. I think it's early days on the interoperability front, but clearly the more interoperability you have in a space like that, the more liquidity will be able to flow, and the more competition you could potentially support. So I think as a general principle, we support interoperability. Of course, the details have to be worked through in each case.
Yeah. Are there risks that you see if we don't move on this in this space with some urgency, I guess?
Well, there's a lot of developments internationally, particularly around stable coins, which we're monitoring closely. The good news for Australia is the legislative framework is being developed. The work on stored value facilities under the payments licensing reforms would also deal with stable coins. So that's an example of where we're on the path. The digital asset reforms, of course, are also very important there. For putting us on the path. So it's an area the RBA is heavily involved in. We're putting a lot of our research efforts into it. We're thinking about the future of money, the future of financial markets, to help position Australia well as these technologies evolve.
Thank you. One more question, Chair, is that okay?
Yeah.
I just want to go back to the fees, and this is a question, I guess, for all three regulators. They are clearly very complex. We've heard that there's opaqueness. I read submissions where people were saying scheme fees, hundreds and hundreds of pages. One might argue that that's not opaque, but it's very complex. So where are you seeing, and I'm thinking with the regulators that particularly deal with complaints as well, where are you seeing the complexity lead to real issues for consumers and merchants and banks?
We've certainly seen the real issues for merchants from the scheme fees. The consumer is somewhat shielded from the scheme fees issues, but the merchants have the scheme fees passed on to them one way or another by their acquirers. So we've received in response to our consultation paper a lot of feedback, which we published in a summary of the submissions regarding some of the impacts of this complexity and some of the scheme fee practices on the acquirers and the payment service providers and through to the merchants. So yes, we've got a good list of those which we would be happy to provide the committee on some of the practical complexities that the scheme fee arrangements have been imposing.
I wonder if ASIC may have something to add, and of course AFCA has made a submission to the committee about what complaints come before AFCA.
Yeah, if you can do it very quickly, just because I'm conscious we've got the next roundtable to do.
Yeah, in 5 seconds, just to mention that adjacent to the work on fees from a consumer perspective from ASIC, we're worried a lot about scams and fraud. So that consumer angle, which the scams protection framework, the SPF, and work that's done for fraud in relation to the e-payments code are adjacent frameworks that help address some of those direct consumer issues.
Thank you. Now, APRA, I don't want your other regulatory colleagues to think you got off lightly. I am going to ask you a question on notice, though. I was a bit concerned about Binance getting access to NPP, and then they were taken off a few days later by an industry participant. So I'm going to be putting some questions on notice around that, unless there are any issues you want to quickly cover off before I move to the next roundtable.
Thank you, Chair. We're happy to take that question on notice.
Okay. Thank you again to everyone who appeared. The committee secretariat will contact you in relation to any matters arising out of today's hearing. Just following on from what I'd flagged, there are no doubt there are a lot of questions we could have run through, and I'll be placing personally a number on notice. I imagine colleagues will be doing the same. So I just want to flag with all the regulators, you'll probably get a few questions on notice that come out of this. You'll also be sent a copy of the transcript of your evidence, and I'll have an opportunity to request corrections to transcription errors. But again, we're very grateful, not just for your appearance today, but for your ongoing work in this system. Thank you again.
Thanks, Chair. Thanks, everybody.
Thank you.
Thank you very much.
So we'll move to the next roundtable, which will involve the banks. So if you want to... Okay. Okay. I saw my name. We good to go? Righto. Okay. I want to welcome representatives of the Australian Banking Association, ANZ, Commonwealth Bank, NAB and Westpac to give evidence. For the Hansard record, could you please state your full names and the capacity in which you appear before the committee? So starting with the ABA, then ANZ.
Simon Birmingham, Chief Executive Officer of the Australian Banking Association.
Nigel Dobson, ANZ. I'm the Banking Services Lead at ANZ, covering payment services, infrastructure and operations.
I'm Shane Conway, and I'm the Group Executive of Transformation at the National Australia Bank.
Westpac.
Joel Enhart, I'm the Managing Director of Merchant Acquiring at Westpac.
Ethan Tees, Executive General Manager, Payments for CBA.
Thank you. My apologies for missing you. Okay, before we proceed, I just want to advise you that although the committee doesn't require you to give evidence under oath, this hearing is a legal proceeding of the Parliament, therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as a contempt of Parliament. The evidence given today will be recorded by Hansard. It attracts parliamentary privilege. I now invite each of the witnesses to make an opening statement before we proceed to questions, but brevity is your friend, if I may gently try to persuade you all.
Thank you, Chair, and I believe mine will be the only opening statement.
Okay.
And thank you very much. It's a tad surreal being back here and it not being a Senate Estimates Committee, but I thank very much you, Chair, the members of the committee for the opportunity to appear today on behalf of the Australian Banking Association and, of course, to be joined by colleagues from some of our members. When we discuss the payment system, it is easy to get lost in technical complexity. But for millions of Australians who this morning used their phone to pay for a cup of coffee, a train ticket or to fill up their car, it is simply a utility. like electricity or water, they expect it to work instantly, safely and at a fair price, as do the businesses who rely on it. The efficiency, convenience and security that underpins modern commerce has been enabled by the sustained multi-billion-dollar investments made by Australian banks over many years. In recent years, for example, the industry came together to deliver the new payments platform, the NPP. This multi-billion-dollar infrastructure is what allows money to move securely and instantly 24 hours a day. It is also, crucially, Australian-owned sovereign infrastructure. Banks also carry the large responsibility for keeping the payment system secure, requiring substantial ongoing investment into areas like fraud monitoring, financial crime, cybersecurity and scam prevention. Importantly, the investments and capabilities facilitated by Australian banks provide the functionality that enables innovation to flourish. For example, the NPP underpins new account-to-account payments offerings, and certain mobile wallets and buy now, pay later offerings are only possible because of the investment by banks into tokenisation and card scheme rails. Parliament's scrutiny today is welcome because the landscape has and is fundamentally changing. While the experience for the consumer has arguably become simpler, the system behind it has become even more complex and layered. In addition to the huge international card schemes, the payments landscape is now interspersed with a wide range of intermediaries and specialist providers, often global payments and global technology giants. With mobile wallets now used for more than half of in-store card payments, this rapid pace of change is evident. The challenge we face is that this shift has created a concerning imbalance. Australian banks do the heavy lifting to keep the system running and secure. Fees paid to Australian banks, such as interchange, are transparent and have been subject to regulated price caps for over 20 years. In contrast, as the system has added more layers, a significant and growing portion of the fees paid by Australian small businesses are opaque and unconstrained by similar regulation. These global players generate significant value from Australian commerce and the infrastructure and services provided by Australian companies, yet they do not face the same regulatory obligations or requirements to invest in and support Australia's payments infrastructure. To put it simply, these companies do not build or maintain the roads that Australian commerce runs on, yet they place their own toll booths at key intersections. The Parliament's recent reforms to the Payment Systems Regulation Act were a vital acknowledgement that the world has changed. The Reserve Bank now has the power to look at the entire ecosystem, and in a very welcome step, the RBA has indicated it will commence a review on this matter later this year. If we continue to focus our regulatory lens only on the domestic players, the parts of the system that are easily observed and regulated, we are penalising the very institutions that invest in Australia and pay their fair share of tax in Australia, while giving a free pass to the global giants who have little accountability to the Australian public. This does not lead to lower costs for small businesses. It simply shifts revenue offshore and diminishes our capacity to develop the domestic systems that keep our economy competitive and secure. There is a fundamental question of national interest here. As we look towards the future of agentic commerce and stablecoins, Australia risks becoming entirely dependent on technology imported and controlled from abroad. This would mean a future where the cost of doing business in Australia is increasingly set beyond our borders in the boardrooms of multinational corporations thousands of kilometres away. As the committee looks at key issues of transparency, fairness and accessibility, we urge that careful consideration is given to how these issues intersect with fundamental questions of our national interest, sovereignty and Australian capabilities. Thank the committee again, and we are all happy to take your questions.
Tremendous. Thanks for the opening statement. Okay, so I've just got two, just cutting straight to the chase. So I get the argument that's put forward, particularly around getting access to, I think CBA has been the loudest proponent of this, NFC, and the arguments you put, Mr Birmingham, forward, and I have a great deal of sympathy for it, but there's something in the back of my mind that just I just got to test. So it's big banks v big tech. I might as well go through the Godzilla v Kong scenario. So, for example, the government recognises that there's a natural monopoly that exists, as it has with big tech in other realms, most notably in media, and decides that this should be opened up and that there should be greater transparency and competition on the setting of fees. Say we do that, like, my take is consumers will see no benefit of that. It'll just be a shift of profit from Kong to Godzilla. They do better, but what happens to the small business? What happens to the consumer? Will there be any flow-through of benefit to an average consumer if we were to attack this head-on? I remain unconvinced, but as they say, change my mind.
Sure. Well, thank you, Chair. Context I'd give is on a couple of fronts. Firstly, the Australian banking landscape is fiercely competitive, and we've seen that competitiveness have a range of effects in recent times. We've seen pressure on net interest margins over recent years, and we've seen, indeed, crunching in terms of areas of return on equity in different places, and fierce competition in areas such as, of course, the mortgage market. But also fierce competition for business in the payment system, and a recognition that that is a key part of the infrastructure that we rely upon. Of course, banks, and particularly the four represented alongside of me, are large businesses in the Australian context. However, when we look now at the global technology and payments companies they increasingly deal with, they are by comparison quite small businesses. And the market capitalisation of Apple is many multiples that of the four banks represented here. And the pressure that can yield when we see, as I said, now more than half of in-store card payments being made through digital wallets, and those digital wallets overwhelmingly being through a phone that has a very, very large proportion of the market share in Australia. That is a consolidation unlike what we have seen in terms of banking competition in Australia before.
I get that, and I think CBA has, as I said, been the biggest proponent, particularly in terms of Apple Pay. Apple Pay came in about 10 years ago. CBA's profit, I think you've done better than most of the banks over that period of time. Your profits are up about 12%. I come back to the central point. We make any headway on this, Mr Birmingham, what confidence do consumers have that they will see the benefit of addressing that market power that you've described?
Chair, I think the confidence does and should come from the competition that exists between these and other banks. And that competition is getting fiercer, and all of the independent financial analysis that looks at competition between Australian banks shows the competition for not just the mortgage market, but increasingly the small business market. Of course, if you're playing in the small business market, the desire not just to be providing lending services, but also payment services is a fierce one, and one where that competition is about trying to look at the areas of creating an attractiveness for people to do business with you. But also come back to the fact that in terms of the fees and structures we're talking about, in the payment system, the fees that the banks can charge are regulated and have been regulated for 20 years. So they face that type of constraint as well as the competitive aspects, unlike those multinational players.
Okay. The second issue before I hand over to Ms Jarrett is the biggest one. There's no way we can have an inquiry like this without addressing this issue, particularly around fairness, and it's the setting of interest rates on credit cards. I get that there's a risk element that reflects the interest that's set, but given the amount of data that now is collected on consumer behaviour and their ability to repay, but why has there not been any move by banks now to be able to give a fairer deal to average consumers, to put them on an interest rate that better reflects the risk of that individual, given how much data you possess, given the ability that you can crunch those numbers much easier, particularly with the embrace of AI by banks? Why can't consumers expect a better deal on interest rates on their credit cards?
Chair, there are many different product offerings in that market, different interest rates, different interest-free periods, and if we look at where transaction data is going, credit card usage in terms of transactions is relatively flat, whereas debit card usage in terms of transaction numbers continues to go up quite significantly. So consumers have the choices both between credit cards of those different interest rates, different interest-free periods, different other benefits that apply, as well as, of course, a debit solution that has become increasingly convenient, is in many ways an equivalent to using cash, but with the convenience of digital payment systems attached to it. And you can see from the data as to how consumers are making those choices, including for interest-free propositions by using their own money through a debit card.
So you reckon? So I mean, that based on what you said, I draw the conclusion in my head that consumers are voting with their feet, and in large part it could be because of the interest rates that are set. I mean, is it based on what you've just said, Mr. Birmingham? Are we seeing the end of? Are we able to see the likely end of credit cards if people are using debit because they just don't want to pay the fees and the interest?
No, because a large part of that debit growth, of course, will be the shift from cash transactions, and we've seen that huge decline in relation to the use of cash into the digital equivalent of using cash, which is to use a debit card as distinct from a credit card. It's always important to remember that by its very nature, the credit card is not your own money, it's a lending capacity, and it's a loan that is there, and so that's why it comes with higher costs to service. But across the full spectrum of banks, they do all offer within themselves different credit card products at variable rates and conditions.
But they're way higher. Those rates, though, Mr. Birmingham, are way higher than what the cash rate is. I mean, they're a double-digit interest rate. They're very, very expensive. I don't think you'd. What would be the lowest interest rate you reckon exists on a credit card in Australia right now?
I'm not going to try to guess, but I'm happy to go away and do some research on notice. However, as you rightly acknowledged at the outset, there are absolutely fundamentally different risk factors compared to a securitised loan for a residential property compared with credit cards that are not securitised in the same way.
Yeah, okay. I use Chair's prerogative to ask more than two questions that I flagged, so I'm going to hand over to Ms Jarrett, and then Mr Violi, you'll be next.
Thank you. I just want to pick up on the comment that you made earlier that certain players in the system don't pay for the roads and the infrastructure, and that's part of the evolving landscape that we're facing. I notice in your submission also that you're a little critical of the three-party systems. And we also heard earlier that we have, though, one of the most seamless payment processes in Australia. So my question is, what's the answer here? We're trying to keep costs down for consumers. We're trying to create a more efficient system. We need greater competition. You know, what is the answer to what we should be looking at? I know that's a very, very broad question, but coming from your perspective.
Thanks, Ms Jarrett, and my colleagues may wish to add to that, because I know Mr Tias was wanting to add something before, and I should have deferred. I think, firstly, yes, those relativities. There's contributing to the payment system, and there are also all of the issues that I know you are well versed in terms of the relativities of contribution overall. Let's be clear, as our submission calls out, the two big card payment schemes, Visa and MasterCard, reported through the ATO's Corporate Tax Transparency Register, paying $3 million in tax in Australia, Apple paying $153 million out of some $12.5 billion of revenue, compared with these four banks paying circa $10 billion in tax in Australia. So there are big differences in contributions to building things like the new payments platform, and in contributions to public welfare and public good through being good taxpayers. In terms of what the answer is, the new PSRA powers legislated by the government and the Parliament, very welcome, as I indicated, The fact the RBA has indicated that mid this year they expect to begin consultations around how they will review those parts of the payments platform and system that are captured by those powers, three-party schemes, digital wallet providers. Again, very welcome, and we have been urging since the passage of those laws, and indeed prior to it, for the RBA to undertake that review, looking at the transparency of those fees, using those powers to be able to perhaps break through contractual restrictions that mean it is not clear, and often banks and others are heavily legally restrained under those contracts from revealing some of those fee structures. And so having the RBA with those powers to delve in, very, very critical. Then areas where possible competition can be enhanced, and we see those debates around access to the hardware of phone services for being able to have more competitive solutions, access to app stores. These are all things that I would expect to be explored, but colleagues may wish to add.
Yeah, I might just add, and some of that will be a recap, which is, if you look at the future, I would probably sum it up in three things. One, that it ought to be sustainable. Number two, and you heard the RBA say it earlier, that there ought to be a level playing field free of free riders and rent seekers, and that it ought to be competitive. That's going to drive the world-leading payment system in Australia. And you asked at the beginning of your question about the three-party schemes. This is an area where there's been a competitive disparity, where that level playing field has been uneven. And the question is, will it become more uneven before it becomes more level? I think that's before us here as we widen the aperture and talk about what goes beyond the current PSRA. I might take the opportunity just to respond to the chair briefly on digital wallets and the opening of the infrastructure. I think it's a great question that, what will the consumers and businesses really get? You would see in Apple's submission to this committee that their fees have not changed since they launched the service. They've stated that very clearly. But that doesn't mean that they will never change. And when you have choice, you can put competitive pressure into the system. We see when we speak to our customers that they want to have choice, and they trust banks to support them in making their payments because they know the banks ultimately are responsible for their safety in many aspects. And so I think if you look at opening the system and doing what was done in the EU, this could open the door to both domestic industry innovating, but also fintechs innovating on this infrastructure. And we can't foretell what we're going to get, but we know we're going to get more choice.
Can I just follow up on that? The EU, what's the EU example you're specifically referring to? Because I know they've done a lot of work in that space.
Oh, yeah. So with regards to the NFC chip, we have a two-speed outcome. We have in the EU, there is a opening of the NFC chip. And this does get very technical and complex, and I think there is some benefit of hiding behind the complexity that certain parties.
You might just give the 2-second version.
Yeah, 2-second version.
Get some maybe the
the EU has opened what they call the host simulation service, and they've done that on open access regime. Whereas in the rest of the world, there's been a voluntary opening of the NFC by Apple on the secure element, which introduces technical complexity for those building and a lack of interoperability, which you heard before was important.
Thank you. Chair.
Terrific. Mr. Violi?
Thank you, Chair. Thank you all for your time. Just in regards to the timing of banning surcharges, we've established that the government had committed to having it banned by the 1st of January this year, which has clearly not happened. What I'm trying to understand is, was the ABA or any of the big four banks there today consulted around the timeline when it was announced in 2024, given your importance to the sector?
Thanks, Mr. Violi. I'm not aware of consultations, but is well known I was in a very different place at the time of those statements in 2024. I'm happy to take it on notice to see if there were any prior consultations. In terms of the timing as that has evolved since then, shortly before my commencement in this role, the RBA released draft proposals for how it may look at those reforms to surcharging. Those proposals were far more sweeping in terms of impacts on other parts of the payment system than I think had been anticipated. And there has been a lot of question about some of the assumptions and analysis underpinning those. And the RBA has gone through, I think, a very welcome process of engaging more deeply, seeking more data, and as it's gone through that process, made the decision late last year to extend its decision time frame by 1 quarter. I note that these are powers independently held by the RBA through the Payment Systems Board, and it's ultimately their decision. But of course, the government has made its desire clear and is looking to see, I've got no doubt, the outcome of that decision, which we expect next month.
Perfect, thank you. Now, just in regards to, I guess, removing cost from the system, we heard from the RBA this morning that if we ban surcharging in isolation, it won't make a difference. Essentially, the cost will be passed on to business and consumers through a change in the unit, cost of good pricing. And to do it successfully to benefit the community and small business, we actually need to pull cost out of the system. So very interested in your perspective on some low-hanging fruit or some opportunities where we can bring cost out of the system and avoid any unintended consequences to the stability of the system.
Thanks, Mr. Fioli. So one of the things that became apparent after the RBA released those draft proposals and submissions were made is that there were some areas of alignment in concerns between the ABA and our member banks, and indeed those representing merchants and small businesses, and that was that international experience showed the type of proposals to cut interchange fees, which in Australia are already very competitive, if not low, by certain global standards, had not, in terms of other international examples, materialised in lower fees for merchants. That where cuts had occurred in places in the UK or in the EU, there actually had then been an increase in other costs by those who are not regulated. So again, here in this context, of course, we're talking about card schemes or the shift to three-party platforms such as Amex and the growth in utilisation of those and potentially seeing people and particularly merchants face even higher fees through those platforms. Then we also have highlighted and have been touching on here the complexity around that growth of digital wallets, where the payments to companies like Apple come from within those capped interchange fees. And one part of the RBA's proposal was to look at a potential 30 basis points cap in interchange. Publicly reported that Apple in some cases charges 15 basis points. Mr. T has touched before on the fact that they seem to indicate that hasn't changed over a period of time. And so we're looking at the possibility under those scenarios that half of the eligible interchange fee could essentially be going straight offshore into a company like Apple and really diluting the capacity and capability of banks to be able to fund and manage that payment system. So they're the concerns that obviously have been raised. As I said, we've welcomed the RBA's approach in seeking more data, seeking more information, giving itself a little bit more time to analyse that and now await their decisions.
Perfect. Thank you, Mr. Birmingham. Just a question for Westpac and specifically around deposit deception and the links around debit cards. So when Australians are signing up to their high interest savings accounts, they want to receive the interest rate that's advertised. However, many banks, including Westpac, have transaction hurdles within these savings accounts. I want to go specifically to the Westpac Life account, which is promoted to 18 to 34-year-olds who are told, and I quote, "You could earn bonus interest plus $50 cash back when you spend and save." Now, these young Australians must make 20 eligible purchases with a debit MasterCard linked to their Westpac Choice account to receive the higher interest rate. Now, transactions using Visa and MasterCard often cost more than other options. So why is it a requirement that it's linked to a debit MasterCard? And do you think it is appropriate to force Australians to pay more for their own money to get a savings rate that they should be entitled to?
Thank you for the question. I'm happy to provide a high-level response on that, though Certainly high interest savings accounts are slightly outside of my expertise, and happy to take further questions on notice. But so what I would say is that behavioural savings products, the like of which you've described in terms of the life account, are common practice across the industry and typically are designed to encourage saver behaviour. So encourage active use of the facility, as well as, often with other types of savings accounts, certainly those offered by us and others, to encourage regular saving towards a goal. It's the intention of the product. From time to time, we will run offers and promotions that may link to some of that behaviour that we would like to see in terms of positive spending and saving behaviour, in order to unlock additional value that wouldn't otherwise be offered on the account. But as I said, happy to take further questions on notice with respect to that specific product and example.
If you could, because I understand the level of transactions, etc. However, when you're forcing people, particularly younger people, to use a debit MasterCard, and let's be honest, I would actually like to know the numbers, if you can, on how many of those people are using Tap and Go, because the vast majority of 18 to 34-year-olds would be using Tap and Go. And it's hard not to look at this requirement and not think that there's no encouragement to savings. It is purely a mechanism to drive extra cost into the system at a time when we should be removing costs. So, yeah, if you could provide more detail on those using that system, any data you can provide around Tap and Go and those kind of things, that would be great. Well, Chair, I'll send some more detailed questions on notice for Westpac around this as well, and then I'll cede my time now.
Thanks. I think in a rare moment of bipartisanship, I think that's the issue for a lot of consumers, is that while they'll hear you say it's not right and this money's going offshore and we've got a big tech player against us, their own lived experience is they get soaked along the way by the banks themselves. So where is the benefit? I don't think that's been answered in terms of opening this up. I get it on the theoretical ground, on the logic about what needs to be done, but I just don't see what the consumer benefit will be, because none of you will be able to say that you'll pass that on. And if I may, before I hand Mr Gregg, I have to correct something. I suggested that CBA had done the best over 10 years on cash profit, but in actual fact it was NAB at 21.4%. So my apologies, NAB, but anyhow, it's a lot of money. So over to you, Mr Gregg.
Thank you very much. To what extent do you think that market dominance of Apple Pay and the like was enabled and facilitated by the banks?
Well, Mr Gregg, I think colleagues may wish to add, but in terms of the consumer trends in Australia, Apple phones are overwhelmingly the dominant phone in Australia. They have, I think, around, trying to check the exact data while others are talking, but around 60% or so market penetration or market share for phones in Australia. So by virtue of that, in some ways, their technology, constrained as it is in terms of access points, as Mr Tias indicated, has by default become the dominant player. I don't think Australians choose their type of phone by virtue of the digital wallet that is available on it. I think they're choosing for a whole range of other functionalities, and I'm sitting here with an Apple phone in front of me, and there's a whole lot of other reasons that drive them to that. That's to Apple's credit in terms of their innovation, technology, branding, marketing, etc., but it's come with a consequence.
But the banks chose to allow their cards to be put on an Apple Wallet, didn't they?
Banks did, starting with one, and others, of course, then did so, responding to consumer desire, and we can see the way in which, and nobody at this table is contesting the benefit for consumers of being able to access those services and technologies and no longer having to physically carry a card around with them, but the convenience of Tap and Go is something all welcome. What we have, though, is a player with huge market concentration now and consequences that come from that market concentration.
but the banks have signed up to platforms knowing what they are, as has been pointed out, the fees haven't changed, and now suddenly want access to the hardware in the background. Is that the correct understanding?
Well, I think that is one of the potential policy responses that we can see in the EU type context where that is being provided, and we are far from the only country in the world having this debate about what the consequence of that market concentration is, because it's reflected in other parts of the world in similar ways. And as has been the case with many parts of the growth in technology over decades now, the type of response, be they antitrust laws elsewhere or competition practices, are real ones for policymakers to respond. And of course, this Parliament has done so, considering a range of other consequences. This is arguably the next one that warrants that consideration, already done partly through the PSRA Act and those powers, but potentially with other measures that will need to be considered by the RBA and or the Parliament.
I just made add two pieces of color. I mean, one is, yes, there's a fertile ground for digital wallets in Australia because of the investment of the domestic industry in creating a world-class payment system. When I got here in 2013, it was impressive how ubiquitous tap and pay was in Australia for plastic instruments. And you wouldn't see that even today in the US. When I go to the US, I have to carry my wallet, which is long gone here in Australia. The second thing is I think that the banks entered into this delicate bargain knowing that there was some risk, and it's well documented that the banks sought ACCC approval to collectively bargain, and at the time that wasn't entertained. I think ultimately it is the case that the power has been revealed in a much more clear way, and I do wonder if the same decision would be taken today.
Do love a bit of collective bargaining. Obviously, you spoke of the overseas experience. Overseas, it's quite common to see QR codes and the like, and for us, they're just a bit of a COVID trigger. But how much effort have the banks put into promoting alternative methods of payment outside the wallets that are lower cost for all involved, really? So, to enable this new infrastructure that's being developed to be fully utilised.
So colleagues at the table might wish to touch on any of the particular experiences they have. The NPP itself providing that infrastructure, and infrastructure not only being used by the banks, not just by these four, not just by the other banks, but of course also by new competitors outside of the banking ecosystem accessing the guardrails of that bank-funded infrastructure through the NPP. But I'll welcome others who...
Yeah, so the answer to your question is we've spent a lot of time and investment building out our Pay 2 proposition, which enables Australians to buy things online directly from their bank account. So that doesn't process through the card schemes, it's directly from the NPP system. So a lot of investment has gone into that, and we're seeing good growth, but it's not as ubiquitous as card payments yet. And then we've got other innovations like Pay ID receivables for business customers, which enables Australians to pay directly using an email or a mobile account to a small business. Again, that's growing, but still very early days. All of these things leverage the NPP infrastructure that we built up over many years, and a lot of investment from the banks.
So in terms of investing in promoting those alternatives, is there a concerted effort? How much money is being invested in promoting alternatives to the status quo?
Yeah, a significant amount of interaction with our business customers, because we start with the business customers because ultimately they're the ones that need to receive payments. It also involves change on their side. So as you can imagine, businesses have a wide range of ways they can receive money, and often they want to make it as simple as possible. So a lot of our effort is talking to the larger business customers about how we can help them reduce their cost of payment acceptance. And some of those projects can be quite significant for the largest merchants in Australia. So that's one side of the market. The other side of the market is getting customer awareness, or Australians' awareness of things like Pay 2. So you've probably seen some of the advertisements on bus shelters that AP Plus, which is the body that sort of administers that scheme. So we're investing more, but we've still got quite a long way to go. And interestingly, when you speak to other banks offshore, they're very interested in what we've done with Pay 2 an MPP, and I think Australia's a leader in that space.
Thank you. I'll leave it there for now.
Okay. Julie, over you.
Thank you, Chair. I wanted to start by referencing Mr Birmingham's opening because I think at the front you said it's easy to get lost in the technical complexity of these systems. And that's been really clear just from our first kind of hour and a half of the inquiry. And so I guess given the fact that many of us on this committee are very focused on the impact on consumers, I was going to ask if my mum went to go buy a coffee at a local small business, how would you explain to the small business owner and her how your fees work and at what point they're paying them?
Thanks, Mr Campbell. I'll give a shout out to the AHA submission that before getting to the substance of the issues does quite a good job highlighting the complexity of some of the terms and language that exists across the payments ecosystem. Many of it, of course, for good reason, because it is a complex technological system that sits in the background. Now, the first point I'd make is, in many ways, there are costs for all forms of payments. We don't tend to talk about the cost of receiving cash in the same way, but there are costs for small businesses in terms of security, in terms of transport. Indeed, industry is investing significantly in terms of how to maintain those transportation of cash logistics across Australia as people use cash more, but it still needs to securely be moved around the country. And so the costs exist in all of those areas. And it exists in the background where consumers, quite rightly, care about least cost and greatest convenience. And so in terms of explaining, there's absolutely a need to explain, I think, to small businesses and merchants about the cost architecture that exists for them. And the point I made in the opening statement is that is arguably getting more complex through different practices that are undertaken, as we do see more competition, but the competition is not necessarily leading to lower fees or costs for some of those small businesses. If I look at some of the published merchant pricing comparisons, the banks offering traditional merchant services for SMEs range between around 1.1% to 1.2% flat fee transactions costs, whereas some of the other startups that are growing in market share in terms of providing merchant services, Tyro, Square, Zeller, SumUp, they're at 1.4 to 1.6% in terms of the costs that they charge. So we're seeing new players, but they aren't necessarily actually providing lower costs in terms of those services. The reasons, again, may be technology and other solutions that they are successfully selling to merchants, but making sure that merchants do understand the propositions that are available, and indeed, as Mr Conway was talking about before, some of the alternatives that are available for merchants that are also offering different cost solutions to them, driven by technology that the banks have invested in.
And how do you think, and thank you for that answer, how do you think that a small business would respond to that answer that you've given in terms of understanding how the payment system works and how fees work for them?
Yeah, I think, obviously, depends very much on the small business. I think, again, those small businesses, like their customers, want reliability, convenience, least cost. It is a fierce marketplace to go after those merchant businesses and to have them sign on, but people compete on different propositions. That's evident by the data I gave before, that those charging higher fees are presumably winning because they're convincing those small businesses of different value equations, whatever they may be in their circumstances. So each small business will make the decision based on what's convenient for them in terms of that matrix of reliability, convenience and cost, and how they assess against that. And it's for of course, these players to all compete on those grounds. But it is also in the face of disruption.
Yeah, can I just add one thing? And I think it's a very important point that you've made here, and what we, when we talk to our bankers, and so these are the people that go out and speak to small businesses, what a good banker will do is shield the customer from that complexity, because it is very difficult to describe how it works. And honestly, a lot of small businesses they're not that interested. That what they want is something that's very, very reliable, that it's very clear and transparent around what they're going to pay. A lot of small businesses we find want certainty. So convenience and certainty is very high on their needs. And often payment fees are not their biggest issue. There are other business input costs that are far more concerning to them. And this is a sort of recurring theme of what we hear from small business customers. But it's very difficult to explain how scheme fees work and interchange, and actually a good banker tries to shield customers from that.
I know you're trying to say that from a good perspective. Sorry to
No, you're
jump
right.
in, but when you say shield them from the complexity, it makes it sound like, to me, don't worry about that, we've got that sorted. But they're actually genuine questions around transparency, and this multiplicity of scheme fees is a real issue.
And that's what our submission reinforced, is that two things. One, increasing transparency has tended to lead to lower fees over time, and you can see that in the merchant service fee data that the RBA publishes. It's come down by, I think, about 30%. And so, yes, transparency is very important, and it does lead to more competitive markets. We also think that simplifying how scheme fees are charged is also a very important thing. These are charges from the card schemes to the bank, so we don't set how they come across to us. And so that was another feature of our recommendation, is to simplify it so that you can make comparable price comparisons across providers.
It's the difference between the world as it is, which is that it is complex, it is opaque in terms of things like those scheme fees, those digital wallet fees, etc., versus indeed what has presumably been part of the genesis of this inquiry by the committee and the government, which is how do we make those things more transparent? Interchange may be complex, but you can find it on the internet very clearly laid out as to what those interchange fees are. The same cannot be so clearly said in terms of all of the other parts and the growing parts of the ecosystem, like the digital wallet fees.
In a world where small businesses are super busy thinking about everything else, do you think that transparency can be achieved with a system this complex in a way that is meaningful?
It can certainly be enhanced, and I think to Mr Conway's point, the transparency itself can then drive further competition, and does drive further competition. A near monopoly player operating behind non-disclosure legalities put into their contracts, not being clear about what they are charging, that is not helping anybody and not driving any sense of competition or better outcome. Does the fact that they're in this part of the payments landscape, in four-party schemes, will always be complexity because there are four parties, or indeed more than four parties involved in it, mean that we can expect consumers and merchants to completely understand all of the aspects of that? No, but of course most parts of, or many significant parts of the economy, people don't understand all that goes into electricity generation, transmission, retail, all of those components that make up other forms of pricing. But we should absolutely aspire to make it more transparent, to drive competition, and that's at the fundamental heart of our submission today, that by doing that across scheme fees, doing that in relation to digital wallets, the RBA having new powers in relation to three-party schemes as well, all provides capacity for a more competitive environment and a fairer reflection of where costs go. Because we are seeing, in terms of the banks, that fixed, that capped interchange fee, but a growing share of it going off to Apple as a result of that shift to digital wallets.
I suspect my mum might stick with her free seniors card coffee from Macca's, but that's it from me. Thanks.
Righto. Over to Ms Situ and then Mr Laxale.
Thanks very much, Chair. My question related to the difference in pricing between your larger customers and your smaller customers, your small businesses. I will put on notice, because I'd like to get insight into the different pricing between the two. So I know that you'll probably require quite strict parameters around the definition of that. But following on from that, why is there such a difference between what you charge big businesses in their merchant fees and small businesses?
Thanks, Ms Situ. And I mean, those, of course, go to competitive factors within the economy, the competition for business, different relationships that exist there. That might be one that the banks themselves wish to respond to in terms of how they approach those issues of competition. As I reflected on earlier, I think we are seeing a step up in competition across the market for small business banking services, and that is something we've heard Mr Conway talk about in terms of presenting other payment options increasingly to small businesses as well. But in terms of those particularities you ask about, if any of the banks wish to touch on. Thanks, Mr Lenhart.
Yeah, I'm happy to weigh in, and absolutely happy to take questions on notice around the specifics. But I think what I would say is that when comparing costs between any business on its acquiring costs, and it's not just small and large, I think it's important that we're comparing apples with apples. In my experience, there are a number of substantial differences between the underlying processing costs that go into processing transactions for very large or enterprise merchants versus small businesses. A very obvious example of that is that a number of those enterprise merchants qualify for strategic interchange rates with the card schemes. Those strategic interchange rates, in terms of the actual rates themselves and the qualifying factor, it's not something that the banks have a say in, so that is set directly between typically the enterprise customer and the card scheme. And those strategic interchange rates can lead to a substantial discounts on the cost of processing by virtue of the sheer volume of transactions that typically those customers are processing, which is not that different to volume discounting in any other kind of industry. On top of that, there are a lot of other fees that would typically go into providing a service to a merchant customer that we would typically bear or bundle. So underlying things like infrastructure and gateway fees, the physical terminal hardware and those types of things are often being supplied by the bank to the customer in a small business scenario, whereas often for a larger enterprise customer, they would be procuring those types of things themselves, which again, bring down their cost of acceptance. So I'm happy to take specifics on notice, but I think it's just important to highlight that it's not a like-for-like comparison necessarily.
And the things that you've just outlined there, and I understand the point about it not being a like for like, and some of those barriers, those steps that you outlined where there is a differential. Can you talk me through where, in what you've outlined, there is an opportunity for movement to help small businesses? So if there's innovation that's coming online that would help with, for example, the infrastructure that they require, or where do you see that there is potential movement on some of those barriers that are currently preventing small businesses from acquiring lower fees?
Yeah, absolutely. So, so from our perspective, I think a few things. So, transparency has been mentioned previously this morning. We think increased transparency around the costs that go into providing a payment service, to the end merchant can only assist in terms of continuing competitive pressure to bring those costs down. And that needs to be transparency across the other components of that payments value chain where there is currently limited transparency, and notably scheme fees. From our perspective as well, I do think that there's an element of this that intersects with the current discourse on surcharging. I personally, can attest that our small business rates are competitive, as are, I think any of the other panel members would argue that their small business rates are currently quite competitive and do represent good value for the service that's being provided. One of the challenges that we have seen emerge, in the recent years linked to surcharging has been breaking the nexus between the cost of the service that's being provided to the merchant and who ultimately bears that cost. And in the case of surcharging, that is ultimately the consumer. We think by certainly correcting some of that imbalance, again, that should have a restorative effect in terms of driving more competition into the system and bringing down costs to merchants.
So at the moment, the large driver of the cost, where would you say that the large driver of the cost in terms of these fees to small businesses are coming from?
Yeah, so I would say that, so just across the board, our view would be when we talk about large prices for small businesses, there are, as Simon's outlined, there are some market outliers where the cost of those services is quite substantially higher than the average cost to provide a service to a small business. I think my point is that surcharging is allowing that price distortion to continue, where ultimately the merchant is less incentivised to look at what price they are paying if that cost is ultimately being surcharged. We think that by, so very much welcome the RBA's review into surcharging and their announcement on that in March, which I think is probably going to have the biggest effect in terms of addressing some of that disparity.
I think point.
Sorry, go ahead.
No, sorry, I was going to add. So, key there that as we've seen the growth in some of those non-bank provided merchant services, I said before, welcome competition, but higher fees attached. That the unregulated nature of the way in which surcharging is occurring at present, that essentially it is not really policed and it is hard to police, and I think the ACCC and others have acknowledged it is hard to police because of the way the regime applies at present, does mean that there's a ease of pass-through by small businesses. If the surcharging regime changes, either through complete bans or caps that are simple to understand on credit surcharging, that in itself will likely put pressure on schemes and others as small businesses are more incentivised to shop around rather than see the opportunity to pass through those costs to customers. And that's something that we've welcomed. As indicated before, the actual small business fees charged by the banks are competitive relative to some of the others, lower than some of the others, and the opportunity is there to through transparency and regulation that is more effectively applied or enforced to create changes to the market conditions that could benefit both small businesses through some downwards pressure, but also consumers through transparency on what is or isn't allowed, and a capping of that or a elimination of it.
I've just got a final question around this sense of transparency and competition being a tool for small businesses to be able to get lower costs. If it is that there are going to be changes to surcharging, and like you've argued, that then incentivises the small business owner to go and shop around for a better product, a better payment product with lower fees or whatever it is that they're required. How would they do that? If you are the owner of a bakery shop, how do you even start to do this work, which is, like we've all said, incredibly complex? How do we make it? What's the role of each participant in this payment scheme to make it easier for that individual small business owner to get the best payment product for their shop?
I think, and colleagues might be better placed to explain in any further detail, but important for us to remember distinction between the complexity of the fee structures, the aggregate components, interchange fees, scheme fees, other fees that add up, versus the product offering often to SMEs being the type of flat fixed rate transaction fee that I just spoke about earlier in terms of the comparisons of the banks running between sort of 1.1 and 1.2% in many of their published SME offerings, others running between 1.4 and 1.6% in terms of their published offerings. That's simpler for a small business to understand. It's not going into the complexity of what constitutes the different parts of that fee. It's a clearer comparison that can be made between one product versus another. Now, then there'll be, what is the associated technology? How are those things used in a business for the convenience of their payment systems, and how does it integrate with their other day-to-day banking platforms? These are obviously decisions small businesses make all of the time, but by making changes to the surcharging regime, it can create, in our opinion, an environment where there's pressure on scheme providers, pressure indeed on some of the competitors to banks as well, that if surcharging is eliminated, then small businesses will definitely be looking at what the costs are, how they are either passed on in different ways or reduced through negotiating. If surcharging were, for example, capped on credit card transactions at 1%, then many small businesses will say, if that's the RBA benchmark, why are you charging more than that? And it will provide a point of conversation for what is allowed and versus what is charged, and stimulate those sorts of conversations.
Okay, just quickly, and then I want to move on to Mr. Laxell, if that's okay. Yep.
Oh, very briefly, I might just add, I think you're onto something there, that transparency needs standardization and tools. And so we've heard that from the industry. We had in our submission to the RBA's inquiry, which is narrower than this committee, exactly that a marketplace would have to be developed. And I think it's not a terribly difficult lift to catalog those characteristics and consume that in the marketplace. We also have heard from the small business community they want more time to do that shopping. And so I think those two things have been heard.
Okay. Is it okay, Ms. Siddle, if we move on? Yep. Okay, Mr. Laxell.
Thanks, Chair, and thanks for all your evidence so far. It's been really interesting. Just in regards to mobile wallets, got a few questions on that before I move to other topics. From my understanding, the main players are Apple, Google, a little bit of Samsung Pay, and then smaller ones still. Do they all charge fees?
No, my understanding is they do not all charge fees.
Okay.
Obviously, Apple does, and that is widely published.
What is that fee?
I've seen it reported as being 15 basis points. Mm-hmm. My understanding is that from answers given in other testimony, there are quite tight contractual restraints in relation to talking or openly or publishing what those fees are.
And that fee is non-negotiable?
Obviously, they're all contracts. You've heard Mr Tias talk before about the fact that banks did seek at a past time capacity to try to collectively negotiate around those fees. That wasn't granted, so they each would have individual contract settings. I can't say whether they are identical or not, Mr Laxale. I don't know.
Maybe a question to the banks. Do either of you or do any of you think you could realistically stop offering Apple Pay and other digital wallets to your customers?
I don't think so. I think the usage and the ubiquity of that as a way for Australians to pay, it's well and truly embedded in the society we live in, and it's a very low friction experience. So I don't see that we could feasibly not offer that to our customers.
Okay. So digital payments, do you think has sort of moved more from convenience? Like a lot of people have mentioned the convenience of tap and go, and I think Mr Tees, you were surprised at the level of tap and go. Like obviously COVID accelerated that. It's moved more from convenience to necessity now for banks in terms of having access to that wallet and for small businesses. Would you agree with that?
Well, I think convenience, if you look back over the history of payment innovation in Australia, and there's been lots of innovation over the decades, payment methods which are easier, lower friction and more convenient, Australians are very early adopters of those payment methods, and we've seen that consistently. The MPP is a good example where I think we're up to around 1.8 billion payments from a base of 0 over 5-6 years. So that's Australians adopting a better way to pay. It's faster, it's real time, they can see it, it's free for most customers.
But a small business couldn't stop taking, well, not many small businesses could stop taking digital payments, could they, at the point of sale?
I mean, it's a very diverse marketplace, but I think most businesses want to make their point of sale checkout experience as seamless as possible so they can serve more customers. I think they would always offer digital payments because that's the way consumers want to pay.
We're talking, it's an environment that is technology enabled and consumer led, if I can sort of put it that way. And T's point before around, before we got to tap and go through a digital wallet using your phone, using tap and go with cards, that again was technology enabled by banks investing in taking their cards and merchant services to a newer level, a level not necessarily replicated in other economies, as you heard in the example, but it transformed the payments experience for merchants and consumers, most significantly by being faster. And people were still paying by their card and getting the direct transfer of cash for those payments, but we all know how much faster tap and go made it, which of course was a productivity benefit for those businesses in terms of the speed of their engagement. Digital wallets, furthering that more at a customer convenience level of no longer having to carry their cards, but the ubiquity of, or increasing drive towards the ubiquity of that, if we're now talking more than 50% of customer present transactions, I don't think there are any examples of Australian consumers turning away from convenience once they've got it.
The cup I'm drinking coffee from, Chair, just so happens to have some numbers written on it. And these numbers are from MasterCard, right? And it explains the 8 cents in the $5.08 when you tap, right? And so they've said on average about 4 cents goes to payment service providers, 2.4 cents being interchange, and 1.6 cents going to schemes. That's their numbers. Where in this do these digital wallet fees come in, if at all? Like, are they part of that 8 cents?
My understanding, and I'll be subject to correction or addition by my colleagues, but my understanding is they come in at the interchange fee level, at the fee that is paid to the Australian banks, not the global scheme providers. And of course, it is the Australian banks in those interchange fees who are regulated, face caps that have been in place for 20 years by the RBA, have faced a proposal for reductions in those caps, and it's why we have been so clear, not just in urging transparency and other reforms through this inquiry, but also in urging the RBA to make quick use of the new powers they were granted by the Parliament last year in terms of looking at all of those other aspects. Because to go right back to my opening statement, the alternate scenario is the capability to invest in payments infrastructure in Australia by Australian companies that is sovereign and owned by Australia will be diminished, and increasingly those funds will be a greater proportion of them transferring offshore.
So as interchange has been regulated down, scheme and payment service provider fees have been going up. Do you think that's sustainable as a model, particularly for merchants, small businesses and consumers? Like how are we going to drive down costs if costs are only being addressed for 20% of the 8 cents?
And you'll notice if you get the answer wrong, you owe him an extra card.
I could make a joke. I could make a joke about coffee mugs.
It says back in black on the back. Yeah.
That was not a setup. That was not a setup.
But I figured I'd go there first. And now I've got to get my train of thought back.
Right. No, how are we going to drive? How are costs going to go down to businesses and consumers when only 20% of the cost is being addressed?
To reference again something I've said earlier, the concern that became evident from our submissions, and entirely separately in a different perspective from some of those merchant submissions to the RBA, was a common one of when we look overseas at recent efforts to try to reduce costs just by cutting interchange, it hasn't worked. And it hasn't worked because the costs have simply gone up elsewhere in the system. So I think the answer is it doesn't work to just tackle one component. We have urged the RBA, in terms of its current approach to surcharging, to do as the Governor herself has expressed publicly, and that is take a no-regrets approach. A no-regrets approach in terms of making decisions now to deal with some of the inconsistencies in surcharging that have been spoken of here. The fact that it is not transparent for consumers, it is not fair in relation to debit card transactions where people are using their own cash, that it does not necessarily drive full efficiency and competitiveness in the setting of fees for merchants, and that there are real things the RBA can and should do, but to apply caution when it comes to the type of proposals they initially outlined to deeply cut into interchange fees, because that could fundamentally erode the economics of the payment system for the way Australian banks invest in it, and simply result in more money going offshore without any benefit necessarily to consumers or merchants.
Maybe a question for someone with a more understanding of the digital wallet and the NFC. So in terms of how a bank could use it if they get better access to an NFC, like could you potentially create an item in a digital wallet that links to the NPP that you could still tap at a facility that would then totally bypass Visa, MasterCard, Amex? Is that sort of the technology that's available here? That's not like
speak hypothetically. I'm sure behind the scenes there's whatever competition happening.
Very similar
between...
to the chair. We'd like to try and you want banks are asking for access to the NFC like in Europe, right? But what does that mean for the consumer, right? Does it mean that duopoly can be challenged in the way that I've put up or other ways?
Yeah, so I think, and I'm sure Ethan has points that he'd like to add, but from our perspective, it is about providing optionality in terms of the way that those payments are completed and what rails those payments go through. So rather than being, so you asked a very specific question about a very specific use case. I think our point is Access allows optionality in terms of how that payment is orchestrated, and that optionality doesn't exist today.
Okay. But you've invested heavily in the MPP, right? And you've sort of outlined some initial steps. But at the same time, you've got commercial arrangements with Visa, MasterCard and Amex, which return some sort of revenue to you in the form of rebates. Is there do you have the incentive to decouple from Visa and MasterCard, given the commercial arrangements you've got with them?
So, from my perspective, it's less about the financial incentive. I think it comes back to what we were talking about before in terms of embedded consumer behaviour. So, there's an embedded consumer behaviour amongst Australian consumers in terms of tap and go.
Yeah.
And I think the question earlier in terms of QR adoption, for example, QR is an alternative to tap and go, but it is not as embedded here as it is in other markets. Yeah. And there is a hurdle in terms of QR adoption for payments to overtake tap and pay payments. I think the challenge is that today tap and pay payments are linked to a single type of payment processing. Some optionality around how that looks like going forward would give us the ability to look at different payment innovation to allow that to go through.
But what's stopping having that now? As my last question.
Yeah, I might answer that. For that to be a reality, there'd have to be two things. One is access to the NFC, which CBA already has an app on Android that uses the NFC, and we have good customer uptake on that, but not on Apple, and that's where the volume is. And the second is we'd have to have standards in the acceptance technology, the terminals, which would require going through the standardization process and rolling that out. So it's non-trivial, but it's very achievable technically.
We're just going to wrap up. Just to come back to something, a discussion you and I had, Mr. Birmingham. So, quick research, there's nearly $20 billion in credit card debt subject to interest. Total interest charges exceed $240 million annually. 30% of cardholders carry a balance. Rates on standard cards often exceed 20%. So I come back to the point about, can people expect a better deal on something if we were to address these issues? Would they get better interest rates, for example, on their credit cards? Also, picking up on the point you raised around the surge in debit card, which I'd put to you is reflective of the fact that people would prefer a cheaper way of being able to do their transactions rather than credit cards. I think you're going to suggest to me or stipulate to me that it's too early to start drafting the obituary for credit cards. But one of the things I wonder is whether or not loyalty schemes are the life support of credit cards, keeping customers stuck to them because they don't really have if they're looking at credit cards v debit, on a pure commercial basis, if I could put it that way, debit would be much more effective. So are those loyalty schemes acting like a life support system for credit cards in this country? The Qantas, the frequent flyer and the like?
Chair, in terms of loyalty schemes, and again, if I turn to some of the international examples where capacity to fund and provide loyalty schemes was constrained by deep cuts or changes in relation to interchange arrangements. That's where we've also seen some of the fastest growth of three-party schemes, namely Amex, which of course has very generous and significant loyalty schemes attached to it. So understanding that loyalty schemes are something that individuals, businesses through corporate cards as well, make decisions based on their personal attraction to particular benefits, are not solely held within the confines of the credit cards that banks offer, and that those loyalty schemes exist through, indeed, say, Amex, or I'm sure you would have noticed, as I have, increasing advertising by Revolut, also promoting loyalty schemes attached to that. So we are seeing that is an area of competition, not just between banks, but of course with other non-bank providers, payment providers, and the like. There's some good data in some of the bank submissions highlighting, that use of debit cards and that growth in transactions. Slightly more even growth in terms of dollar volumes. So we do see, again, perhaps driven by the corporate cards and other users of credit cards, a higher growth in the dollar volume of transactions, whilst the number of transactions actually remains flatter. So consumers, as I say, making those choices. Understand the point you make about the interest rate offering. Still say there are a wide range of interest rate options there. There are no frills, no rewards, lower interest credit card options that are available for Australians, and those choices do exist. And I think critically, and I always make this point in where I can in media or other public appearances, whether it's credit card debt or other debt, if Australians get into trouble with those things, then the need to speak to your bank quickly about that is the best way to try to resolve that problem and to find refinancing solutions to it.
Okay. Righto. Well, thank you all for appearing. I owe all the committee members a cup of coffee for dragging this into their break. Thank you to the banks and the ABA for your appearance. The committee secretary is going to contact you in relation to any of the matters arising out of today's hearing. There'll probably be questions on notice as well. We'd be grateful for you answering. You'll be sent a copy of the transcript of your evidence, and you'll have an opportunity to request corrections to transcription errors. I'm going to suspend proceedings for a short break, but we'll resume at 11:35, and we'll just have a slightly later start time, if that's okay. And with that, we're now going to break. the representative of Visa to give evidence. For the Hansard record, please state your full name and the capacity in which you're appearing before the committee today.
I'm Alan Matchett, and I'm the Group Country Manager for Visa for Australia, New Zealand and the Pacific Islands.
Thank you. Before we proceed, I just want to advise you that although the committee does not require for you to give evidence under oath, this hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and can be regarded as a contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. So now I'd invite you to make, if you want, an opening statement before we proceed to questions.
Thank you, Chair, and thank you to the committee for the opportunity to appear today. Visa has provided a submission to the committee as part of the inquiry, and in my opening remarks, I would like to briefly touch on three areas. Firstly, what Visa does and the value we deliver to Australian consumers and businesses. Second, the changing payments landscape and what we're doing to ensure continued investment in security and innovation. And finally, the competitive landscape we operate in and our commitment to supporting a world-class payment system in Australia. As a global network, Visa operates the technology enabling money to move digitally between consumers, businesses and financial institutions across more than 200 countries and territories. Today, Australians tap or click to pay, trusting their transactions will be fast and secure, with Visa's zero liability and chargeback rules protecting consumers. When Australian airline Bonza stopped operations in 2024, unlike consumers who paid for flights using direct debit, Visa cardholders were able to secure refunds. Through Visa, businesses access a global customer base, new payment innovations and cutting-edge fraud tools, helping them operate more efficiently and driving economic productivity. And behind every split-second transaction is Visa's global network, operating 24/7 and processing up to 83,000 transactions per second. Importantly, it's our financial institution and fintech clients who issue Visa cards, set interest rates and customer fees, and compete on cardholder benefits. Acquiring financial institutions set up businesses to accept card payments and charge accordingly. My role, and that of my team in Australia, is to support our local clients through sales and marketing. I want to touch on the changing landscape as the inquiry comes at an important time. Advances in technology and computing power are reshaping the future of payments. AI, agentic commerce, account-to-account payments and stablecoins are expanding choice and accessibility. These carry substantial upside for Australians, but only if continued innovation, security and consumer and business protection remain core. Within the next decade, quantum computing will move into the mainstream, unlocking opportunities for businesses, but also empowering cybercriminals. Many are already preparing with the Harvest Now, Decrypt Later strategy to exploit today's data with tomorrow's quantum power. We've invested $15 billion in technology and innovation over 5 years to ensure we stay future ready, and now is not the time to pull back on investment. Finally, I want to address the competitive landscape. Today, we compete with a broad set of payment companies, including three-party networks like American Express, digital wallets, and BNPL providers who, despite being key participants in the digital payment system, currently operate outside regulation. Our pricing, known as scheme fees, is paid by financial institution and fintech clients. They reflect the benefits we deliver, managing the security, reliability, and global reach of Visa's network, and represent only a small component of the total cost a business pays its financial institution. We recognise small businesses face challenges, and our refreshed small business program provides access to some of the lowest payment acceptance costs in the country. That program offers preferential interchange rates to financial institutions and fintechs who support small businesses' growth on the Visa network. With balanced policy settings that enable innovation, Australia's payment system will remain globally competitive, continue to deliver best-in-class payment experiences that benefit consumers, businesses and the broader economy. Thank you for the opportunity to appear, and I would be happy to answer any questions you have.
Terrific, thank you. So the issue, understandably, of scheme fees comes to the fore. We always get from the business community, understandably, encouragement to cut red tape. But I think I read in one of the submissions there are more than 400 categories of scheme fees, 400. And it just seems to a number of us that there's a lot of complexity baked into the system, lack of transparency, which makes it hard to try and go, well, how do we make this work better for everyone? So I'm just wondering, does Visa make it clear what the purpose or value of these fees are? How many scheme fees do you operate? And when new scheme fee categories are added, should those be clearly justified?
So scheme fees represent what we charge, of course, Australian issuing businesses, that's banks and fintechs, acquiring businesses, the acquiring organisation that supports Australian merchants, and that goes to support the global network that we have. That's that $15 billion of innovation. We've invested in security, reliability, Visa's uptime's 99.99%. All of that goes into making sure that we have a strong and safe system. It's the first point I'd make. In terms of the scheme fee components, there's issuing side scheme fees and acquiring side scheme fees. There's enormous change that's been coming. Visa's been in business for over 60 years. The growth in new services, changes in the services we offer to those businesses has also been quite substantial over that period of time. And in fact, more recently, there are a number of new innovations that we've brought to bear to the market, some of which are standardised and all of our customers pay, others of which are a choice in terms of whether they'd like to use those services or not. As a result, there are a number of scheme fees, and unfortunately I can't give you an absolute number, but of course would be very happy to share with the committee the detail around every scheme fee to make sure that there is then the next part of your question is transparency. So every single Visa client signed up with us gets access to the full list of scheme fees, what they are, and they get monthly reporting at a minimum of all the scheme fees, how much they paid and what they paid for.
So to be clear, you're not able to tell me how many scheme fees Visa Australia maintains at this point in time?
I would prefer to take that on notice to give you an exact number, but I acknowledge it's a large number.
Okay. Does Visa sort of take an approach that if it's bringing in a new scheme fee, it gets rid of others? How often do you review and remove scheme fees?
We do regularly review our scheme fee schedule. You asked an earlier question I'd love to address, the point around engagement with our customer base and making sure they're aware of any changes to scheme fees as well as the introduction of new ones. We're very cognizant of the fact that these become additional costs for our clients. It's important we give them both the time and the visibility of what those scheme fees are for. So we're very cognizant of doing that in as transparent a way as we can to make sure they understand any changes from our network.
Right. I just want to read out some quotes around transparency. These are quotes in submissions that we've received. Recommendations of organisations representing small businesses on fee transparency. A comparison tool should be available to help merchants choose the best plan to lower their costs and close the gap between fees paid by large merchants compared to SMEs. That's the Independent Payments Forum. We require stronger transparency of scheme fees and fee schedules, including standardised reporting and meaningful segmentation by card type, scheme, payment channel. That's from the Australian Restaurant and Cafe Association. COSBOA say added transparency will make it easier for small to medium-sized businesses to compare offerings and costs in the market. The ability to compare and have a competitive market is key in providing businesses oversight over recurring costs. That's COSBOA. So given it clearly matters to businesses to understand more than the full cost they ultimately pay, does Visa support greater transparency around merchant service fee segments, including scheme fees?
Mr. Chair, we support the transparency around merchant service fees, absolutely. That is the cost that merchants are ultimately paying. Our clients are the acquiring banks and, of course, the issuing banks on the other side of the ecosystem, with whom we're giving complete transparency. So you've referenced a number of organisations there that are accessing the Visa network through their acquiring relationships. And fundamentally, the cost that they're paying, the price that they're paying, and competing on a number of different factors. There's the software that may be embedded. There may be simplified pricing. There's all sorts of other things within that. It's fundamentally borne by the merchant service fee that they choose to pay in buying that service from that client. So the Visa scheme fees themselves are charged to the acquiring banks. And as I said, we give complete transparency of all those fees. We give an update of how much they pay in those different fees, as well as any changes on those. We always give as much notice as possible, as well as give complete transparency for the value in those fees.
My final question before I hand over, I don't know if Mr. Violi, yep, he's online. Before I hand over to him is, but why would organisations, I read those quotes out, why would they raise those quotes if they were happy with the level of transparency they're getting out of Visa? Sorry to make it so pointed, but I got it.
And of course, hard for me to comment because Visa does not directly engage with those organisations you've referenced. We do obviously with the umbrella bodies, but not with those direct organisations.
I think it's good feedback though.
Absolutely taken on board. The organisations we're engaging with are the acquiring organisations. These are, for the most part, not exclusively, but for the most part, large organisations here in Australia. These are B2B relationships. We often refer to them as the wholesale relationships that we engage with them on a broad basis. And we're giving them complete transparency of the way, what we're charging and what we're planning to charge. You've referenced, if I might go, you've referenced small businesses, because I think there is an opportunity for us to look particularly carefully at the fees that small businesses are paying. And I think that has been a factor that's evolved in the Australian payments landscape with all the changes made over the last 20 or 30 years. We certainly think there is an opportunity, though, to address the fees and the total costs in the system for small businesses. Visa's introduced a relatively new small business program. We introduced it about a year ago. About 1 in 5 small businesses in Australia now have access to that program through their acquirer. And through that, they get a reduction in their fees of over 70%. And the interchange they pay through that program. We'd expect that to be available to more than 50% of small businesses, again, through their acquirers through the rest of this year.
Okay, thank you. Mr. Violi, then Mr. Laxale.
Thank you, Chair. I'll jump straight into that point. I just want to understand, so Visa's not dealing with big business, small business directly. Never, you've got this program now, because what we hear a lot, and I hear a lot, is that large organisations, Woolworths, Coles, etc., relative to an IGA or a cafe, are getting better rates given their volume. So who's driving that? Is that Visa driven? Are you offering the banks a better rate to pass through to a larger customer, or is that driven by the banks?
There are a number of moving parts in that, Mr. Violi. So I'll start with the small businesses interact with us through their acquiring bank relationship. For the very largest merchants here in Australia, and you've mentioned a few names there that would absolutely be correct. The very biggest, we do have a direct relationship with those merchants, and that there is best described by capturing the role that we play and the role they play in driving innovation and change in the payments ecosystem. So, for example, if we go back 15 years, contactless payments, Australia is worldwide recognised as being the leader in the adoption of contactless payments. When that was happening, we had all of the banks issuing contactless payments cards and thinking about, should we be making that investment? At the same time, they were waiting for the merchant community and the acquiring community to invest in the infrastructure, particularly think terminals, to be able to accept contactless payments cards. One of the roles Visa plays is to help manage the economics in that system to bring those parties together to make that investment in that decision. In the Australia context, one of the lessons we absolutely learned from that and applied, and frankly have been shared globally, is the ability to be able to deal with the biggest merchants in Australia and give them an opportunity to invest was something that helped accelerate that change here in Australia. So we do have relationships with some of those biggest merchants. As a result, we'd have some bespoke arrangements with them. Their acquiring activity, for the most part, would still go through an acquiring bank, but we may negotiate a B2B rate with them to encourage them to keep investing in the payment system.
So then based on that, would it be fair to say that a large organisation that's dealing directly with Visa would have a competitive advantage when it comes to the price they pay relative to a small business that is going through a bank directly, without the ability to go directly to Visa?
Look, I'd want you to start with the fundamental proposition of Visa, which is its access to hundreds of millions of consumers in over 200 markets. A small business that opens up tomorrow gets access to that full customer base.
And I understand that, sir. I'm just trying to get to it from a cost perspective. And the reason, to be clear, the reason I want to get to the cost perspective is we've heard from the RBA that if we ban surcharging in isolation without taking cost out of the system, all we're going to see is that cost passed on to primarily small business, then to the consumer. So what I'm trying to understand is there a competitive advantage for big businesses? So if we ban as a country surcharging in isolation, the big businesses have a greater ability to absorb that cost, and it will disproportionately impact small businesses. Is that statement correct, given your relationship with larger businesses directly relative to small businesses?
I wouldn't necessarily characterise it that way, given some of the different costs and investments and opportunities across the board. So surcharging, for example, and this is on the RBA figures, is only done by up to 10% of merchants. So the flow-through impacts are uneven. We do, however, agree and recognise there's an opportunity to invest in providing lower costs to small businesses. We think it's important that, particularly as they're starting up and they're small, they're able to take advantage of lower payment costs as they enter the system. But to the broader scope of your question, there are a number of costs and specific items that larger businesses do. There's middle-sized businesses that are looking for particular aspects. When I look at smaller businesses, we often see, for example, their payment costs may be higher because of the relationship they will have with an individual acquirer that's giving them access to fantastic software. They're paying for that. It looks much more expensive, but they're fundamentally getting a fantastic capability that's helping them grow their business. So it's difficult to isolate a single aspect. On the surcharging piece, though, I'd want to go back to it. Only 10% of businesses in Australia are surcharging. And as a result, I think we need to be careful in assessing the total impact, both on the ban on surcharging and has been suggested interchange, for example, reductions are not evenly applied across that system when only 10% of merchants are surcharging.
I think you'd find of that 10%, the vast majority, if not all, are smaller businesses because they need to recoup that cost, as we've discussed. Larger businesses don't need to, which is one of the concerns I have about a blanket ban without understanding supporting small business and pulling cost out of the system. We're actually punishing family businesses that are just trying to survive in a tough economic environment. So I just want to move to another issue. Do you use global deals to local out any local players on payments?
We do have a number of global relationships where we might, on a global basis, align with a global organisation on, for example, global investments or global agreements to issue certain products. I don't know if that answers your question.
So, yeah, I guess, do you do global deals that apply in Australia?
Yes, we do.
And so if that wasn't in place, could merchants get a better price with a domestic provider?
We look very carefully to make sure we're consistently trying to give the best possible deal to every single one of our clients. You'd expect me to say Visa competes for every transaction. It's really important to us that when we're looking on either the issuing side, which is the issuing of Visa credentials, or on the acquiring side, merchants have a chance to choose where they want to send that transaction. You're talking about global deals with large global organisations. They have a lot of choice. Similarly, local organisations have a lot of choice. So it's not to the benefit to us here in Visa Australia or Visa globally to do things that disadvantage a local competitor here in Australia.
No problem. So, and last question, to give Mr. Laxale some time, I'll leave market share to him. But given the conversation we've had around the importance of bringing cost out of the system and not disproportionately impacting small business, from a Visa perspective, is there a low-hanging fruit or a real opportunity this committee can look at that can take cost out of the system and ensure that small business and consumers are being looked after as we review the system?
Thank you. Yes, there are two places I would suggest where there's opportunities. The first, I think I've described that small business program that we've introduced here in Australia. We have similarly introduced a program in Canada in partnership with the whole ecosystem and the Reserve Bank of Canada, who manages the payment system there. That there has resulted in an industry-wide alignment on lowering costs for small businesses. And as part of that, there's an insurance that it goes to those small businesses. We think that could be a very effective mechanism here in Australia. I think a number of others have suggested similarly, and we have suggested the same to the Reserve Bank. We think that could be quite powerful. The other component, certainly from a visa lens, is we think the encouragement of competition is very important. We think Australia's payments environment is very, very competitive. We've seen a large number of new entrants come into the payment system. They're encouraging more innovation and competition in the system. The challenge today is there isn't an even or level regulatory playing field. So particularly when we have a look at the three-party systems versus the four-party systems, that system has been growing faster in recent years than the four-party system. Those costs are higher. We certainly believe that is one of the things that could be done, is if we even that out, we think that overall costs in the system would reduce while maintaining competition.
Thank you.
John.
Thanks, Chair, and thanks, Aaron, for the pass. You mentioned choice a lot in your evidence so far, yet clearly Visa and MasterCard are the two dominant card schemes. Numbers were between 85 and 90% of all transactions go through either of you two. Do you think that's good for competition in our economy?
Mr. Laxalt, what I would say, go and you look online at the point of checkout. The previous panel spoke a lot about account-to-account payments. We're seeing a lot of new entrants come into the system that are offering different experiences.
Could you just go back to my question? Do you think that's good for our economy that there are two major multinational corporations that dominate the payment system?
Mr. Laxalt, I think, and I have a look at the investment certainly Visa is making in the Australian payment system, the investments the opportunities we offer Australian consumers and merchants. We compete for every single transaction. I referenced it earlier. I think that the competitive environment is such that we're having to do that. And I think we're seeing a system where there are a lot of new entrants coming in and competing for that. So my assessment of competition is that it's very vibrant.
But how... What you've said there doesn't sort of align with the facts here, right? You've got small businesses that, in their evidence, and I'm sure we'll hear it tomorrow, say they can't avoid your network, right? You've had the banks here before say that they can't avoid your network and the digital wallets. The evidence shows that you're at sort of 90%. Like how is that dominance helping drive down costs? Or is it helping drive down costs?
Well, when we look at the total costs in the Australian payment system, I speak about that competition a lot because it's what we're facing all the time. We're seeing a lot of competitive pressures on that basis. I also think that Australians benefit from the global capabilities and scale that we're offering as part of our network. So I can only talk to the fact that it's important to keep supporting and driving that competition. We think the RBA as a regulator and as a leading regulator across the world, they've been operating in this space for a long time, have done a good job of encouraging that competition. And we see that competition growing or shrinking. So our assessment of the situation is that we've got a very vibrant, competitive, efficient, from a total cost perspective. I'll reference some of the other submissions that came through. Australia's total cost of payments is relatively low by world standards. Our assessment would be is that the system is working well to deliver both efficiency and opportunities for competition. I'd also want to emphasise we need to be very careful about focusing too closely only on the costs. I think the investment required in the system over the coming years is going to be large. I've spoken about what Visa's done over the last 5 years, but when we look into the next 5 years, you'll excuse me, I'll take something quite technical, but I think it's instructive. Advanced encryption standards as we move into quantum computing. Today, we're all on a standardised encryption baseline. Australia is a world leader, for example, through AusPayNet in running a project to get us all up to a new encryption standard that's going to protect us for when quantum computing becomes mainstream. The investment required, certainly from Visa, the big banks, the acquirers, the issuers, and of course those merchants, the terminals, is substantial.
You mentioned competitive pressures in costs, yet the RBA have shown that scheme fees have risen 11% over the last year. How do you justify that?
$2 billion.
$2 billion, up 11%.
The makeup of scheme fees is, of course, made up of the different parts, the issuing and acquiring side. And, of course, it's made up by the type of transactions that are coming through, as well as the number of transactions. A good example of something that's driven the cost side of that, if you like, the higher piece, is we've seen inbound tourism into Australia. We were at sort of 3.5 million in 2022-23. We're at over 10 million in 2025. That is a major driver, for example, in Visa's numbers. I, of course, can't talk for others, in terms of driving those costs. Similarly, international transactions. Australians are now travelling internationally much more. The cost of an international transaction is very different to the cost of a local transaction. And particularly the risk of an international transaction. We see fraud rates, we see the complexity of both approving that transaction, navigating the fraud risk around that, and then settling that transaction is quite different. So you asked about that growth in cost. One of the key drivers, certainly for Visa's numbers, and I won't talk for others, is the mix of transactions have changed quite substantially.
So are you saying that your costs to the issuers for domestic payments has not risen? Is that what you're saying?
No, I'm not saying that.
So they have risen.
What I'm saying is the mix of payments has changed quite substantially. Your
costs to domestic issuers, have they risen over the past?
They have risen,
okay,
but perhaps a point I'd make is the number that was referenced, that you've referenced from the RBA. The largest bulk of that is driven by the mix of transactions we've seen rather than the individual cost.
Over the past 25 years, since the last RBA reforms, interchange fees have almost halved, but scheme fees have gone the opposite way. The only data I could find using RBA data was the last time they looked at this, and there was a six-fold increase in scheme fees between 2006 and 2013 at the same time that interchange kept on going down. How are costs going to be addressed? What if, to what Mr. Violi was saying, how are costs going to be addressed if your scheme fees continue to play a dominant role in the cost base? An increasing role in the cost base.
If I might, Mr. Laxon, and again, referencing others' submissions in this space, scheme fees make up roughly 10% of the total cost of a transaction for merchants, and it would be a relatively smaller number, I think, on the issuing side. So the competitive nature of the business we're in, if we're wanting to win that next transaction, if we're trying to convince all of those different organisations to issue Visa cards, and they of course have alternatives, we're going to consistently be under challenge by all of our clients to consistently be challenging those fees. Similarly, we're living in a time where we're seeing a lot of change in this payment system and a lot of international, I'm not going to say the competition side, unfortunately fraudsters and scam artists, we've seen that as a major challenge for us here in Australia. We've invested enormously to try and combat that. We're going to have to keep investing substantially to keep combating that. So one of the, for example, the areas where Visa's invested very heavily is in that fraud. So when we look at those 83,000 transactions a second, we're looking at every transaction around the world to go and have a look, where is there a risk of that not being a genuine transaction, so we can stop it at the network level. The investment that gets made in that and the other services we're able to offer to our clients to choose whether or not they'd like to process that transaction is going to keep growing. But again, we're going to compete with the whole market for whether they want to choose both our product, our scheme, as well as the services we offer to them.
Sure, but banks take the risk for fraud as well, and their fees are being pretty heavily regulated and have gone down. I'm just trying to understand, like you've said, the market's really competitive, yet you and one other company have almost 90%. You've said you put downward pressure, your got competitive pressure on price, yet your prices have gone up. Like, respectfully, it's kind of a bit like, at the end of the day, consumers are still paying more when they tap and go than the non-digital alternative. I'm trying to reconcile your evidence with the facts, and I can't. I can't. Why should, my final question, why should consumers pay more to use your product, which is what's happening, than using cash? Like, why?
Mr. Laxale, I'll reference again evidence that I think's been given to this committee and submissions that referenced, in fact, a digital payment, particularly debit on the four-party schemes, is the cheapest form of payment for the ecosystem. So the cost of cash,
but it's not the cheapest form of payment to the consumer.
That's right.
Well, if we have,
and you're part of that.
We have, of course, regulated, and the history that there has been in Australia of the way we've positioned the payment cards and surcharging payments cards for a consumer versus the cost of cash, which does get absorbed today by the merchant. Now, I don't want this to turn into an attack on cash. Visa believes there's an important role for cash in the economy. So it certainly isn't that.
No, it's not an attack.
I do want to challenge the view, though, that this is more expensive. It is more expensive for the consumer, because one of the changes we've made in Australia is we decided to allow surcharging. Australia was one of the first markets in the world to do that. If we go look at the UK and the EU, they introduced surcharging, in fact, after Australia, and then they subsequently banned it as a result of our assessment. I don't want to speak for UK and EU regulators, which of course our RBA does connect with. They made that decision, we believe, because it did send the wrong signal. So today, a payment made on the Visa network is likely to be cheaper than any other payment source. I take your point, for a consumer it isn't, because they could use cash, but that is a choice that we've made in the way we've regulated our system, and why we believe that surcharging should be removed, as not all but almost all other jurisdictions have done, including the UK, EU and New Zealand only last year announced it.
Yeah, okay. I've got 4 members who want to ask questions, and we probably need to wrap this up at about 11:20. So I'm going to hand over to Ms Situ and then go over to Ms Campbell.
Thanks, Chair. As you had indicated, debit transaction costs are cheaper than credit transaction costs, and the RBA has said that a way for really capturing that is to go down the road of getting as many merchants to use least cost routing as possible. I just wanted to get your Visa's view on the rollout of least cost routing as a default.
We certainly, we heard the RBA's testimony this morning, and we'd certainly agree with them that for the benefit of the ecosystem, we've successfully here in Australia made least cost routing or merchant choice routing available to the vast bulk of merchants here in Australia. And it has been an effective mechanism of just that providing more competition. We compete very vigorously in that market for every transaction that could go either way, and has been an effective mechanism. I'd agree with what the RBA referenced this morning, is it is a trade-off. Is the moment we mandate a mechanism, then there are costs that need to be borne, particularly by some smaller providers of services, and there's also likely to be unintended consequences. Again, we reference cost as the main driver in thinking about what we could do. I don't want to lose the opportunity for merchants and, of course, acquirers to choose different ways of looking at transactions from a perspective of fraud and security, reliability, and some of the innovation that's going to be available for us here in Australia. So I've referenced stablecoins, agentic commerce, AI being much more involved, for example, in transactions on in the Australian payment system. If we mandate the way a payment flows, that non-standardisation in the system may mean that some of the other changes happening globally will not be available for us here in Australia. As a result, where we've landed with merchant choice routing, it's available to almost everyone today in the system. It's been an effective means of driving competition. But what we're seeing today in the system is that people are choosing other providers on items other than pure cost. And I think for the benefits of both innovation, value, that remains a positive way to approach it.
Thank you. I'll let others go, Chair.
Thank you very much for that.
Thank you, Chair. What would the average fee be for a big company versus the average fee be for a small business?
I don't want to speak out of turn in terms of committing to an absolute number, but the cost for a small business versus for a big business, are you asking at a total level or for an individual transaction?
So if you were, let's go back to coffee selling. If I'm selling coffee at a, McDonald's, or if I'm selling coffee at, a small business down the road, what's the difference going to be in terms of that cost to that business?
So the components that make up that cost, if we were perhaps to go to interchange, scheme fees, and the merchant's margin are the pieces that are within that. And I think I'm referencing everyone's coffee cup. They've got those three breakups of the different components. The biggest changeable part of that is probably the merchant service fee and the acquirer margin and the way they're processing the transaction. The next biggest component of that would be interchange.
And so what's the difference in cost?
I think in the 8 cents example, the merchant service fee for a large business would be, and again, this would not be Visa's costs. I mean, I'd encourage you to ask acquirers, and I think there's opportunity for that. I think it's been suggested about 5.5 cents on average, but it would have a material range. So McDonald's would probably have a lower cost because of the volume they do versus a small business would have a higher cost. I'm sorry, I couldn't tell you the difference because we wouldn't see those costs as Visa. That would be acquirers. The next component is interchange, where you asked about a very large store like McDonald's versus a small coffee shop. The difference there might be kind of the 1 to 2 cents range for McDonald's versus the small one on the scheme fee component, which is why we thought it made sense to introduce the small business proposition for those small businesses to access similar style rates.
Understand. I was going to ask, while we're on the small business program that you're running, there's who isn't able to access that yet? Like, who is able to access and who isn't, and why?
Small businesses are able to access that through their acquirers. We offer that program to all acquirers, but not all acquirers have taken up using that with Visa yet. It's something that they would need to work with us on, but it is currently offered to all acquirers in the Australian market.
Why haven't they taken it up?
It's technology change, it's commercial dealings between ourselves in terms of choosing to partner with Visa on this, as opposed to partnering perhaps in other ways.
Which acquirers haven't taken it up?
I'm sorry, that would be commercial and confidence information. Wouldn't be appropriate for me to share more broadly at this stage.
And so in this live example, you said that it was a reduction of 70% fee reduction for small businesses. So understanding that that's commercial and confidence, how will the small businesses whose acquirers have not taken it up, how would they possibly know that they could have a 70% reduction in their fees?
Two components to it. The first I want to say is we're passing on that 70% reduction to the acquirer. It's up to the acquirer to pass that on.
There's no guarantee they'd get the saving.
We cannot guarantee that because, of course, we don't contract with the small businesses. We contract with the acquirers within the market who offer a range of different plans for those small businesses. We have publicised this, but I think that the best mechanism for this is competition amongst acquirers.
So what do you think competition is? What do you think a competitive market looks like?
I think a competitive market in acquiring shows a number of different places in which providers could compete for an individual set of transactions, which could include, of course, cost matters, but I spoke about reliability and security. Software is something that's been spoken about a lot, that is highly valued by the market. The ease of integrating into other infrastructure for that business. I think competition is giving merchants the opportunity to choose who they'd like to partner with, and there'll be some out there who offer low frills, low cost, and others who offer difference. I think that's competition.
But the challenge for that in terms of the small business lens is a small business can't tell whether their acquirer is giving them this 70% off. The small business can't guarantee whether their acquirer is passing through the 70%, and that means that they become price takers in that process. So I guess my final question was going to be this. Given that we've heard the banks talking about the fact that they sort of, I think, tried to go to Apple Wallet as a collective, would Visa be open to any process or any, idea that small businesses could collectively work to negotiate?
Ms Campbell, we would, and additionally I think I referenced our Canada program, which is a live example. It's exactly what we've tried to enable that we think would be an effective way of addressing this problem here in Australia.
Thank you.
Okay, Mr Gregg and then Ms Jarrett.
Thank you, Chair. Despite a lot of your direct customers being the acquirers loving a bit of fine print themselves, I note that their submissions talk about the difficulty in remaining across the fee schemes. They refer to them as opaque. They say there's routine changes without the ability to opt out, that the acquiring fee, its connection with particular service offerings is unclear. They apply uniformly regardless of usage and things like that. So if these are as transparent as you say, why are so many stakeholders saying that scheme fees are not so?
Mr Gregg, you'd of course have to ask them, and I understand.
Do you think you're being bullied?
Their perspective. I won't take a view one way or the other. We engage with every single one of our clients when we set fees, when we pass fees, when we change fees, when there's the opportunity to engage with us, of course, at any time about those fees.
So when you say engage, do you mean negotiate those fees?
Well, what I was referencing in that is obviously to understand them, if there's any questions about them and the way they're charged. I want to go back to the way Visa looks at that fee set and the way we manage those fees. We look at it on the basis of all the different things we're doing with those different organisations here in the payment system. Those fees go to fund all of those different things that enable access for people from over 200 countries and regions around the world to come and be able to shop at the smallest merchant here in Australia. The fraud, the security, the other services that those, whether that be a merchant or an acquirer or an issuer wants to take advantage of, those are all within the mix of those different scheme fees.
So would it then be fair to say there isn't scope for them to negotiate those fees? They are what they are?
Sorry, that was not what I was suggesting, is of course we negotiate those fees. These are all business-to-business relationships and we do negotiate our fees with our clients, yes.
Because that's what I found strange, that in business-to-business normally you wouldn't have sudden changes without negotiation by one party and things like that. Now I know that big businesses aren't subject to unfair contracting rules, but it would seem that some of these elements basically give you a lot of power to kind of change the rules of the game to reinforce a global network and all these wonderful things that might not be valuable to the acquirers in question, yet they're having to pay for them. So is that just a result of lack of competition that you can kind of do take it or leave it, because at the end of the day they need to have Visa or MasterCard, otherwise they're not competitive?
And Mr Gregg, you actually hit a good point right at the end there around they choose between us and other providers, and we're seeing much more competition come into this market. So I certainly wouldn't say that we do, and we certainly don't experience a system where we can just unilaterally make changes. One of the challenges we do have as a global network is we do need to maintain consistency and standards across that whole network. So there will be times where we will make a change that applies globally to make sure accepted standards can apply everywhere that individual parts of the network may not initially see benefit on, but over time will see that benefit. That's part of the role that we play.
Noting that you can't go into the minds of your customer, but I wonder, I'm just going to read a quote from one of the public submissions, if I could. The proliferation of acquiring scheme fees has become a material source of inefficiency across the payments ecosystem. A particular concern is that new acquiring scheme fee categories are routinely introduced without participants having the ability to opt out, even where the acquiring fee relates to services that may not be relevant to all usage cases. Is there any legitimate point made in that paragraph?
To what you said, I can't go into what their minds were within that. We certainly
sure, but the facts they've stated can be disputed or accepted.
We offer a range of different services. The fees we charge for accessing the network and then for using the network are charged on a as-used basis. I, of course, don't know which circumstance is being referred to in that one, but we would suggest that we would engage very closely with every single one of our clients if they had a question about why am I charged a fee for something I'm not used, and we would engage.
I think it's more if they don't want to be charged for something they're not using.
Well, we also, and I'd go back to the purpose of trying to run a network that is standardised across billions of credentials, hundreds of millions of merchants. There are sometimes changes that we will make into the system that an individual merchant or acquirer or issuer may not value at that point in time, but that we will need to make the assessment, given it's a standardised network, to make that available across the network.
Okay, that's all I had.
Thanks, Ms. Jarrett.
Thank you, Chair. I just want to go back to fees and charges again. Unfortunately, it's been a very hot topic today. You said that one of the ways to bring down or to help lower the fees was to encourage competition, and a way to do that was to even the playing field, I'm assuming between the 3 versus the 4 system process. So what's the inequity there?
So particularly between the 3 and the 4 party system, the interchange fee, which is the payment from the acquiring bank to the issuing bank, is the one that has been regulated by the Reserve Bank here for the 4 party schemes. In the 3 party scheme, there isn't an equivalent, exactly the same fee, but that component of value has not been regulated by the RBA. I think under the legislation passed by the House late last year, there's the ability for the RBA to investigate that, which we think would be very valuable, but that operates at roughly 50% higher than the interchange rate that flowed through the 4 party systems. The other parts of that system, though, which are not regulated, where there's an opportunity, are the buy now, pay laters, the digital wallets, the things that have largely been picked up through the PSRA, some of the new competition coming into the system, that we think that there is an unlevel playing field in the fees that they would charge in the mechanisms they can operate. And we think by levelling the playing field will be the most efficient way to drive lower costs if competition was a level playing field.
So exactly how would that work, though, to lower the costs? I'm looking at the direct, like Dummy's Guide, direct translation.
For example, if we were to have a look at a 3-party transaction versus a 4-party transaction happening. Consumers got the card, they go and pay at the coffee shop. Today, the interchange, which is the biggest component of cost that we've been discussing, is regulated for the 4-party schemes. The Reserve Bank, we believe, could find a way to regulate that number down for the 3-party schemes. Similarly, on things like buy now, pay laters, they have fees that are much, much higher in terms of offering a price point to merchants compared to what it is for the regulated 4-party schemes.
Okay,
we think that would be a mechanism of reducing costs.
Okay, thank you. I also wanted to, we heard this morning from a number of different groups that there are many players in the payment system who are not contributing to the ecosystems that's needed to keep that payment system safe. Would you agree with that? And if so, who would they be?
It's a complicated question given the number of different participants within that payment system. So if I have a look at the way we try and grow and build on our network, we are trying to operate a unified standard network that has 83,000 transactions go through the second. We've got to look at 500 different data points in each transaction. That investment, for example, is done at a centralised point as opposed to locally, although there are components of investment locally, which I spoke about advanced encryption, for example, which needs to be invested.
So you're talking centralised in the global Visa
Correct,
network,
a global
correct?
centralised model. I think the trade-off for us to understand is which are the appropriate parts to be covered by participants locally versus elsewhere. And it's probably more than anything a call for policymakers and a reason why this is a valuable thing to be looked at by this committee at this stage to assess that.
And you don't have to name the names, but like the stakeholders, the local stakeholders that should be participating and who aren't?
I certainly would not be looking to name any names. No, our assessment would be we see a lot of investment go into the system here in Australia. Our biggest concern is if we change the settings or change the settings too aggressively, there'll be insufficient opportunity to invest in what the future of payments is going to be looking like. And certainly our experience to date and what we're seeing play through competitive environment, we think the value that's in the payment system today is effective, but a few others have referenced as well, the more we do things like lower interchange or change the system too dramatically, we risk taking value out of the system, and then there is the risk of systemic underinvestment.
Yeah, and therefore, just following on, if there are groups that aren't contributing, is the system set up to enable that contribution with small changes, or is this a bigger change that needs a lot more consultation?
Again, I'm sorry, I can't comment for that broader part in terms of the different components of investment. I do think it's valuable for this committee to be looking at more broadly to test it. I think the RBA has done a very good job over the many years to try and understand the different components of the system. And with the passing of the PSRA, we now give them the opportunity to go and understand those costs in very complex environment. I think that's been referenced a few times today. The RBA has been an effective regulator in understanding where costs are, where value is created, and ensuring that the system operates effectively. I think the value of the PSRA process is going to help surface that and help inform better for us as Australians where that balance lies.
Thank you. Further questions on notice, Chair?
Yeah, well, I think there will be a lot of questions on notice, and one of them would be, I understand in response to Ms Campbell, you said you can't name the acquirers that aren't participating, but you could name the acquirers that are, and it'd be interesting to know if Visa would structure its offering in a way that would require the acquirer to pass on the saving, is a question on notice I wouldn't mind. You don't have to answer that now, but there'll be a stack of questions on notice that'll come your way. I just want to say thank you for turning up personally. I know it's been a robust discussion, but that's the best way to sort of get to the bottom of things. So thank you for making that effort. It does mean a great deal for us. The Committee Secretariat will be in contact with you in relation to any matters arising out of today's hearings and also passing on questions on notice. You'll be sent a copy of the transcript of your evidence, and you'll have an opportunity to request corrections to transcription errors. So thank you again for your attendance.
Thank you, Mr Chair, and thank you to the committee.
Thank you. Terrific. We can now seamlessly move to the next witness, which is MasterCard. I understand there are two people present from MasterCard, and I welcome them to give evidence. For the Hansard record, please state your full names and the capacity in which both of you appear before the committee, please.
Mute.
President for MasterCard.
Sorry, could you repeat it? You were just on mute. If you could repeat that.
No problem, Chair. Can you hear me now?
Yes.
Fantastic. So, hello and thank you for the opportunity. My name's Richard Wormald. I'm the President for MasterCard across Asia Pacific, based in Singapore. I felt it was important that I attend in person because prior to January this year, I was accountable for the Australia-New Zealand business for the prior 8 years. And I bring with me Paul Monington, who has now replaced me in that role.
Okay.
My name is Paul Monington, Division President for Australasia.
Terrific, thank you. Before we proceed, I just want to advise you that although the committee does not require you to give evidence under oath, the hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as a contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. Given your circumstances, in terms of appearance, I understand you are appearing from outside Australia and that the Secretariat has provided you with information that this limits the protection offered to you under parliamentary privilege, as this protection cannot be enforced outside Australia. With that warm introduction, I now invite you to make an opening statement before we proceed to questions, and what I'll do is I'll go to Ms Jarrett, then Mr Violi after I ask questions. So over to you if you want to provide a brief opening statement.
Thank you, Chair, and I will be brief. To begin with, I want to set out how MasterCard's role in the payment system operates. We provide the infrastructure that allows money to move securely through the economy in Australia and around the world. Our network is built on a simple promise to consumers and businesses. Wherever you are in the world and however you choose to pay, your MasterCard will work seamlessly and securely. And if something goes wrong, you will be protected and get your money back. We do not lend money. We don't set interest rates or issue credit cards. Those responsibilities sit with consumers' banks. We do not set the price that small business pays to accept payments or provide port of sale terminals. Those responsibilities sit with the merchant bank or payment service provider. Now, before turning to the detail, it's important to recognise the level of change that the payment system is undergoing at the moment. And whilst the value and volume of digital payments have increased significantly, the cost has also fallen at the same time. Independent research by Boston Consulting Group shows Australia has amongst the lowest card acceptance costs in the world, and that cards are the cheapest way for retailers to get paid. These costs are already lower than in the UK, the US, and in the EU. And based on BCG's analysis, MasterCard's fees account for only 7% of the total cost of acceptance. Now, this inquiry comes at a critical time for Australia's payment system. While the regulatory framework is evolving through Treasury's work and the RBA's role, this committee has an opportunity to recalibrate the focus of that work. As you hear from participants over the next days, we'd encourage the committee to consider the following recommendations. Firstly, Australia has a problem with surcharging. Surcharging was originally introduced in 2002 to signal the cost of payments to consumers. However, while the cost of payments has decreased since then, new payment service providers have pioneered what we would call the free FPOS model. And it works like this. Sign up to my premium plan with added features. It will cost you nothing because you pass on all the cost to consumers as a surcharge. This model is uniquely Australian and often costs 40 to 50% more than the basic plans offered by all of the major banks. This is why we would say the Treasurer was right to ban surcharging, and we'd urge this committee to support the recommendation and push for a full ban. The second is the need to take a whole-of-system view. Last year, the RBA commenced its review into surcharging and acceptance costs. Their proposed action plan was widely criticised across industry, and hence the RBA has extended its time for this review. Part of the problem, we'd argue, is that the RBA mandate has been too narrowly focused on merchant cost of acceptance. And we believe that payment regulation should take a whole-of-system view with the consumer at the centre. The end of the day is consumers that pay the surcharges. They pay the prices if cost of goods rise. They pay the higher interest rates on credit cards if interchange is cut. And they pay the annual fees on debit and credit cards. They're also impacted if they can't access credit when they need it the most. So we would encourage the committee to consider a best interest test in the RBA mandate to ensure that future regulation puts consumers first. And finally, much has been said about the cost to small business for payments. Now, in 2022, MasterCard introduced a small business program in Australia that provides lower interchange rates comparable to those of big business and reduced scheme fees as well. And whilst a number of acquirers have adopted the program, we cannot force those partners to pass on the savings to small business. In Canada, the central bank coordinated the introduction of a consistent set of programs across the networks, and transparency measures helped ensure the savings were passed on. We'd encourage the committee to recommend a similar approach in Australia, as others have mentioned, and thank you. We look forward to your questions.
Thank you. I've sort of had an interest in these issues over the years, but never had the opportunity to delve in such a detailed way as I have been afforded this opportunity through this inquiry. And it just seems like for ordinary consumers, they are forced to sit inside a bar while a mighty fight is going on between all these different big players, in which there might be differences of advantage that swing from banks to card providers to acquirers to merchants, but it's always going to be the consumer that cops the wayward bottle in the head. They don't really get much benefit. They're increasingly discouraged from using cash. Sorry to stand on my soapbox with the words populism on the front of it, but the reality is the lived experience of a lot of consumers is they're discouraged from using cash. They then have to go and use a card. If they're using a credit card, there's a whole set of conditions or fees attached to it. And there's a lack of, this whole complexity that is baked into the system makes it hard for things to be transparent And despite the talk of competition in the payment space, in Australia, the scheme fees have gone up by $2 billion and grow at a rate of 11%. That doesn't suggest to me any sense of competition at all. So while it's great to hear you say consumers should be put in the heart of it, of this, I don't know whether or not they're actually going to see any benefit that comes out of any reform. And the other thing I'd point out is it's interesting to see across a variety of jurisdictions now, governments are actively, UK, EU, Canada, even the US, are now looking at trying to inject something better into the system. It seems to me, this is a long way of saying, this system is really messed up, the consumer loses out, and the only advantage comes if you can get some sort of benefit shift from one player to the other with ultimately no benefit to the average person in the street. Now, if you think I'm completely wrong, I'm happy for you to tell me where I'm wrong, but it does seem increasingly, based on the evidence, that that's where things are headed. You tell me if I'm wrong. I'm happy for you to.
Sure. Thank you, Chair. There's two things I'd say. Well, first of all, if you benchmark the Australian payment system to others around the world, BCG have done some good analysis on this last year across a range of markets. What you see is that the Australian payment system is highly efficient. The costs are actually already amongst the lowest in the world and have driven significant productivity improvement across the Australian economy over the last decade and more. Contactless payments are now 98% of in-store transactions. That, as I think we were talking earlier, has saved retailers millions and millions of dollars in productivity improvement. So the system is efficient already, but we do agree that consumers should be at the centre of that. And I think the debate has become skewed by a focus just on merchant acceptance without due regard to the implications on consumers. And if you look at other markets around the world, the UK is one example. They proceeded down a path of cutting credit interchange to the levels that the RBA is proposing here. What happened in the following years was credit card interest rates went from 15 to 20% to now 36%. And so that's why we'd argue you have to look at a whole ecosystem view to ensure you don't have unintended consequences on consumers overall.
Can I just ask how many scheme fees you operate in Australia?
Yes, we have that in detail, actually. I'll hand to Paul, who has that detail now.
Just in terms of the number of scheme fees that we billed in 2025, that was 122.
Mm-hmm.
The top 15 was actually 75% of those fees. Now, those fees are there in terms of us to continue innovation and any new services such as agentic, etc., and also just maintaining the integrity of the system. In terms of us, we actually discuss that with and actually send bulletins out to our acquirers. So it's our acquirers who we wholesale those fees to. And those acquirers then actually understand those fees. They have a system called Mastercard Connect they can go into. They can look at the detail and actually see the bulletins and see all of those details. And we discuss those in a lot of detail with each of the acquirers.
Yeah, I'd add that the way that we think about our pricing structure, and yes, it's true, there are a large number, it was 122 in Australia last year, is because we try and ensure that participants only pay for the services they use on the network. And I'll give you an example. So we have a service called stand-in. So when a major bank, either on the customer or the merchant side, fails, the systems go down. Traditionally, that would have meant the retailer couldn't process payments, the consumer couldn't make payments. But we've developed a service using AI that when a bank goes down, automatically kicks in and mimics the response of the bank. So the retailer can keep trading, so the consumer can still spend. Now, we only charge for that when it's used. That adds complexity. That can't be forecast because it's unknown when a platform will fail. But in doing so, it's more efficient because those partners that invest in resilience and have more reliable platforms, they don't pay those fees. whilst those that have less reliable platforms and rely on the network do pay for it. So there's good reason why there's that complexity that's built up over time. However, we recognise and we hear the feedback that we need to do more to support our acquirers. They are the party that contracts with the merchant. And so we're building a fee emulator that acquirers can use to help merchants understand the fees and forecast them. We're happy for acquirers to share the detailed fees with merchants as well, for those who are on interchange plus arrangements. So we recognise there's more work for us to do, but actually when you step back and look at it, we have this complexity because it is a complex world. There are significant threats ahead of us around cyber and fraud that we're trying to address. And so there are trade-offs between how we build for efficiency and complexity.
Okay, I'm going to hand to Ms Jarrett and then to Mr Violi after her.
Thank you, Chair. I just want to go back to a couple of things that we've heard this morning and also some comments in that you made. We've heard that scheme fees are obviously opaque, they're complex. I won't go into some of the questioning that others had because my colleagues will probably go down that path. But can we literally simplify and make scheme fees more transparent and comparable across the board? Because from what we're hearing this morning, it's just so complex and so different.
Just in terms of the transparency, just to clarify, the scheme fees are completely transparent for the acquirers who actually
but what
rebuild.
about the merchants and the consumers?
So if I just take you through from an acquirer perspective, the acquirers, a lot of acquirers will build models around the scheme fees. They'll actually map out those scheme fees, they'll reconcile the actuals against those scheme fees, and they'll forecast those scheme fees for each of their merchants. So in a previous world, that's what I did. And we would actually discuss with the relevant merchants those scheme fees, what the forecasts were. It obviously depends on whether there's more card not present transactions, credit transactions, etc. But that's the role of the acquirer, to then sit with those merchants and actually discuss that forecast and how that's going to be. Also, in terms of the small business, as Rich mentioned, I think we're more than happy for each of those acquirers. When we sit with them and we're building this fee emulator, we know that some acquirers are better at those models than others, which is why we're building the fee emulator, so we can help them. And we're more than happy for, as they go through that, for them to communicate those fees to the end merchants of the forecast.
Yeah, but if you're a merchant, you're doing it for you, Visa might be doing it for them. I'm looking at how we can make it more transparent across...
Yeah, I think you're absolutely right, and that's why, as an acquirer, they need to do them for Visa, MasterCard, EFTPOS, Amex, all of the above. So they need to take those and actually forecast them out, look at that impact on those merchants, and actually describe that to them.
One way to think about this is when you go to a restaurant, the restaurant owner has a menu and sets the prices. They decide what services they're offering. They decide the prices they're going to sell them for. The restaurant is that's the role of the acquirer in order to do that. The merchant's customers come in. We're a wholesaler. We're like the beef supplier. So the end customer coming into a restaurant, they don't need to know what the cost of the beef is. They go to look at the services that are offered. And what merchants are doing is they're looking at different providers and deciding which range of services are most appropriate for their needs. For some smaller merchants, they want simplicity. They want bundled services. And our costs, when you look at the BCG analysis, are 7% of the total cost of acceptance. It's important for the committee to consider the other 93%, which is really where the cost is in the equation. And those costs are broken into three buckets. The first is the direct costs. So Jerome's coffee cup, the transaction components there. There's also the cost of the terminal, the setup required to process payments and fraud. And then there's the back office reconciliation costs. And so you've got to look across the whole end-to-end system to understand the cost of payments. And that's where when you step back and look at it, cards are actually the cheapest way for retailers to get paid. They give most efficiency and security, and that's why you see many retailers favouring cards over other forms of payment, because they're the most efficient.
I'm not sure I'd go with the analogy between restaurants and payments of credit cards, but be that as it may. You did also say that we should be taking a whole system view, and I do agree with that. But where exactly should we be focusing on? Where exactly should we be focusing on if we're looking at increasing efficiency, adopting new technologies, protecting consumers, keeping costs low for merchants and consumers? I know that's a very big question, but yeah.
I think the place to start, as I said in my opening statement, is to put the consumer front and centre, because the system, yes, is complex and there are many players, but the costs are ultimately borne by consumers, either through surcharges on the merchant side, the cost of payments impacting cost of goods, or on the cost and their access to financial services. So one of the submissions to the committee was from COSBOA, representing the smaller banks. And so when you think about the trade-offs that need to be made, we need to decide how we want to balance the cost in the system. Merchants should make a reasonable contribution towards the cost of the network. They see significant benefit, but that shouldn't come at the expense of consumers. And so when the RBA announced their proposed changes late last year, one of the reasons that almost all stakeholders pushed back was because they're feeling that balance was wrong. And I'll give you a couple of examples. So one is, we know that when you cut interchange more broadly, and only 10% of merchants actually surcharge, 90% of that benefit goes to merchants that don't surcharge. So there's no benefit on the merchant side. But the cost impacts to consumers, we can see from the UK, for example, it will impact access to credit and cost of credit. And who pays for that? It's the consumers that are less well off and need access to credit for cash flow. It's not about rewards cards. And so that's why it's important to get this balance right. And so the consumer should be at the centre of payment regulation.
And one last question, Chair, if that's okay. So looking at technological developments and future of payments, Bitcoin, stablecoin, etc., does that offer an opportunity for consumers to be better off? And how should we be thinking about that then, if that's the case?
Yeah. So there's the cost of goods side of consumer experience that many, I think, participants for the committee have already touched on as well. When you look to the other consumer impacts and opportunity to do well off, access to credit, cost of credit is one of the major opportunities. And the regulators in Australia have done a good job in making sure access to credit is responsible. ASIC with the NCCP has made sure that lending in Australia is actually well regulated, but we have choices in those policy settings. If we want lower interest rates and more access to credit, we need to encourage more providers, and that's to make the system more sustainable. If you look at the interest rates that a small business might borrow at in Australia, they might be 12%. So a 1 month cash flow benefit is roughly 1%. Credit interchange settings in Australia are already less than that. And so there is this waterbed effect where you make changes on one side, you impact the other side as well.
And therefore, are you saying, therefore, the future technologies that we have now that are going to be growing and integrated into our payment systems and our financial markets, Bitcoin, stablecoin, etc., that's going to lead to that?
I think when you look ahead, probably the next wave of change we would see in the Australian payment system is with the use of artificial intelligence in payments, so agentic commerce, the ability for a consumer to instruct an agent to do research and then make payments on their behalf, therefore finding opportunities to find lower cost options from retailers and make those payments seamlessly. Now, we have actually already piloted the first live agentic transactions in Australia with an Australian large language model called Matilda, with an Australian payment service provider, IPSI, with an Australian merchant, Event Cinemas, and with a number of the Australian banks as well. So That's one of the ways that actually the global networks are providing investment and opportunity to access these capabilities at very low cost in Australia. That pilot, by the way, was conducted really between November last year and January this year. So it's come to market very quickly. I think that is the next closest innovation. I'd say stable coins, central bank digital currencies are probably some way further out yet. And there's not yet certainty as to how those networks will evolve in Australia or many markets around the world.
Thank you.
Thank you. Mr Violi and then Mr Gregg.
Thank you, Chair. I just want to start talking about, you referenced the 7% as a percentage, which has been referenced a lot today, but it's a little bit deceptive, is it not, in the sense that that is on, your charges are on every transaction, whereas if you look at a terminal cost, let's just say it's $100 a month rental fee for a terminal cost. As a business, as particularly a small business, hits a certain point of sales, they'll have essentially covered that cost. It will then not be part of their unit of goods moving forward, or they can amortise it across. Whereas your transactions are on every transaction. They don't reach a point where they avoid paying that fee. So it will have a greater impact on their total business cost of goods sold. Would you agree with that?
It's still a valid cost, right? So in terms of, it depends how many transactions they're doing. They'll have the cost of the terminal, which is not insufficient. And they'll also have the cost potentially of integration middleware as well, which they also pays for. So it may not be at a transaction level, but it's still a relevant cost. And for actual small businesses who are not doing that many transactions, it's actually a substantial cost that goes into the overall cost.
No, correct. I agree. The point being, over time, they will amortise that cost. They cannot amortise over time based on volume of sales in a day or a week or a month, the fee that you charge. And I just think that's an important distinction to make, because these conversations around MasterCard and your competitor Visa go to every transaction for small business in particular and large business. And if we can reduce that cost, it's going to then hopefully flow, either keep that business, particularly family businesses, more sustainable, or flow through to consumers, which is what we're focused on. So I just want to talk around your model, and I understand this essentially distributor model where you go to acquirers. Do you also in Australia go directly to large businesses, Woolworths or Coles, those large scale businesses? Will you provide services directly to those businesses?
Just before we answer that, I'll just come back to the 7%. So that's from independent analysis from BCG. It's not from us. And when you look at the 93%, the costs through that do occur on every transaction. So the acquirer margin and interchange is on every transaction. The fraud cost is on every transaction. The back office reconciliation costs are on every transaction. The terminal cost is amortised and will need to be replaced. So there won't be a point where that's fully amortised and gone to zero, because they don't last forever. They last a couple of years. So the 7% is an accurate reflection of our costs as a proportion of acceptance cost. And when you back up and look at Australia's payment system, we have amongst the lowest payment costs in the world. Now, in answer to your second question around do we deal with merchants directly, we do have relationships with major merchants. I mean, my background, I used to work for Wesfarmers beforehand and dealt with MasterCard and Visa and American Express on the other side. Paul obviously had experience with Woolworths as well. We offer a range of services beyond payments to those retailers. So from cyber, security protection, data analytics and loyalty. So our payment network is part of our business, but our relationship in the B2B space with retailers, with government, with other players goes beyond that as well. And that's in large part where we have those relationships with, whether they be retailers or telcos or other players in the system.
But it would be fair to understand that there's other services you provide to them. But if you're going directly to them, again, I've been in the business world with the distributor model. Those distributors or acquirers need to make a margin. If you're going directly to those larger businesses, would it be fair to say, I understand you can't give exact details, but as a general comment, they would be receiving a better rate than a small business based on the volume that they would do with your organisation?
In terms of if you compare small business and the large businesses, so obviously the large businesses, if you go down to the coffee cup analogy, so we had interchange, scheme fees, acquirer margins. So if we then compare those three and we start off with interchange and scheme fees, So interchange, the strategic merchant rates for the larger businesses. For the small businesses,
So sorry, just to be clear, sorry to interrupt, but strategic merchant rates is another way of saying a lower rate for a larger customer. Is that when you say strategic, just to, yeah?
Yeah, that's so based on volume. Yeah. However, we also give strategic rates through our small business program. That was, as Rich mentioned, that was introduced in 2022. We've since revised that since then. And actually that gives virtually the same rate on an interchange perspective to merchants within that program. Then from a scheme fee perspective, the scheme fees are fairly standardised. Although with the strategic rate on small business, the small business program, we actually give a 50% discount on most fees around that. So they actually benefit in that area. So if you compare the coffee cup on those two, actually they're very similar from a scheme fee and from a interchange. Now, your acquirer margins will vary very much from a large business to small business.
Now, that small business program, how many of your small businesses would be on that program?
I'd have to take that on notice. We're happy to provide the full details. It's fair to say it's not been fully adopted by all acquirers, and we're not able to require those acquirers to pass on the savings. They set their prices to their merchants commercially, which is why we'd suggest that a coordinated approach led by the Reserve Bank, as has occurred in Canada, would ensure that there's alignment of those small business programs. For example, we have a small business program on credit and debit. Visa only have one on debit. The programs are different. They've obviously been created independently. EFTPOS have a different program again. So this is something that we can't coordinate with other players, nor would we seek to. It's something the Reserve Bank should take the lead on. And we believe when you look at a surcharge ban together with a Canada-style change, you could easily see small business rates moving from the current 1.6 to 1.8% to around 1%, which would then be probably the lowest in the world.
So is there a legal reason why you cannot require the acquirer to pass it on? And the reason I ask is twofold. Again, I've worked in this industry where we would offer discounts to distributors or other middle people, businesses, but we would require that percentage discount would be passed on to the consumer to drive increased sales. Otherwise, we're essentially reducing our margin to give the acquirer a greater margin. The whole point of you offering the discount for small business is to drive increased sales, I would have thought. So are you not able to legally, or do you just choose not to as part of your negotiations with those acquirers?
Spot on.
Our advice is that we can't legally require or can't intervene in the prices, the price setting that a merchant has with their acquirer.
Well, respectfully, why do you offer a discount?
That's hard to believe.
Why do you offer a discount to an acquirer with no guarantee that it's going to drive increased sales? Why would a business that needs to deliver a profit, being MasterCard, reduce your margin with no benefit to the small business to drive increased sales?
Exactly.
On a pure business case.
Exactly.
So it's an intensely competitive market. We felt that in order to be competitive, that we needed to offer a small business program. And as the RBA said earlier this morning, that in their view, they felt that there was sufficient competition in the acquiring market, that over time that those savings would be passed on. So we introduced our program in 2022. I think other networks have only more recently done so. So this is a relatively recent change. So if you take the RBA's view at face value, they believe that over time competition will result in those savings.
Where's the evidence
on.
of that? Sorry, yeah. I've just got to ask. Where's the evidence?
No, go for it, Chair.
Where's the evidence of that? Where is the evidence that gets passed on? Because this is just the volume argument blows my mind. If you were a toll operator, you would not give a discount to haulage because they use your toll roads that much, because you've got to use that money to keep the system, the actual network, deal with CapEx, OpEx, whatever. But somehow smaller SMEs have to still pay up. There's no discount for them, but the people who use it the most and no doubt attract the highest risk get off with a discount. Like, where is the fairness in that? And to Mr. Violi's question, he's spot on. Like, why would you willingly make that cut and then say that it's designed to help, but there's no proof, and you can't contractually through your system require the flow through, the pass through to the smaller business?
As a number of other...
Yeah, go on.
Sorry, Chair. Well, as another representative for the committee today have said, that there is complexity in the system. There are many participants here as well. You know, we are running a global network that we believe provides real productivity and efficiency benefits to businesses of all sizes. You know, we've invested over $16 billion in cyber and fraud protection over the last few years alone. And so when we look at the small business space, we want to compete and we want to be efficient and we want to help our acquirers offer effective, efficient services to those players. That's why we produced the Small Business Programme in 2022. We would say that the problem is not what we've done, it's the overall ecosystem adoption of that, which we can't control because we're only one player in an overall network with many other players as well. It's why this committee, we think, can add real value and direction to the future payment policy framework in Australia. And one option amongst others is what's happened in Canada.
Yeah, these are small business programs that can't be guaranteed to help small business.
And respectfully, it sounds very much from not just your testimony but others today that it's the small businesses in my community of Casey and across the country that are actually underpinning large businesses in Australia and underpinning this business model for yourselves and others. Given you're going directly and offering discounts to large business and there is no evidence and no desire to pass that benefit onto the small businesses that are needing to charge this surcharge, because you talk about the 10%. And the reason small businesses clearly are charging the 10% is their cost of business is so high they need to pass it on to consumers. And we now find out that larger businesses don't need to charge a surcharge because they're getting greater deals and greater access. And while there might be a scheme, there is no desire to make sure that gets to small businesses. And as someone that spent my life in sales and in business, if there is a desire to get it to the end consumer, it will happen. Businesses will make sure if it's in their interest to get it to the end. It is very disappointing to hear that it is not getting to the small businesses that are risking it all and deserve it. So I appreciate, Chair, I've taken a fair bit of time there. I'll pass through.
Yep. Over to Mr. Gregg.
Thank you very much. Took the words right out of my mouth there, Aaron. The recommendation in your report talks to moving from a cost-based look at this to a value-based approach. And in the context of small businesses having to pay the sizable share of the fees, is there a risk of just a value to cost approach just entrenching existing market power with MasterCard and Visa rather than assisting the competitive landscape?
I think when you look at the market structure in Australia, the 90 to 85 to 90% view of our share is just incorrect. When you look at the Australian payments network, it's actually dominated by Australian domestic payment networks. So actually only 5% of payments in Australia are processed on any card network. BEX is the largest network, which is obviously Australian owned and operate. Even when you remove that, the AP Plus organisation, which has NPP, FPOS and BPay, processed 2.5 times as many transactions as all of the international networks combined. So our share in Australia, we would argue, is at best 11% of the market. And so we're not a dominant player. We provide good value because we provide an efficient, safe and secure network. But we compete every day for every transaction on that network, and will continue to do so.
But that would go to your role as well, mostly being consumer or transaction things in stores and things like that. Obviously, when a business is paying a wage or something like that, Visa or MasterCard aren't being used. So your stats are including a lot of transactions which the business model of Visa and MasterCard have not in any way sought to be part of. Would that?
No, that's not true. So in Australia, we have actually built an overlay service on the new payments platform in the last 3 years, and we're experimenting with that at the moment. So in other markets, we actually offer account-to-account payment services, and we do those effectively and efficiently in a number of markets in Asia and around the world as well. So historically, 60 years ago, we started with credit cards with click-clack machines. But over the 50 years, we've moved from magstripe to chip and pin cards to contactless to now AI. And so when we look at the market opportunity both here and in Australia, we would say our market share is 11%, and we believe we can add a lot of value to many of those other flows. I mean, Australians lost more than $2.8 billion to scams last year. We have technology platforms that can help address that problem and bring real value to some of those other flows in the market as well.
Another one of your recommendations goes to the adoption, as you were saying before, of a voluntary industry agreement like what is seen in Canada. Why do you think that would be more effective than rules requiring these savings to be passed to small businesses?
That would be an alternate model. And it's what I'd say is it's for the regulators to determine what's the appropriate path forward. But there clearly are opportunities ahead of us to reduce costs for small business. I was in New Zealand recently. New Zealand has also announced a ban on surcharging and had previously seen this sort of free EFTPOS model proliferate. But what's happening in New Zealand now is those new entrants have pivoted their model. They've reduced their cost to merchants to around 1%. They've done that by simplifying the plans. They've removed American Express from those bundle plans because it's more expensive. That's available as an optional extra. When you look in Australia, all 4 of the major banks already offer basic payment plans of around 1.1 to 1.2%. That's before any Canada-style small business program comes into force. When you look at the free EFTPOS models, they're 40 to 50% more than that. And that obviously is resulting in higher surcharges for consumers. So there are clear opportunities ahead of us. New Zealand is not far away. It's a similar market structure, and they are seeing some progress on this issue already.
So I've noticed you've made a lot of global comparisons. Obviously, Visa and MasterCard contribute to that environment in each jurisdiction, so all of them are influenced in some way by Visa and MasterCard. Going back to what I was asking one of your colleague from Visa before, some of the banks themselves have expressed concerns about the opaque and difficult nature of the fee structures in schemes. Do you think there's any truth to it? And do you think could you describe any places you think there's room for improvement in the way that these schemes are communicated with banks and their capacity as acquirers to negotiate deals for their customers and for themselves?
Yeah, I think I mentioned earlier in terms of we've got a robust process for those changes. So when we put changes out, we put bulletins out to the banks. We then will schedule meetings with each of the banks on the actual impacts of those. We'll run through those. If there's any price impacts to them and any changes from that, we'll actually model those out and walk them through it as well. Those will be scheduled in for about 6 or 9 months down the line because we're on an integrated network with the banks and the acquirers. We need to obviously maintain the integrity of that network. So there may be technical changes and we need to walk them through those as well. So all in lockstep. I think we've seen that we can actually help further. As I said before, each of the acquirers will have their own models and they will model each of those out. But I think some are better than others, and I think we can help more with a fee emulator that we're building that can then help them forecast and look at those changes around that side. So from that side, that's pretty clear that we can help more, and we're trying to do that. In terms of the kind of fee changes around that, most of the fee changes are behavioural. So just trying to get integrity on the network. So let's say if someone's sending through too many approvals, that we would charge for that because it's not good for the network from those kind of things. Some of them are actually requested from the banks, I think I mentioned. So one such one last year was where one of the parameters was in USD and we changed that. They requested it to change to AUD. So we did that change as well. So it's easier for them to change that. And also quite a number of them, about 25% last year, were opt-in. So they can choose to opt in or not. So we'll discuss all of those with the banks and the acquirers. We'll run through where they've got issues around technical implications and actually the need to defer. We will consider those, and we'll consider a waiver and defer some of those things as well. We have done that in the past.
So if their concern is with cost, how often would those meetings result in a change in cost paid by the acquirer? If they're just like, look, there's no value add for this you know, we don't need it, we don't want it, we've got other safeguards that cover what you're talking about. I just don't want any part in this change. Because I know that there was, one of the complaints was there's no opt-out of some of these scheme changes. Are you saying that they can always opt in and out of scheme, you know, of new?
No. So some of the changes obviously are integral to the network for us to do that, and some of them are behavioural. So if they don't do those behaviours, they don't pay for the fees. Some of them are opt-out, some of them are opt-in, and a few of them, I think, if you look at the changes last year, one was obviously small business, which actually reduced some of those fees. Some of them, I think one was commercial, so not to do with retail. One was to do with ATM surcharging, as an example. So they're specific, and they're most of they're integral to the nature of the network. Where there's specific issues with an acquirer to actually meet those, then we will have discussions.
So does that mean in your arrangements with acquirers there is scope for you to kind of unilaterally change the terms of your arrangement with banks in the life of a relationship?
No, that's not the case. So where we identify a security weakness, that's something that, and that's a rare case, but that's something that the banks would need to implement for their own safety, for the safety of their own consumers. But many of the changes we introduce are opt-in. It's up to the banks to decide if they want to avail themselves of those services or not. And if they opt out, they don't pay for them.
So they are always able to opt out of things that are not security related?
That's largely true, and that's certainly our model as we look forwards. And I'd say, coming back to the start of your question, our fees are not opaque. They're very transparent to the acquirers that pay them. We recognise there's more we need to do to help some acquirers understand them and be able to explain them to merchants, and we're working on that. It's not 400. Last year it was 122, of which 15 accounted for 75% of the total cost. There's a big difference between opaqueness and complexity. I mean, we're living in a world where the threats from bad actors have never been higher, and our network is under attack daily from bad actors around the world. And touch wood, so far we have managed to ensure the security and safety of that network for more than 60 years. That requires consistency, it requires diligence and focus, and so it is complex, but it's not opaque. It's clear to the acquirers that pay those fees what they're for.
Thank you very much.
Ms Campbell?
Thank you, Chair. Just to change gears a little bit at the outset, I wanted to ask about some of the work that you're doing in tokenisation and biometric checkouts. And I know you've got pilots for these. I think that one of them is based on my own personal worst nightmare, which is Pay by Smile. Can you take us through what the big risks that you're seeing in that safety space are from those pilots?
Right. So in Australia last year, there was around $900 million of fraud on card networks. That was AusPayNet's data. That was almost entirely in e-commerce, so customers buying online. Now, what we've seen over recent years is an increase in attacks on retailers that are storing customers' card data. And so your card number is stolen, it ends up on the dark web, it gets resold to a bad actor, and then you see a transaction on your account you don't recognise.
Sorry.
So that's the problem we're trying to solve with tokenisation.
Yes, sorry, I understand.
Yes.
Sorry, I was going to say, I understand the sort of, benefits. I guess I'm asking the flip side. I am asking, what are the sort of unintended things that have happened in those pilots, in terms of the things that we're trying to solve, right? What's happening that you didn't expect?
I'm not sure what didn't expect, but certainly our pilot work addressing e-commerce checkout. There's a lot of changes required across the whole system. MasterCards are accepted in 150 million places around the world. So for many years, there are going to be places where consumers have to put their card number into the checkout. Our work on tokenisation on pilots is one part of it, to try and reduce the places where customers put those card numbers into the system. What we're also seeing on the other side is we ultimately need to take away the card number and make cards numberless. so that a consumer, when they're checking out online, doesn't get their card out and putting a fixed number. They go to their banking app, they create a one-time use card number that then, if that's stolen, is useless to the bad actors. So what we're seeing is there are multiple steps that we're going to have to take, both in Australia and around the world, which will take a number of years to protect consumers. And that's why there's significant investment going into the network, both here and around the world. And that's also why we have to, in some cases, require banks to make upgrades to the network to ensure its security.
Okay, I want to come back to small businesses briefly. In terms of the 50%, discount on fees that small businesses, would get if the acquirer passes it through, how do you do a 50% off fees? How do you do a literally half-cut price, in terms of, a model?
So we bill the acquirer, not the merchant. So
no, I understand that. Sorry, I guess I'm asking, how is it, if I went to a store, and we're back in our coffee cup store, or we're back in our coffee store, and I said, oh great, I'm gonna cut my cost of coffee by 50%. I don't think many people could do that. How can you do that?
So we focus this program specifically on small business, and most small businesses operate in-store. In-store transactions are safer. So as transactions become safer and lower risk, we have over a number of years lowered our fees. And so this is one of the ways we're doing it, because we recognise that small businesses in-store, contactless, the digital wallets, have made those transactions more secure over time, whereas in e-commerce, there's still a lot of work to do. They're higher risk. And so our fees reflect the risk of those transactions, the value that we provide. And so that's why we've been able to reduce our fees in that space, because in our view, they are now lower risk. And therefore, that's our small business program.
Visa was up just before, but they were doing 70%. Why is their risk at that kind of 70% discount rate and yours is at 50%?
I'm not familiar with our competitors' programs. We developed our program independently, obviously of the other networks, which is why we'd argue that this is appropriate for central coordination through the Reserve Bank to align those programs. And it might be that the settings that the RBA decides are somewhat different to ours or other networks. You're not
familiar with your one other major competitor's programs?
We have many competitors in the Australian market, certainly not just one. When you look at our capability in the credit space, Amex is the fastest growing network. Buy now, pay later has grown very rapidly with some great innovation that's been led in Australia by many of those players. In the debit space, there are EFTPOS and account-to-account payments. There are potentially emerging stablecoins. So it's not true that we have one competitor. We have many competitors.
Last question. I was just going to ask, in your submission, the sort of first principle that you bring up in the recommendations is a value over cost payment policy principle. And in terms of value over cost, understanding what that means, but what does that mean for a small business?
Well, many small businesses today, and if you look at the acquiring market, we've seen significant new entrants. I think there's more than 100 acquirers now in Australia. As the commentary from the Big Four banks mentioned earlier, they're scaling very well, but by not being the cheapest providers, they're generally more expensive providers. And that suggests that cost is not the only factor that small businesses are taking into account. They're looking at the overall package like any product. What price is it? What features do I get? And therefore, how does it best suit my needs? And so that's why I'd say at the beginning, the RBA settings at the moment have overly focused on merchant cost at the expense of consumers.
Okay, thanks.
Ms. Situ. Ms. Situ, if you're online, over to you.
Oh, sorry, Chair. I was happy to give up my time for others, given that we're running short of time.
Oh, okay. Thank you. That's very generous of you. Thank you. Mr. Laxale.
Thank you, Chair. Thanks for your evidence today. You've mentioned quite regularly that your scheme fees are transparent. Could you just pick a random acquirer and let us know what your scheme fee is to them? You can de-identify them.
I don't have that level of detail in front of me.
Ballpark?
So our scheme fees in total are around 7% of total acceptance cost, according to the BCG analysis. It does vary by the type of transaction. So the range will be between 5 basis points and 20 basis points. The RBA submission, I think, already outlines the overall range of that as well. But obviously it will vary by the transaction type.
And over the last, since the last major reform by the RBA on credit card surcharging, have your scheme fees increased or decreased?
Some have increased and some have decreased. We've added a range of new services that didn't exist previously. We also consistently review our scheme fees to be competitive.
I'll rephrase that. Has the revenue you've received from scheme fees increased or decreased?
Well, our revenue is a function of both price and volume, and electronic payments have increased, and so our revenue has gone up. But actually, it's a very competitive market, and so some of our fees have gone down. We've introduced new services. We offer, we believe, good value compared to other options for merchants. And as you see from the BCG analysis, cards are the cheapest way for retailers to get paid, and our fees are only 7% of the total cost of acceptance, and Australia's card costs are amongst the lowest in the world.
What is your annual revenue, by the way, in Australia?
We don't disclose our annual revenue in Australia. We operate a global network. Australia represents a small fraction of our total volume, and the Australian businesses that connect to us and consumers benefit significantly for the global investments that we make that are effectively available to the Australian participants in the network because we're doing it at global scale.
Do you pay any tax in Australia?
We do pay tax in Australia. I'm happy to provide the details on notice so the committee has the full details. But what I can say is that we pay more tax in Australia than our nearest two comparable networks. We employ more people in Australia than those networks. We employ, in fact, 1,200 people and operate one of our largest technology hubs in Sydney, and we collect more tax than those other networks in Australia for the Australian government.
So you know what your competitors pay in tax, but you don't know what they charge to small businesses. You mentioned before to Ms Campbell
the tax reports are publicly available.
Okay. Do you pay, say, banks, for example, rebates, performance bonuses, sign-on fees? Is that part of your business model?
We have to compete for issuing banks to issue our cards.
Yep.
It's an intensely competitive market. The major banks determine the terms of those RFPs. So we have to compete on price and features and value. And so we do offer rebates on our issuing fees because we have to compete. On the acquiring side, we have a range of programs, and we also offer incentives and compete on price in a fiercely competitive market as well.
How long have you been offering rebates to issuers in Australia?
So the business is over 60 years old. The four-party model, as it was developed, balances incentives on both sides. It has always had incentives rebate structures in order to drive the adoption of new technology. So that practice is not new. It's been around since the business model first started more than 60 years ago.
Okay. And have the amount that you've had to pay per acquirer, has that amount, gradually increased over time?
Yes, it has, as a function of competition. And as I said earlier, we fight for each transaction on our network. There are many alternatives. And so when we look at our share of payments in Australia, it's at best 11%, and that's excluding the BEX platform. And so there are many more capabilities that we believe we can bring to improve the safety and efficiency of the Australian payments network. It's highly competitive.
So, as far as I can see over the last 25 years, interchange reform has decreased the revenue to the banks. You've just confirmed that the scheme, so the rebates you pay the banks has increased over time as well, and that scheme fees have also gone up. Whilst the cost to the consumer, isn't going down in terms of using these, I don't believe it's going down. It's at the eight cents in the $5 a cup of coffee. So, are you using these rebates to offset the bank's declining interchange revenue by increasing your scheme fees? No.
No, and if you look at the RBA published data, the cost of payments in Australia has gone down over the last 10 to 20 years.
But scheme fees
and when
have
you
gone
benchmark
up.
Australia,
Scheme fees have gone up 11% over the last year.
And so our scheme fees have not gone up by that much. The largest increase in scheme fees in the last few years, when you look at one of the other submissions that was provided, was actually the EFOS network who increased their fees the most. And that's, I think, because they're building new capability, which costs them money. They're entering channels that are higher risk. And so their costs actually went up much more than other networks.
Just, you mentioned earlier that I think you said that you said you were a small player. I think they were your words, correct me if I'm wrong, in the payment system. That seems to be at odds with the evidence that we've got, including data from the RBA. I think you're comparing it to total payments, whereas I think the focus of this inquiry and also the surcharge review is on consumer payments, where card transactions are about 70% or even higher with the declining use of cash. Do you accept that you're part of a duopoly in the cards payment network, like in Australia?
No. And in fact, when you look at the data, the Australian payments network is dominated by Australian networks, even in consumer payments.
I'm talking about consumer payments here. Consumer payments.
Yes, as am I. Every day when I pay my bills on BPay, I'm not using a card. When I make a payment on Pay2, I'm not using a card. When I make a payment on Buy Now, Pay Later, I'm not using a card.
We're talking at a small bit, walking into a shop to buy something, or we'll go back to the cup of coffee. Are you suggesting that the majority of people paying BPay and bank transfer? Buy a cup of coffee with BPay?
Consumers in in-store retail do favour cards, as do merchants themselves, because it's the lowest cost, most efficient way to pay and be paid in Australia. And that's, in part because across the industry, there has been large-scale coordination to adopt the new capabilities like contactless. The RBA has been very supportive in driving that change to make Australian businesses more efficient. I mean, that's been the original genesis of digital payments drive that Australia really led the way on. And that lead was in part taken by the Reserve Bank themselves.
But no one's going to Coles and paying for a bag of groceries using BPay. You accept that, right?
That's true, but that's only one part of retail.
So now that we've established what the question is...
Hang on a second. When they go to pay for their petrol, they're not using BPay. When they tap and go using the train network in Sydney, for example, they're not using BPay. I mean, yes, BPay exists, but to Mr. Laxal's point, it's clear Visa and MasterCard are the big dominant players. It's effectively a duopoly. As much as you talk about competition, scheme fees are up 11%, $2 billion worth. I mean, that's just not... Our experience suggests otherwise.
I mean, just a question.
It's a very narrow definition.
Visa and yourselves seem to be at pains to give evidence that suggests you're not a duopoly when it's clear as day to me that you are. Why you have this hesitation to accept that you're a dominant player in the Australian payments industry for consumers?
The data, even from the RBA, doesn't support that allegation. The Australian payments network processes 2.5 times as many transactions as all the international networks combined. We operate services not just in cards. We've built an overlay on the new payments platform using account-to-account technology. There are many other alternatives to MasterCard. Ultimately, merchants decide what options they put in front of consumers, and they do choose cards because they are the most efficient way of paying and getting paid, and the Australian economy benefits significantly from the productivity improvements that has provided and continues to provide.
I again, similar comments to sort of the end with these, like the reality seems to be very different from the evidence we're receiving in terms of how competitive you feel the market is, because it's certainly not competitive for a small business that can't exit your taking your payment network. The banks gave evidence before saying that they couldn't exit providing mobile wallets, and like it's just it's like you and Visa operate in a different reality to what small businesses live in. But I'll leave my comments there and my questions there as well.
Okay, thank you. I think we'll end it there. Thanks for appearing today. The committee secretariat will contact you in relation to any matters arising out of the hearing. You're going to be sent a copy of the transcript of your evidence, and you'll have an opportunity to request corrections to transcription errors. I'll convene for a half-hour break or thereabouts and reconvene at 2 p.m. Thank you. I'd be grateful if you could state your full names and the capacity in which you appear before the committee.
I'm Corina Davison. I'm the Managing Director of American Express Australia.
Thank you.
Sarah Wood, Vice President of Government Affairs, American Express.
Thank you for that. Before we proceed, I should advise you that although the committee does not require you to give evidence under oath, this hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. I'd now like to invite you to make an opening statement before we proceed to questions.
Thank you. Appreciate that. So, Chair and members of the committee, thank you for the opportunity to appear here today on behalf of American Express. The inquiry comes at an important moment. Australia's payment system is evolving quickly, shaped by changes in technology, consumer behaviour and business needs. It also comes at a time when the Reserve Bank of Australia is considering significant changes to payments regulation. In that context, more competition is good for consumers, and regulatory settings should be proportionate to support choice, innovation and investment. Let me begin just by spending a little bit of time on who we are, American Express in Australia. We've operated here now for more than 70 years. We are a non-bank lender and a payments provider, employing more than 1,000 colleagues who serve small businesses and consumers in the Australian market. We issue credit and charge cards. We do not issue debit cards. We continue to invest substantially in the local payments infrastructure that supports consumers and small businesses. That includes developing real-time user cases on the NPP platform, as well as investing in CDR as a non-bank lender. We're also investing to keep pace with customer expectations in digital wallets, advanced fraud detection and scam prevention capabilities. These investments enhance competition and resilience across the ecosystem and demonstrate our long-term commitment to the Australian market. We are a global brand, as you will know, but we're also a very niche player in Australia. In terms of size, American Express represents 2% of all card transactions in Australia processed on the American Express network, and we hold less than 10% of transaction value, and that is spend on cards. We are what is commonly referred to as a three-party scheme, which means we issue cards, we provide cards to cardholders, we accept payment on behalf of merchants, we are also the acquirer of merchants, and we run the network which processes payments, merchant payments. American Express operates in Australia as a regulated participant in the payment system. We are subject to financial services, credit, competition, privacy and anti-money laundering laws, and we are overseen by multiple regulators including the Reserve Bank, ASIC, the ACCC and AUSTRAC. A defining feature of American Express is the principle of choice that underpins our business model. Cardholders choose to hold our cards and merchants choose to accept them. We are a not must-take payment system and we must demonstrate value in every transaction to be accepted or used as a cardholder. If we do not deliver the value, it's simply the choice of the customer or the merchant. We know that small business is the engine room of our economy. We're very proud that many of our customers are small business operators and we design many of our products to support them with their needs in mind. Our cards are not just a way to pay, they are increasingly a source of short-term working capital and unsecured lending. For small businesses, that flexibility is very important. It helps manage cash flow, pay suppliers on time and respond to growth or seasonal pressures. Card-based credit offers fast, flexible working capital without the collateral that is often required by some of the bank lending. Beyond financing, we support all small businesses by trying to help them attract and retain customers through initiatives like our Shop Small program, which is in its 14th year. Chair and members of the committee, over the past 2 decades, payments regulation has focused heavily on card payments and fees. While that has not changed how fees are structured, it has not fundamentally changed the underlying market structure. The same 2 schemes continue to dominate and account for the majority of transactions, and merchants' dependence on those networks remains largely unchanged. At the same time, there are positive signs of competition emerging more broadly across the payments ecosystem, including new entrants, new ways to pay, and significant investments in platforms like NPP, AI, and data-driven innovation. If allowed to develop, these forces have the potential to enhance competition, productivity, and deliver better outcomes for consumers and businesses. Further pricing regulation without regard to differences in scale, business models and sources of innovation risk entrenching incumbents and damaging investment rather than supporting a dynamic and competitive payments market. And more broadly, it can affect Australia's attractiveness as a market for payment innovation. Policy and regulatory settings need to recognise that payments deliver real economic value, and that doesn't happen just by accident. It does require ongoing investment. The Australian payment system should encourage competition, protect consumers and deliver long-term benefits for small businesses and the economy. Thank you.
Thanks, Ms Davison. So I've got three quick questions before I hand over to Mr Violi. First, the average merchant fees for Amex are 1.3% of the cost of the goods, compared with debit cards at 0.4%, Visa and MasterCard credit cards at 0.8%, according to the latest RBA data. Why is there such a big difference? Why are your fees so much higher for merchants?
That is the average transaction paid by a merchant as published by the RBA. If I can just step back for a minute and talk about our role as a network provider, but also the acquirer of the merchant. So the costs that are associated with American Express are a single merchant fee. There are no additional acquiring or scheme fees attached to that, and that simple fee is printed on the merchant statement.
Sorry, can I just confirm that, because scheme fees have been a big focus of the committee's consideration today.
Correct.
So you don't have a multiplicity of scheme fees.
We have a single rate that is negotiated on a bilateral arrangement with the merchant, and it is printed on their statement. There are no additional fees charged by American Express. For that fee comes a couple of things. Number one is the provision of the network in terms of fraud protection, scams protections, payments processing. So it's the facility of the network in which the merchants are processing payments. But in addition to that, again, it's a not must-take card. We are negotiating with the merchants business services and values so that they accept our pricing and accept American Express. An example of that is data and insights and marketing packages, as well as, because we are a closed loop in that we are both the issuer of cards and we are the acquirer of merchants and we run the network, we are able to use that closed loop for data and insights and bring customers to small businesses. So when we're pricing with merchants, it's a single fee. No scheme fees, no acquiring fees. It is a fee that is based on the value that we provide to that merchant, not just the cost of using the network in which they're processing fees.
So sorry to interrupt you, it's just,
of course.
I'm sort of, unfortunately, you're paying the price of me being very generous with time, and we've run over, obviously, so I just want to get to the heart of it. Based on what you were just saying, is it that if I have heard correctly, you're saying that all these other things, like, for example, the data analysis that you provide for merchants, that gets bundled into the cost, and that by implication is why you're charging 1.3%?
Merchants are our customers, and as a customer we provide the network in which they process transactions, but we are also the acquirer of the merchant, so we need to demonstrate value to that merchant in order for them to accept the price the single price that we charge to merchants. Again, American Express is not a must-take. If we cannot deliver that value proposition, or if the merchant does not see that value in American Express services, then they do not need to accept American Express.
But they don't absorb that cost. They would be a complete pass-through to the consumer, right?
Again, a pass-through to a consumer, I assume you're referring to a surcharge?
No, I'm not. No, I wasn't referring to that at all. But if you're charging a merchant fee of 1.3%, they'll just add that to the... Like, if the merchant is your customer, the merchant will then provide to the end customer, they'll just pass that 1.3% through.
That is the cost that we negotiate on a bilateral arrangement with the merchant. How they pass on those costs and price their goods and services is the determination of the merchant.
So they could charge higher or lower than the 1.3%?
Again, the merchant...
When you say negotiate, that's how...
The merchant service fee is what we negotiate with the merchant. How they price their goods and services, how the merchant prices goods and services to customers is the determination, the decision of the merchant.
Okay. Well, you're very efficient in answering another question that I did have, so I'll just go to the final one. So Australian banks are arguing that they fund our nation's core domestic payments infrastructure, while international schemes monetise activity on those rails. Amex, in particular, has been able to operate without an interchange fee cap. So what direct investment has Amex made in Australian payments infrastructure over the past decade? And then I'll hand to you, Mr Violi.
Just a reminder to the committee is that American Express, we do not have interchange fee as a three-party system, but we...
No, I said that.
Yeah.
I said without
interchange, correct.
Yep.
In terms of the investment that we're making in the ecosystem, we make the investment in three ways. First is the network. So we're investing in latest fraud detection, scam capabilities, faster and more efficient payments processing. That is our role as the network, American Express network. We're also investing in the local technology development in terms of real-time payments and CDR, as I said in our opening statement. We are investing in wallet infrastructure, which is important for our customers. So as a network and payments provider, there are a lot of investments to ensure we meet our customers' expectations as to how they want to pay. As an acquirer, we're investing in the merchant value proposition as well as we think about programs that we invest in like Shop Small. It's important for us as merchants and small businesses are our customers that we are demonstrating value to help their businesses grow. And also, as a provider of cards and lending, we are investing in unsecured lending for small businesses, which we've seen is a real need in Australia, particularly for small businesses who don't have the collateral and want the flexibility.
I understand that, but some of that sounds like, and again, you can correct me if I'm wrong, please. I won't be offended, but that sounds like those investments benefit Amex. It's not like you described as an ecosystem investment, and I think if I'm to interpret your argument, it's like that if Amex is healthy, it's good for the broader system in the sense of if you're operating without those risks to the wider system, then that's a good thing. But the banks are saying, effectively, they're doing all the heavy lifting.
At the end of the day, we serve customers and our customers are cardholders and merchants, and our investment in the infrastructure is to ensure that it is safe, efficient, secure and meets the expectations of those choosing to use our cards or our network.
Okay, thank you. Mr Violi and then over to Ms Luxale.
Thank you, Chair. Thank you for appearing today. I just want to sort of touch on that point around the difference in the model. So we've heard from MasterCard and Visa, I'm assuming you were watching this morning, that they've got acquirers, so which are essentially the banks and others, and then so people sign up to Bendigo Bank or any of the other banks and they get a MasterCard or a Visa. Do you have partnerships with the banks or are you directly to the merchant 100%?
We are directly to the merchant most of the time. We do partner with third-party acquirers. And again, the reason we partner with those third-party acquirers is because that's a merchant choice. They will often partner with the third party because it's a bundled offering and there are services attached to it. It's important that we price competitively to be part of those merchants. But for the majority, we will partner directly with the merchants.
Could you provide some examples when you say third-party acquirers? Are you talking like, could you provide a few examples for
like
us?
Like a Tyro or a Square is an example
so
of a
the
third-party.
Point of sale system.
Where it's a simple offering of multiple payment options to the merchant, and they will choose that option because of the other services that a Tyro or a Square will provide. Back office administration.
Yep. Mm-hmm. Yeah, it makes sense. Okay, but not with not with banks as such. Like a point of sale system, obviously, is a different.
Correct.
Yeah. And then I've just noticed in your submission you talked about your membership model being unique, and what I'm trying to understand is, and I'll tell you where I'm going so you can understand why I'm asking. You're talking about obviously regulation without flexibility, and ultimately in a choice model, if you're not providing value to consumers and businesses, they're not going to use it. So can you just explain the membership model and why you see yourself as different to a MasterCard and Visa and your concerns around the regulation? If we get it wrong, we could be stifling choice.
Yes, so we are a three-party model, distinct and unique three-party model in that we are both the acquirer and the issuer of cards, and we run the network which processes transactions. At the same time, we don't issue debit, and when we compete in the cards market, which includes debit, and we offer unsecured, non-secured lending to commercial customers, which is where we will underwrite the risk for commercial customers and apply the liability on our balance sheet. So when we think about membership services in that ecosystem of both cardholders, merchants and the network, we will put together value propositions across that for our businesses and our consumers. And again, the value proposition ranges from secure and efficient transactions, fraud protection and scams, membership benefits that could include access to our Shop Small campaign or insurance on your product. So there is a very big, we are a services organisation, and providing those services in our membership model is important, again, because we are a choice.
So I appreciate cash flow is king, particularly for small businesses. So would it be fair to say, and I've worked in organisations that have done this, but I just want to confirm that it's wider spread, that essentially a lot of people are using Amex as a cash flow mechanism and a line of credit. And do you therefore anticipate that your sort of line of credit maximum number would be higher than some of the other providers in terms of the amount you would lend to people?
So increasingly we are providing unsecured lending using the card rails. So customers are already spending a high average spend with working capital or interest-free days up to 55 days. And then they have the option for a flexible payment option where they can revolve some of the balance. And again, we will make that determination as to how much we lend based on their risk profile and the industry that they're participating in. But again, it's a need that we identified a number of years ago. There is absolutely a need for more flexible lending in this market. We are able to facilitate that through our card rails, and it is something that our small businesses and medium enterprises appreciate.
And do they get access to like loyalty points and things like that as well if they're using the cards to pay their day-to-day expenses as a business?
They can if they choose a product that is associated with rewards. We have a suite of proprietary products in the mix of which customers choose the types of features and benefits that they want to pay for. Rewards is an option.
Two more questions, Chair, very quickly. In terms of dealing with small businesses versus larger businesses, are you providing different rates to larger businesses compared to small businesses?
We price by industry and risk profile. What I can tell you is that we have introduced a very competitive rate for small businesses. They're our customers, and it's important that we are seen to be supporting them across the value chain, not just as a merchant, but also as a cardholder, and we have a low and very competitive rate for small business, lower than the average.
But as a general rule, the larger businesses having economies of scale for your business would, on average, likely receive a lower rate across the business given the scale they provide.
In instances, and again, in some instances with a high-risk industry like car hire, that doesn't equate.
Yeah, but it's more the point around what I'm getting to is we have to be very careful with the payment system that as we make decisions on how we regulate, there is an inherent economies of scale that big business has relative to small business. Would you agree with that broad statement?
Understand, yes. And as a small business, we appreciate where there are those economy of scale advantages.
Yeah, perfect. No, thank you, Chair. I'll hand back now.
Terrific. Mr Laxale, and then going on to Ms Campbell.
Thanks, Chair. Thanks for coming. Your submission recommends that future regulatory settings be proportionate, technology neutral and targeted only at demonstrated market failures. What does Amex think those market failures are in the Australian payment system?
Over the past years, there's been a lot of focus on pricing regulation, which again hasn't fundamentally changed the pricing structure or the market dominance of the two schemes, who still hold more than 90% share of the market.
So you feel addressing that market dominance is one of the biggest failures of our current system?
No, what I'm saying is that the intervention or regulation needs to be proportionate to where there is a market failure or where there is market dominance.
Yeah. So you see market dominance as a failure of the market to be competitive, innovative, etc.
Correct.
I don't know if you saw the evidence from Visa and MasterCard earlier, but they don't seem to think they're dominant. 90% is quite close to 100. What's your percentage in terms of share of the market?
So we're 2% of transactions and 10% of spend.
Okay.
So that's why we're smiling, because we were recalling the
previous
very emphatic declaration of non-market dominance by other
Yeah.
people in the
Others,
market.
by others, who shall remain
I think
nameless.
probably just an important note on that too is that that 2% has come down over time too, even though we don't have interchange and we're not regulated by interchange. The market, we have seen our pricing has come down, and certainly our share of transactions has come down over time as we exited we were providing cards through the banks, companion cards through the banks, and we're no longer in that business.
Yeah, I saw that in your submission as well. Do you, as the acquirer as well, do you fund chargebacks through your...
Yes.
You do? Okay. Ultimately, I just want to ask a few questions more generally about the chargeback system. Who, and forgive my ignorance, who determines the chargeback rules? Is it acquirer by acquirer? Is it dictated, by the schemes? I mean, like who determines what qualifies for chargeback and what doesn't?
So we have a policy that would be shared with merchants, and then if they're requesting a charge back, then that would be managed between us and the merchant.
And your policy potentially could be very different to another acquirer's chargeback.
I'm not sure. I can't comment on others' chargeback policies.
Central guidelines about what, apart from Australian consumer law, are there guidelines about what your policy needs to be, or is it just something that you've developed over time?
So we would be consistent globally, and then obviously, relative to local market dynamics, and that would be developed within American Express. But of course, if there's further details that you'd like on our chargeback policy, we can absolutely take that away.
No, I'm just trying to determine how it's different. So it seems to me that each acquirer develops their own chargeback policy and executes it as per the policy. There's no one saying you have to do this. There's no regulator saying you have to charge back in this circumstance or that circumstance. You just kind of do it.
That's my understanding.
Okay.
Sorry, can you take that on notice?
Absolutely, we'll take it on notice.
Do you monitor fraud within your chargeback policy? Yeah.
Yes, we do.
Could you tell us a bit about fraud within that system?
Since 2010, we've been using machine learning and AI to really monitor real-time fraud transactions and alerts. And we, as a result of that, we've been building on that technology over the time. And as a result of that, we've got some of the, if not the lowest fraud rates in the market. So it's real-time that we're monitoring fraud.
How, in your experience, I'm not asking you to speak across the industry, but in your experience, how often is it a common occurrence that consumers would accept delivery of a product, say they never received it, and then you'd issue a chargeback without verification? What's your processes in that circumstance?
So there's fraud where we're monitoring real-time unusual suspicious behaviour, and we're flagging that early enough before payment is processed so we can intercept where possible. Scans is another interesting area, and scans prevention is where we're starting to see some of this type of behaviour of intentionally saying I never received the goods. So again, we're building out our infrastructure and our technology infrastructure to make sure that we're doing a better job of alerts and intercepting, and always, it'll always be in the favour of the cardholder or the cardholder in terms of if there has been fraud on their account, we will protect the cardholder until we've investigated. If a merchant is saying there's fraud their end, same.
Okay. And from memory, having run a small business in the past, the onus of proof is on the merchant to prove that said product has been delivered, and you deal with each case then, right?
And again, because the merchant is our customer and the cardholder, I think that's probably one I would take on notice to, just to come back and clarify for you the steps in the process.
Okay. Some other submissions have, I guess, criticised the digital wallets and international players for not contributing to the domestic payments network, in particular chargeback being one of them, having to carry that risk. Would you level the same criticisms at digital wallets? Do you believe that they have a role to play in funding our domestic network?
Look, we are a customer of the wallets. It is a requirement from our customers that it's their preference and how to pay through wallets. We've been a customer of Apple, Google and Samsung for some time now. We pay the wallets, correct? Apple.
All of them, or just Apple?
No, Apple per transaction for that. And we expect that the relationship that we have, even though a payment is going through the wallets, is still directly with the merchant. So we will continue to act and advocate on behalf of the merchant in the event of fraud.
Sorry, can we just? How much do you pay per transaction?
I can't share that in publicly, but again, happy to have further conversations behind closed doors.
Okay. It's just that, if you don't mind me
go for it.
Jumping in, I mean, this is the big debate that's going on about either open up NFC with Apple, because they have market dominance. I'm sure they will, like others, come in and say, no, they don't, but they do. So there's two choices. You either open up NFC, when I understand there are issues around technology, or you allow for a better negotiating, as we were talking about the collective bargaining approach. You allow for a better outcome, commercial outcome, where people can negotiate. Obviously, knowing others have been quite upfront about how much they pay Apple per transaction, but it would be good to know from yourselves at some point how much that is, because it's something that we will actively consider.
We'll take that on notice.
Thank you. Sorry, Mr. Luxall.
Oh, I'm fine, thanks, Chair. Well done.
Is that it?
Yep.
Oh, okay. Mr. Gregg.
Thank you. I know there's been a lot of conversations around market share today, and I think the percentages will obviously depend on how you define the market. In terms of card payments, let's say you're just in the industry of credit card transactions. What percentage of credit card transactions, in terms of value, would be covered by Amex?
Back-ending into that, because I understand that some of the schemes have presented that number, which I assume has been, they've taken out their share and applied us as the only three-party model to come up with roughly around about 20 to 25% is the share of spend on credit and charge. But what I would reiterate to the committee is that we are competing in cards, and we are competing in lending. And when you look at that total market, including debit card, a lot of payments are still made on debit. Debit is growing in this market. We are 10% of that share.
So in terms of percentage of just credit card transactions, though, so you've said the 25% is wrong, and that's been quoted, I think, by the banking...
25% of value, I believe, is what has been quoted by the banks. In terms of transaction size, Sarah, can you confirm?
So the
value
fewer
is
$1,000 transactions to more $100 transactions.
Yeah.
So because it's their business high-value clients, they would likely have higher value transactions than most banks on average.
Yes.
So therefore, for you to have a sizable share of market power would require you to have fewer number of transactions. Would that not be true?
I'm sorry, I'm not
sure.
So
because your market share, which is because you charge as a percentage of the value of the transaction, it's transaction value that probably matters more than the number of swipes of the card. So I guess I'm just trying to work out how much value, what is the value of the credit card
So I'll go back to where if we're competing in cards, which is credit, debit and charge.
Oh, I'm just saying just credit cards.
And then we're 2% share of that, and we're 10% share of the value or the spend across the cards ecosystem.
But you don't have the percentage of value just in credit cards, not including debit cards, which you don't play in.
That is what I believe the others have shared with you.
That's a correct figure. I think it's a 2024 figure.
That is what has been shared.
In terms of the accurate number, we'd have to take that away for you.
That's fine, yeah.
Corinne, we view the relevant competitive framework as, at a minimum, all cards, because, of course, when you're paying at point of sale, you're actively choosing. Are you paying with your debit card, your credit card, right? So we're competing in that space, but more broadly payments as well, right? Because there's other payment options available. So we would say that was the competitive market, but of course we can take that figure away.
That would be good. Thank you very much.
Thank you. There are a stack of other questions that I just think with time we might put on notice. And so we'll send those to you accordingly. I just wanted to also, actually, if I may, while I do have a quick opportunity, can I ask, so American Express has indicated you use behavioural signals to identify emerging hardship, and you offer interest-free periods, card stops and tailored repayment. So I guess I've got a few quick questions. What specific indicators trigger proactive outreach on hardship? What proportion of customers in arrears are contacted proactively before they need assistance? And do you proactively review accounts to offer better pricing to low-risk customers, or must customers request a reassessment?
Yes, so we have a very robust hardship program in place, which we have recently just uplifted based on ASIC's recommendations to the industry on hardship, which really required us to be much more proactive in terms of identifying where customers may be in financial stress, outreach, reaching out to those customers, which is actually quite a sensitive call to make, and then applying more curated or customised hardship programs for them. It's not a one-size-fits-all solution because every situation is different. So American Express is proactively identifying and monitoring where we see customers who have missed payment, who appear to have been, who've missed payment for a couple of times, who are calling us in and expressing some concerns about having to pay their card off. That will trigger a review in terms of, is this person in hardship, an outreach to say, are you in hardship, how we can help, and then we will consult with them on the types of hardship programs that are available, whether it's a a break from paying interest is the word that I'm looking for, or whether it is a payment over time type program.
Okay. I've got a couple of other questions. I'll put them on notice.
Okay.
But can I just, on behalf of the committee, thank you for making the effort to be here today, to be able to explain, answer questions, and also to answer any questions on notice as well. Thank you very much.
Thank you very much. Appreciate the time.
Thank you.
Oh, I should say, sorry, the committee secretary will also contact you in relation to any matters arising out of the hearing, and you'll also be sent a copy of the transcript of your evidence, and we'll have an opportunity to request corrections to transcription errors.
Thank you for the time.
Thank you. Okay, moving right along, we will be hearing from Apple. This is two. Yes. Yep. Okay, terrific. I now welcome representatives of Apple to give evidence. For the Hansard record, could you please state your full names and the capacity in which you appear before the committee? Mute. You're on mute, I'm afraid. Still not hearing you. Do you need us to put our AirPods in? Sorry, I had to ask that question. I had to ask. Just trying to lighten the mood. No, we still can't hear you.
Maybe it's an incompatibility issue.
Yeah, probably.
Can we unmute them at our end?
It's not at our end, is it? It's not at our end?
Can they hear
Not
us? Can you hear us?
No?
Yeah, they can hear us.
They can hear us?
Okay.
It still shows mute on our screen that you're on mute.
We've got mute next to your name on the screen.
Mm-hmm.
Oh, here we go.
This is looking promising.
The mute logo's gone.
Testing.
Good.
Let's see.
Yep,
we can hear
It's getting
you.
better.
We can hear you. We can't see you.
Low. Can you hear us now?
we can.
Yes.
But we can't see you.
No vision though. There we go.
There we go.
Excellent. Okay. Everything is going on. Okay, I'm going to do that again. So for the Hansard record, please state your full names and the capacity in which you appear before the committee.
Sean Dillons, Apple Senior Director for Competition Law and Regulation.
Marshall Allshouse, Apple Senior Director for Law for the Wallet, Payments and Commerce Organization.
Thank you. Now, before we proceed, I just got to advise you that although the committee does not require you to give evidence under oath, this hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of the Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. I also need to state that I understand you are appearing from outside Australia and that the Secretariat has provided you with information that this limits the protection offered to you under parliamentary privilege, as this protection cannot be enforced outside Australia. But I don't suspect you're going to be making any wild and heinous claims, so as long as you avoid that, I think we'll be fine. I'd like to invite you now to make an opening statement, if you wish, before we proceed to questions.
Great, thank you. And good afternoon again, Chair, Deputy Chair, and members of the committee. As I just stated, my name is Sean Dillon. I'm Apple's Senior Director for Competition Law and Regulation, and I'm joined by Marshall Allshouse, who's Apple's Chief Legal Counsel for Wallets, Payments, and Commerce. We're excited to have this opportunity to speak with you today about our innovative work on digital payments. Apple cares deeply about Australia, and we've been investing in the country and its people for the last 43 years. Today, we directly employ over 3,000 Australians and operate more than 20 stores. And the developer ecosystem that we support here is particularly strong, with more than 180,000 Australian jobs in the app economy. Over the decades, we've worked tirelessly to enrich the lives of our Australian users through user-centered, safe, and secure products that people love using. 10 years ago, Apple launched Apple Pay with a simple vision: to transform and enrich the lives of our users by providing them with a secure, private, and easy-to-use way to pay with iPhone. We built it on our seamless integration of hardware and software, offering breakthrough convenience and fraud protection while keeping users' most sensitive personal transaction data private. Apple developed and deployed an entire suite of technologies to do this, including tokenization, so you can pay with Apple Pay without ever sharing your physical card numbers with anyone, and all but eliminating the most common pathways for fraud. We also employed a separate hardware chip called the Secure Element, where your most sensitive information is securely stored on your device. Now, we built Apple Pay such that Apple cannot track what you buy, where you buy it, or how much you pay. And we certainly don't accumulate or sell user data. Apple has made and continues to make enormous investments in this technology, and we're proud that Australia was one of the first places we launched Apple Pay, reflecting our deep respect for how Australians embrace innovation, security, and consumer choice. Today, millions of Australians love using Apple Pay to pay for virtually everything, from groceries to train tickets and so much more. They're safely and securely storing their Apple Pay-enabled cards in Apple Wallet, alongside their event tickets, boarding passes, private health insurance cards, access badges, and more. We've also invested with local partners to enable Australian users to use Express Mode for Apple Pay on local transit networks. But the benefits of this technology extend beyond users to merchants and payment institutions as well. Countless Australian merchants, large and small, are now offering Apple Pay at their physical stores, online, and within their apps, streamlining the checkout process and enhancing the customer experience. It's driving increased transaction conversion and deeper customer engagement. Over the past year alone, Apple Pay has generated an estimated $100 billion in incremental merchant sales globally. And we've made unique investments specifically for our Australian merchant partners. We were the first digital wallet in Australia to enable FPOS on dual network debit cards, and we fully support least cost routing, allowing merchants to choose their preferred payment network and save money. Apple Pay and Apple Wallet have also meaningfully enhanced innovation and competition in the Australian payment sector. Traditionally, only big banks had the resources to develop a digital payment option. But with Apple Pay, small and medium-sized banks can access high-quality mobile payment technology without spending the time, money, and resources needed to develop their own. More than 125 Australian banks and payment service providers have chosen to offer Apple Pay to their customers, from Australia's largest banks to smaller credit unions like Firefighters Mutual Bank and startup app-focused banks like Amp Bank and Up. We offer Apple Pay to payment institutions on non-discriminatory equal terms, giving banks of all sizes access to industry-leading privacy and security measures on a level playing field, with no preferential agreements or special treatment. And we've designed Apple Wallet so that users can store and easily switch between cards issued by different banks, simply by dragging their preferred card to the top of their digital stack. This gives Australian consumers more choice. And we've invested massively in the technology that powers Apple Pay. That includes not just the secure element and our integrated platform, but secure authentication features like Face ID, Touch ID, and secure passkeys, alongside enhanced camera and scanning technologies that enable banks to accept mobile check deposits. These kinds of investments afford payment institutions significant savings and a substantial return. They not only save money by managing fewer physical cards and benefiting from the growth of more efficient digital channels for customer engagement, more importantly, they also save money due to the near zero fraud rate on Apple Pay. By our estimate, Apple Pay reduces fraud losses by well over $1 billion annually, saving banks substantial sums. And with our NFC and SE platform, financial institutions can now offer contactless transactions in their own apps on iPhone, separate from Apple Pay and Apple Wallet. Using the same seamless and secure underlying technologies, we're looking forward to seeing what they can build on top of that platform. Alongside these benefits, I'd like to take a moment to address the regulatory landscape.
And
Just
Mr.
last
Dillon,
year...
Sorry, Mr. Dillon, to interrupt you. If you're able to do that in a relatively quick time, we might be able to explore some of the other points you intend to make through Q&A, if that's okay.
Let's finish up.
Finish this point that you were about to begin, by all means, but if we could be brief, I reckon we'll have a good discussion.
Great. As you know, Parliament granted the Reserve Bank of Australia new powers with respect to digital wallets, and we understand the Reserve Bank will be exploring whether and how to deploy them. Apple supports appropriate oversight, and we appreciate the opportunity to engage in these processes. Apple should allow these existing regulations to take effect and see how these processes play out before adding additional laws and regulations to the mix. Otherwise, there may be unintended consequences, including a heavy-handed regulatory regime that could stifle innovation and benefit only dominant incumbents. So we respectfully urge that you focus this inquiry on the real structural changes in the Australian market that genuinely limit competition, especially the high levels of competition in financial services. So Apple is committed to Australia. We're proud of the contributions we've made, and we'll continue investing in innovative technologies that benefit our Australian users, our merchants, and financial institutions alike. And we look forward to your questions. Thank you for allowing us to make this statement.
Thank you. And I have to say at the outset, I very much respect the fact that Apple has fronted. You've done better than your competitor Google, who has chosen not to put anyone forward to talk. It's hard being a behemoth these days to find the people to do the job, but be that as it may, you have fronted, so thank you for that. And I've also recognised early on, when I was agitating 10 years ago for Apple Pay to be used widely, because you could see, and I mean, I'd raised this issue with the RBA literally 10 years ago about the fact that we would go increasingly towards mobile. I just didn't imagine, I guess this is where the love ends, I didn't imagine it would become so widespread that there is incredible market power that is held by both Apple and Google in this space. The issues that have come before us, you've got a lot of banks, and we have grilled them at length this morning, but obviously the big gripe that the banks have is you don't open up NFC, and I can understand the arguments as to why you do that, but you don't open up NFC, and you won't budge at all on the amount you charge in terms of fees yourself on the way through. So, I mean, we haven't, as a jurisdiction, had any problem in dealing with overseas tech where we believe that market dominance is presenting an issue in our market. So why is it that you don't move on both those elements in the way that you're being urged to encourage competition?
So thank you for that question. Let me take a shot at that. So Apple faces direct and relentless competition in every market in which we compete. We compete every day. It motivates us to create better products. And I think that's also the case when it comes to digital payments. If you think about, Apple Pay and Apple Wallet, this is something that we're incredibly proud of. It's very popular with users, but it's one of many options that are available to the banks in terms of payment. Sure, we have Apple Pay and Apple Wallet. Obviously, there are alternatives on existing devices. There are options for banks to do this within their own apps. In certain payment technologies, QR codes are something that's been used. But even after 10 years, with Apple Pay, at the point of sale, most payments today are made using physical cards. So I think we see competition much more broadly than just NFC-based payments. In terms of fees for Apple Pay, we have never increased our fees after a decade. And that's despite the fact that we continue to invest in Apple Pay. We continue to make new features available. Even I think that's a good thing. After a decade and more banks using it, we've expanded our investments in it. We haven't increased the price of Apple Pay. I don't know if Marshall can say anything.
But before Marshall goes on, I think that the issue is, Mr. Dillon, that the view is that it's a take it or leave it, that the fee is very high and that it's a take it or leave it approach and that there's no negotiation on that.
I'll jump in here on this. With respect to the commercial model that we have with Apple Pay, we believe it is a rational commercial model. It is built on the revenue that the partner makes, the value that we're delivering to the partner, and then the costs that we incur in building and maintaining the platform. And I think you could see that through several different things. First of all, we talk about the decreased fraud. That is money that the banks save. It is a direct financial benefit to the bank, and that is a tremendous value that we're providing the bank. You also look at the increased transaction conversion. We mentioned $100 billion in increased transaction conversion last year through Apple Pay. Again, a direct financial benefit to the banks. So we look at Apple Pay and we say that we have a rational commercial model because we're delivering this great value to the banks. We also deliver it to the merchants and then ultimately to the cardholders. So we see Apple Pay as a benefit to the entire Australian payments ecosystem.
And if I could add to that, we have this standard global fee structure because we want the small banks to be on the same terms as the large banks because we are enabling competition from these smaller banks. Oftentimes, the larger banks will come to us and say, hey, we want a better deal. But the way that our model works is we want to treat everybody the same so that the smaller banks have an opportunity to compete on the same terms as the larger banks.
But I think it'd be hard for people. I just need to sort of push back against the assertion that you have so much competition in this space, particularly the advantages that have been given by the availability of the NFC chip in an iPhone and how much iPhones have been taken up. I mean, there was a time where another bunch of people said that their offering was way quicker, was way safer, was way more cost-effective, and that intruding on them would be wrong. And it led to the first ever antitrust action in the US when railroads were arguing the same thing years and years and years and years ago. I mean, why is it that Apple, with its market dominance, should not be dealt with respect to this take it or... It is genuinely seen as a take it or leave it approach. You charge that money per transaction and you will not allow access to the NFC. Like, why should that be sustained? I'm not saying Tim Cook's a Vanderbilt, but,
I wouldn't characterize it that way. I think we see things a little bit differently. Again, I think banks really do have options, including one of the options I've actually put together is, we have Apple Pay and access to the NFC through Apple Pay and Apple Wallet. One of the things that we heard from banks and developers that they wanted another option outside of Apple Pay and Apple Wallet, and that's something that we created with this NFC platform. And that is now an alternative that we have made available to banks. So that's an option that they can have as well.
So sorry, if I understand, sorry to interrupt you, but if I understand that correct, so if a licensed Australian payment service provider wanted to launch a competing tap-to-pay wallet on iOS, does Apple have the ability to approve or refuse that access?
Well, we do have, of course, rules in place to make sure that, for example, we have rules in place to protect privacy, to protect security. We want to make sure that developers that are granted these, what we call entitlements to get access to these things, abide by those rules. But yeah, I mean, if a developer is willing to meet those rules, they will be, they will qualify for this and we will approve them. I mean, we have every interest in making sure that users have as many choices available to them on our platform, and that includes payments on iPhone. So that's why we've created this NFC and SC solution alongside of Apple Pay and Apple Wallet.
Okay, I might hand over my questions either to Mr. Violi or Ms. Jarrett.
Mr. Violi on the line.
Yeah, I can jump in. Thanks, Chair. I just want to continue that line of questioning and understand there's the banks and payments, and we can define, as we've heard a lot today, Australia is the most competitive economic system in the world. Sarcasm deliberately there for Hansard because everyone defines it as they want to. But obviously the iPhone is a key part of this. Understand it is not part of the payment system, but it's linked to it, and particularly in a startup world, tech startup environment. I spent some time at a tech startup prior to politics, and we literally, to offer consumers what they expect, you have to partner with Apple Pay. It is a standard expectation in the market. So how do you protect the ecosystem and the consumers given this take it or leave it approach?
Our whole view is to do everything we can to enrich the lives of our users, and we do it through the hardware and the software that we make. And when we look at Apple Pay, what we did is we created a secure, private, and easy way to transact. We wanted to deliver that benefit to our users. We built it in a way that it would complement the existing payments ecosystem. We don't want to get in the middle of the relationship between the banks and their cardholders. And so we created this digital platform for the banks that they can use that gives them an increased reach into their cardholders and provide them with this safe, private, and easy way to transact. That's what we've done. And we have over 125 banks in Australia on the platform that are taking advantage of that. And so we look at what we've delivered as a net benefit, a significant benefit to the Australian payments ecosystem.
No, absolutely. Apple Wallet, I understand. I use it myself, but I'm more talking about Apple Pay in the sense of, Uber's probably the big end, but if you're a small tech startup wanting to create Ritual, the company I used to work for example, we were allowing consumers to tap and go with their coffee, et cetera, et cetera. So we were required to have Apple Pay as an expectation from the consumer. So this is not about payments. This is about the iPhone and the market dominance you have that you're now parlaying into other opportunities. Apple Pay, great product, but let's be honest, if you didn't have the dominance in the iPhone sector, would it be a must-have? No. So I'm just trying to, how do you look at that challenge, to go to the chair's point around the dominance you have in the phone sector, which is then parlaying into other services like Apple Pay and then bleeding into payments? And how do you ensure you're getting that balance right for consumers and for our country, which is what we've got to make decisions on?
So look, we're very proud of the fact that we've created a device that users love and it's very popular. But I think that we would look at this differently.
Respectfully, and I don't mean to interject, businesses can't look at it differently. You might choose as Apple to look at it differently. We as lawmakers and regulators can't look at it differently because businesses and consumers don't look at it differently. And I know that for a fact because when we were making business decisions, we had to consider the connection between iPhone uptake, apps that we were creating and services we were creating that would be hosted on an iPhone, and consumers expecting Apple Pay as part of that market dominance. So I guess Do you not see that connection at all? And if not, I must say that's quite concerning if you don't understand the market power that you have with the phone, which then links to Apple Pay.
So I think that we have a very popular device. I would respectfully disagree with the idea that it's a dominant device. We compete in we can compete relentlessly with a number of Android devices. It's a very competitive market. This is why we need to invest significantly in research and development. Every year we're offering a new device constantly with new features because competition is fierce. Having said that, we are very proud of what we've created, and that is something that we will continue to do. I think if you look at Apple Pay, it's part of our device, and it's a differentiating feature, and we offer significant value to the bank. So we don't look at this as it's something that banks or users must use. It's something that we've created that is easy to use, safe, and secure. That's why it's popular.
And we continue to invest in the platform. That's the other thing. We want to make sure that we're delivering value, and not just value to our users. We want to deliver value to the entire ecosystem. That's why we're looking at things like enabling FPOS. That was a significant investment on our part to make sure that users are able to use the cards that they carry with them, including their FPOS cards, and have that same experience on the platform. We were the first digital wallet to enable FPOS with co-badge cards. That benefits the merchants. It gives them the ability to route transactions in the way that they want to, that directly saves them money. So we continue to innovate. We continue to look for ways that we can deliver value and improve the entire ecosystem.
So you mentioned before that 125 banks have signed up to Apple Wallet. How many of those banks have sought permission to use the Apple NFC chip?
That's an interesting question. I don't have the data in front of me, but I do know that there are numerous developers in Australia that are in the pipeline working on getting onto the NFC NSE platform.
And is there a cost involved for the banks to sign up to the NFC?
There is a commercial model that underpins the NFC and SE platform. Again, that model is based on the value that we're delivering to the banks. There are fees that we incur as a part of offering that platform. Likewise, there are services that we provide to the banks as part of that platform. And so we have a rational commercial model that applies to the platform as well.
And last question, Chair, just the EU is obviously regulated to open up the NFC technology at no cost, and banks have clearly taken up that opportunity. So there is a way you can provide it at no cost in the EU. Why would that not apply if we went down that path in Australia?
So one of our priorities at Apple is on creating experiences on iPhone that are safe and secure for our users. And we provide NFC access through Apple Wallet and the recently introduced NFC and secure element platform in a managed and secure way. This implementation that we have includes the secure element chip where the most sensitive information is contained. Now, the host card emulation solution, which I believe you're referencing in Europe, is a result of specific regulatory requirements in the EU. HCE is very different from what we've built with Apple Wallet. HCE relies on software to store and process payment credentials, making it susceptible to hacking, and perhaps Marshall can provide more details on this, but it is not the safest or most secure way to make payments. So, unfortunately in Europe, this is an obligation that we have. This interoperability obligation free of charge in Europe, which I should also say that we're challenging legally. But we don't think that because there is a much safer solution, it's not something that we'd be interested in doing outside of Europe.
Yes, our focus is on delivering our users the most secure way to pay with our devices. And the NFC and SE platform and Apple Pay provide that. It is much more secure than the host card emulation model. And that's because the credential in the HCE model is stored in the cloud. It is then transmitted to the application processor, which is the main chip on the device. It introduces several vectors for fraud. Whereas with Apple Pay and the NFC and SE platform, the credential lives on a separate chip. We look at payment credentials as some of the most sensitive data that our users have. And so we've actually put in a separate chip, the secure element, on our devices where that data is stored. And so for us, we want to continue to give our users the most secure way that they can pay.
Thank you for joining us today. I just want to follow up on questions from both Mr. Husick and Mr. Violi. You'd mentioned in your response that users who qualify can use the iOS system, I assume. And is that the Apple NFC chip? I just want to be really clear on what we're talking about here.
Yes, that's correct. It is the NFC and secure element chipset that we have in our device. That's correct.
Okay. So how would one qualify to be able to use that?
Yes, there are a series of technical integrations that have to go into building this. We want to make sure that the developers are able to provide a secure system and to make sure that our device maintains its security, and we don't want anything to compromise the integrity of the device. There are also several standards that have to be met, such as the EMB code standard or the applet, which is where the credential is stored within the secure element. So there are different technical implementations that the developers have to build, and then it has to be certified by a third-party testing lab. Independent third-party testing lab. And so the things that the developers have to build are the same things that we have in Apple Pay. So it is a very similar and consistent architecture that the developers have to build towards.
So if I'm a potential user of that product, how easy is that for me to do? Do I have to engage all sorts of IT specialists to help me work through all that? I'm just trying to get a sense of how open this is for users.
For developers, yes, it is. It's consistent with other app development that there are technical specifications that developers have to meet. I will say though, there's also going to be enablement services. So there will be other developers out there who will be able to help enable developers to create their own app that leverages the NFC and secure element platform.
And do you have a sense? Sorry, yes, please go on.
I'm sorry. Just wanted to clarify. Yeah, we're talking about the developer side. On the user side, it's very easy. On the user side, it's just using the app, or if they're using this NFC and SE solution, or if it's just opening Apple Wallet. It's very simple for the user.
But you said they had to qualify, so now I'm confused.
The developers have to qualify, not the users. I apologize. So yes, the cardholders, similar experience as with Apple Pay. Nothing that they have to do. Yeah.
So it should be fair. So can we assume, therefore, that the ability for users to access NFC, Apple chip and the Apple system is very straightforward and therefore open to, general consumers?
Yes.
Okay, thank you.
Exactly.
I just wanted to clarify. Thank you. And in your submission, you said it's really important to focus on the real structural changes that limit competition, and that's part of what we should be looking at. What are those real structural changes that you see that are limiting competition?
When we look at the competition in the Australian market, I think one of the things we look at is just the concentration of the power of just a handful of banks. And so I think that there needs to be, well, I don't want to put myself in the position of a legislator or regulator there. I do think, though, that it is not good for the market to have just 4 banks that control or dominate that entire market. That there should be, and especially when those banks are agitating on things like not having to pay fees when they're reporting record profits. So we think that there's something there that needs to be looked at. Those would be the things that we would encourage you to take a closer look at.
And so therefore,
man, I'd be careful as a $1 trillion company making those calls. But that's your that is your choice, my man. That is your choice.
We're not complaining about the cost it takes for us to run our business.
So are you therefore like talking to the next tier banks and starting to organise, getting them on board with your products?
I'm sorry, I didn't follow the question.
Are you now working with, having discussions with other banks? So you criticise the other, so beyond the big four banks, we have a number of middle tier banks, smaller banks. Are you working with them now to bring them into your fold, so to speak?
Oh, they're already on the platform. So the platform is open to all banks in Australia and fintechs on a level playing field. And we have over 125 issuers on the platform in Australia. And that's what we want to do. We want to see whatever cards our users are carrying out there and ways that they're transacting, we want to be able to provide them an experience that is safe, easy, and secure using our devices. So we absolutely want to bring in as many banks as we can onto the platform.
And that's why we think that Apple Pay and Apple Wallet are great for competition. I mean, we've built this technical architecture for secure digital payments, which many of the smaller banks wouldn't be able to do on their own. And they have equal access, the same access the larger banks have access to in Apple Pay and Apple Wallet. Their cards are also presented right alongside the cards of the big banks. So if you're a user, you can choose the cards from the smaller banks, from the larger banks. It's really up to the user. So we provide that choice through Apple Pay.
Okay, one last question. Understanding that all the banks all get treated exactly the same, they've got the same fees. How much did Apple make in fees in Australia over the last, let's say last financial year?
I don't have that information, and likewise, we don't look at it on that. That's not the way we report our information. But I can take that back and see if we can't get that
Appreciate if you take it on notice. Thank you.
Okay, Ms. Campbell.
Thank you, Chair. Thank you very much for giving evidence today. And the thing that's come up a lot in submissions and evidence that we've heard already is the concern from other players in the payments field have about multinational companies with respect to two major things. Firstly, a lower form of regulatory scrutiny, which is something that they argue. But the second is less of an investment in payment infrastructure. So given that that's been raised by those banks, would Apple be willing to invest in some of the payment infrastructure that sits around its ability for Apple Wallet to operate?
We believe we've already contributed significantly and continue to contribute significantly to the infrastructure in Australia. Apple Pay was built to supplement the existing infrastructure and to provide more security, more privacy, more ease of use. And you've seen that through a lot of the technology that we have brought to the market. Things like Touch ID and Face ID. That's a way to authenticate a transaction to make sure that it is indeed the user and the cardholder who is making that transaction. The banks also use that. Yes, please.
Sorry, I was going to ask, can you outline what specific investment that you've made into the Australian payment infrastructure space, other than things that would have just already existed for your other markets?
FPOS, bringing FPOS onto the platform, making sure that least cost routing is supported through mobile wallets. That wasn't done prior to Apple Pay and us enabling them. And that took a significant investment resources by Apple in order to do that. So that's one example of where we have invested in the Australian infrastructure.
And I think it's also important to remember Apple Pay is a technology platform. It's not a payment or a financial service. Apple doesn't issue cards, it doesn't authorize transactions or process payments. We don't have access to users' funds or money. So those functions still remain with the bank. So we're very different from the financial institutions.
And beyond those initial setup costs that are, designed to make the technology available on a whole range of different platforms, what investment do you see in the payment system going forward in our jurisdiction?
Yes, we're constantly innovating. We're looking for ways to make it better and to deliver more value to the banks. And so, we mentioned FPOS. We have been investing in in-app provisioning, which is another secure way for cardholders to provision a card into Apple Pay by going into the issuer's bank app. And so the bank has authenticated the issuer there within the app, and so they know that they can have a secure provisioning process into Apple Wallet. So things like that, which also it's a great example of how we're promoting the digital reach of the banks to their cardholders by, again, driving traffic to the financial institutions app. So we'll continue to invest in things like this where, again, we're delivering a secure, private, and easy-to-use solution that benefits the banks, benefits the merchants, and ultimately benefits the cardholders.
In one of the earlier questions, you were asked around why Apple charges for the use of Apple Wallet. You called it a rational commercial model. I was going to ask, in relation to that, if that's a rational commercial model, what do other wallet providers use then if they're not using that same model you're using?
So some other models may choose to monetize differently. Other models may monetize through the use of collecting consumer data, tracking users, and using it for targeted advertising. That's, at Apple, we think privacy is a fundamental human right, and we wouldn't do that. That's not something we would want to do. But that's another way that, digital payments have monetized, other companies have monetized digital payments.
So are there any other models, or is it just essentially you charge for the wallet or you sell people's data?
I'm not aware of other models. There may be some that charge merchants or ultimately charge users. That's not our model. Again, our focus is on looking at where value is delivered, and we see significant value, financial value delivered to the issuers through decreased fraud and increased transactions. That's the other thing I think that's really important to point out is that an Apple Pay fee only accrues when an action is taken that directly benefits the issuer financially, which is a transaction. That's when a fee accrues. And so we again view this as we should have a commercial model that drives a benefit to the issuers, and at that point is when we would be entitled to a fee.
And the last question I had was, understanding that, you're saying that you don't collect data from individual transactions. Do you collect aggregate data? And what sort of aggregate data do you have that could point to, for instance, challenges in the small business sector or challenges in a particular, industry or market?
Yeah, privacy is a central component to Apple Pay. We want to make sure that the user's data, it's their data. They should know what it is that we would be collecting, and our approach is minimize that data. Only get the data that we need in order to deliver an amazing service. So to your point, we collect aggregate data only if it's to help us understand the performance of the platform. We don't know what you bought. We don't know where you bought it. We don't know how much you paid for it. We don't want that data. We don't need that data. But data with respect to performance, that we'll look at.
No, understand. I guess my question is more around, whether your aggregate data, or aggregate trends can pick up, things like what is happening to the small business sector, at a particular time, or things that are impacting on a particular industry at any one time.
Yeah, I don't think we have any visibility into that.
Thank you.
Thank you very much. So, as I understand it, your business model doesn't, can facilitate competition between issuers because you get your money in any event. You get the same amount of money, irrespective of whether it's an FPOS or a Visa debit through Commonwealth Bank or whatever. It's all the same at your end, isn't it?
Yes, and the value that we're delivering is the same. That's why it's a rational model in the sense that the banks are deriving the same benefit in terms of decreased fraud, increased transaction conversion, deeper reach to their customers.
So with that fantastic value, why are all the banks really keen to get direct access to NFC then?
I can't speculate on that. Again, our focus is on delivering the best product that we can, and we'll continue to do that. We think the NFC and secure element platform is a great option for them as well, and look forward to supporting them in any banks that want to launch their own app, leveraging the platform. We're all for it.
So
ultimately, we give value to our customers. We want to make sure they're getting the best experience, and we will support that all the time.
So, as I understand it, the pricing rules prevent banks from charging more for the use of Apple Pay vis-a-vis other forms of payment through their phone. Is that right? So even if they develop an NFC secondary platform, they can't charge me less for transacting with that payment method versus using Apple Wallet or Apple Pay.
I'm sorry, I didn't follow the question.
I'll put it another way. So you can't charge your customers a fee for using Apple Pay as an issuer, can you?
That's right. The fees are paid by the issuers, yes.
So play it the other way around. Can the issuers offer a discount for using a different form of payment within the phone? So let's say that they choose the NFC platform and they charge 1% less for each transaction through that NFC platform. That wouldn't be against your terms. Isn't it?
That's fine.
Aren't those two the same thing? Paying more to use Apple Pay, paying less to not?
Yeah, I don't see it that way. But
so as long as you call it a discount, they're covered. I think the banks would be very relieved by that. So generally, you were talking about market competition before. One of the kind of telltales of market dominance is the fact that you don't need to negotiate the terms of your contract with your customers. So that would be an indicator that you are in a dominant market position. Would you not acknowledge that?
I would disagree with that. I think when we look at the way that we've structured this, again, it's more about making sure that everyone is on the level playing field. With the small banks are paying the same small banks are paying the same fees as the larger banks. We're trying to enable competition, not reduce it. And I think by having a standard fee, that means everybody's paying the same terms.
And so does the fact that aligns with economic self-interest just a coincidence? Like, it sounds like it's a business decision that you know that you've got a market position that the large banks have to take you on to be competitive in the market. Whether they like it or not, they'll have to pay as much as the little guy. They're used to getting discounts and special deals because of their market position in Australia. But when they go to Apple, the big global competitor, they're like, well, you need us. Therefore, they'll pay what they have to pay to be able to be on Apple Pay, wouldn't they?
I think that the banks joining Apple Pay, I mean, this is a choice for them. And, some banks have decided to participate, others haven't. It's really a choice. They have options. And if they have, if they want to join, participate in Apple Pay, again, we have standard terms and we think that's actually good for competition.
And then we'll continue to deliver value to them. And again, that's where we see it. Fraud reduction in Australia through Apple Pay, we reduced fraud in Australia by 77%. That is a direct savings to the banks. That is a huge benefit to the entire ecosystem in Australia that we're delivering.
And if you think about the fees that are charged, there's public information available. It's a very small proportion of what they pay for digital services. The fees that are paid for Apple Pay, it's very small. I'm sorry, fees for digital payments, it's very small.
So you're talking about, so I think it was 2024 or something where the NFC secondary option came up. So how many alternative, wallets or versions of payment are now available to consumers in Australia because of that change?
I don't believe there are any at this point. We know that there are developers in the pipeline, but this does take time to develop this app and to build on the platform. And we have developers in Australia who are well down the path to doing that.
And we're confident that we're going to start seeing some developers offering solutions on that NFC and SC platform.
Along with enablement developers as well. And so we'll be seeing that very soon.
So within the next 2 years, 30 years before I retire?
You got heaps of years.
We think
So with the advent of the secondary NFC, would regulations similar to those in the European Union, which require access to a general car platform, are some of the risks you discussed associated with the European approach mitigated by the fact that you now have this secondary chip? If a similar thing were to apply, but only to the secondary chip?
I'm sorry, I don't follow the question in terms of the European Union.
So you were saying that you have to have a kind of default card option, I think, and you have to make it available for free in the iPhone over there. But that's created security risks through software issues, as I understand it. Is the fact that other organisations can now facilitate payments by a second NFC chip, does that provide a means of enabling that goal to be achieved of the European rules without the same technological risk?
So the NFC and secure element platform that we've been talking about relies on the same underlying technology as Apple Pay and Apple Wallet. So again, it's very different from the HCE solution, and it's much more secure and much more private than the HCE solution that we've had in Europe.
But the policy goal, but the policy goal of having a lower cost option available to tap with is still a possibility as an alternative to Apple Pay.
In Australia, it would be through the NFC and secure element platform. Yes, that policy goal is met through the platform.
Okay. Thank you.
Ms. Situ.
Thanks very much, Chair. I understand that there have not been any Australian payment banks or payment systems that have developed their own NFC or put their own version of Apple Pay up on an Apple phone just yet. But are there international examples? So what are your competitors to Apple Pay on an Apple phone at the moment?
We have several competitors around the world. There are many payment options that are available through QR codes, through Bluetooth, that sort of thing that are available within iOS. When talking about the NFC and secure element platform, we have hundreds of developers in the pipeline that are building their apps, and we expect to be seeing apps launch very soon on the platform.
Right. Okay, but no apps that are currently available for use.
That's correct.
Okay. So can you step me through that process very simply? If I were a major bank and I wanted to develop my own version of Apple Pay, can you just step me through what they would need to go through and at what stage Apple as a company would need to open the next stage gate for that process? And then where are the fees charged during that process?
We'll start with the last piece. Fees aren't charged until it's launched and consumers are using it. So again, the fee model is such that it's based on usage. It's not, they would have to launch and people would be using it.
So there's no fee prior to that, prior to consumers using it. Okay, so there's no fee to put it on the Apple Store or put it on. Okay.
That's correct. And then prior to that, at just a very high level, the steps are you have a non-disclosure agreement. We then hand over the technical specifications so that they can understand what it is that they have to build to. And they then get access to our SDKs so that they're able to start building. They will have to develop or license their own applet. An applet is a container, more or less, that lives within the secure element. And that is where the payment credential ultimately gets provisioned into. That applet then has to be certified by an independent third-party lab. And then once they get that, then we are ready to let them launch their app.
And where is the approval process from? So I'm just trying to figure out along that chain that you've described, at what steps does Apple say, yes, keep going ahead, no, you cannot be on our phones?
That's a great question. I don't know all the specific details of when we review what it is that they built, but we do have an objective process in place to see what they built and to ensure that it meets our standards. But I can take it back and give you the specific information of each checkpoint that Apple has within the process.
And given we don't have any live examples just yet, I would be curious to know the number of applications, for want of a better term, that have been rejected, and what is the reason that it has been rejected?
I don't have that data in front of me either, but I can take that back and get.
What I can add to this is that I know there are apps or there are financial institutions that we've approved. It's really just a question of them developing that app, and but we've approved them, as far as we can, to the point where they're in the pipeline for taking apps.
And my final question before handing over is, if it is your hardware, your software, and that you ultimately are the approver for whether or not these apps go on your phone, what are you doing to make sure that this is not an anti-competitive process in any way? So if, for example, Google were to create their own Google Pay that they want to put on an Apple phone, would you have a mechanism to stop that, or would you allow that through? I'm just interested in what steps you are taking to make sure it is not anti-competitive, given that you, in some ways, control the entire environment of how these kind of mobile payments would happen on an Apple phone.
We at Apple think competition is a good thing. We think giving consumers choices is a good thing. And so we have every incentive to make sure that those consumers have as many choices as possible. And those choices include issuers and banks and the payment mechanisms that they make available on our platform. So we have an incentive, because if we don't make those choices available to users, they won't use our products. Our products won't be as attractive to them. I think if you look, for example, on the App Store, on the apps that we have available, we have our own apps, but in every single category where we have our own apps, there are dozens of other apps available to users on the App Store. And in many instances, those apps are much more popular than our own apps. Again, we have an incentive to give you as many choices as possible. And I think if you look at the track record, we have that incentive, and we will continue to make our platform available to developers.
Thank you.
Thank you.
Thanks, Chair, and thanks for your evidence today. I mean, obviously you'd understand the context of this inquiry. I think many members here are seeking to address cost to consumers for using digital payments, and obviously cost to small businesses. And I think by virtue of your business model, you're a part of these costs, and seemingly an immovable part movable part of those costs. So just on the fee that you charge Australian banks, is that like a flat fee? Is that a fee per transaction? Is it a flat fee per transaction? Is it a percentage ad valorem? What do you charge Australian banks?
Yeah, without getting into the details of the commercial model, because it is sensitive, confidential information, it is based on each transaction so there is a fee that accrues at a time a user makes a transaction and the bank receives a direct financial benefit.
Okay, so it's a percentage of the transaction value.
That is correct.
Okay.
You can't tell us what percentage.
Yeah, what is that percentage?
Again, that's confidential information, so we're unable to disclose them.
Do you charge that fee in Australian dollars or US dollars?
That is charged in Australian dollars.
Okay. And so you charge on every transaction, you charge a percentage of that transaction. So, on $10, it would be a small amount. On $5,000, it would be a much larger amount. How do you explain the cost differential there, given that you're providing essentially the same service for a different value?
I don't see it the same way. Again, our model is based on the value that we deliver. And so again, we see a direct financial benefit that the banks get through using Apple Pay, and it's through reduced fraud, it's through greater transaction conversion, it's through a deeper reach that they have, a digital reach to their card holders. And so when you look at that, plus the investment that Apple has made in building and maintaining and innovating on the platform, that is the basis for our commercial model.
Right. But for a set, I mean, I would imagine, I've heard in other evidence, the data movement required for $10,000 is essentially the same as $1. Yet this ad valorem fee that everyone charges, to be honest, I mean, you're not alone here, scales up in two ways. Obviously, the larger amount that you use, but also as inflation continues to rise, the revenue you're getting is obviously larger, the larger the transaction value is. So how can you justify that for a mature payment network system that essentially just piggybacks off the back of domestic issuers?
Yeah, again, I don't see it that way. I think we're delivering this value, and the value that we deliver increases. The more people use it, the banks and merchants, and in particular small merchants, are seeing a greater benefit from that. Decreased fraud has been significant. I mentioned the 77% that we've decreased fraud. When you look at e-commerce transactions, we've decreased fraud by 90%, over 90%. That is something that is, again, a direct, tangible financial benefit, both to the banks and also to the merchants, in particular small merchants.
So for us, you've opened up your NFC, just to correct me if I'm wrong, you opened up your NFC to Australian applicants. There's a process they need to go through. I think you've established in evidence that none have been granted to banks as yet. Do you charge a fee to access the NFC here in Australia?
There is a commercial model that underpins the NFC and SE platform. So yes, there is a fee tied to that. Again, it's based on the same principles of, are we delivering value to the banks, to the app developer, and then the fees accrue based on those benefits being delivered.
And is that just
clarify,
yep. Go on.
I was going to say, we have actually granted access to banks. It's just they're in that pipeline developing their apps.
Sure.
So we have actually.
As we stand, there's no one that has access to your NFC today in Australia. From a bank perspective.
They haven't created their app, their product yet.
They haven't launched it yet.
Yes.
Yeah.
And so that bank, or they pay, is it an application fee, or is it another per transaction ad valorem fee?
Again, the fee structure is based on transactions. It's based on some sort of action that's being taken that directly benefits the bank. So no, there's no application fee or setup fee or anything like that. Once again, it is based on the cardholder taking an action that provides a direct economic benefit to the developer.
And so, correct me if I'm wrong, but in Australia, to access your NFC, a bank would need to pay an ad valorem per transaction fee to have access, and then also pay an ad valorem per transaction fee for the purchase, or am I getting that? There's 2 fees to access your NFC? No, okay. No, okay, just the one. All right, great. And does one substitute the other, or is it they sort of bundled together? Is access to the NFC more expensive than just partnering with you as they do now?
So they're separate, so it's not a bundled fee. The commercial model is separate for each of the platforms, the Apple Pay platform or the NFC and Secure Element platform.
Okay.
And so it is based solely on the activity that the bank and the cardholders have on each respective.
Is one more expensive than the other?
For the financial institutions, the fee on the NFC and Secure Element platform is less than the Apple Pay fee.
Okay. In Europe, do you charge a fee for a financial institution to access your chip?
It depends if they're doing it through Apple Pay and the same similar, financial supply there. If they're taking advantage of that less secure HCE solution that is, as I mentioned earlier, is a function of the DMA and the obligations that we have in Europe, they would not have to pay a fee. That is correct.
Okay, and was that a decision that you took, or was that regulated?
No, that is regulated, and it's something that we think we should be able to charge for those innovations. So this interoperability obligation in Europe is something that we are challenging.
Do you have evidence of increased fraud using that, in your words, less secure model?
So we don't have access to the data, to the fraud data. That would live with the developer. So we don't have any insight to that. But again, we do know that it is a less secure platform. And I think one of the telling signs that it is that the European Commission is actually in the process of putting together legislation and regulations related to digital IDs and the digital euro. And in both of those initiatives, they are mandating that those credentials reside in the secure element. So they're actually looking at these credentials and saying, these are super sensitive. They can't go on the HCE model. They need to live in the secure element.
How did it come about that you offered, in your words, a substandard product to the European Union? Like, why did... Yeah, explain to me how that came about.
It's really a function of what the Europeans wanted and what the law requires.
They wanted a worse product, did they?
I think that I can't speculate on what Europe wanted. I can only tell you where we landed with the technology.
Did you give them a poorer product just to get it over the line?
I wouldn't say that. I would say that we think that the solution that we have with respect to Apple Pay is a better solution and much more secure, private than the HCE solution.
Right. So again, explain. Sorry, I interrupted you. Explain how they ended up with a poorer model.
Again, it's the HCE solution is a software-based solution. It does not require, does not have as part of that implementation the secure element where the very sensitive information is stored. That information is stored in software in the cloud, so it's much more susceptible to hacking. So it is, in that regard, it's much less secure.
Yeah, but what I'm trying to understand, they obviously didn't ask for a less secure solution, right? Like, did you negotiate down to a poorer version to meet their requirements? Like, they wanted access to the NFC, and did you come up with a poorer product to get them access to the NFC? Like, I don't understand why they would accept a poorer version of your product.
How did this system evolve?
Yeah.
I can't speculate on what the European Commission was thinking, other than this was something that they mandated that we provide.
And you had no role in negotiating what system that they accepted?
Again, this is the solution that the European Commission wanted.
Interesting. You mentioned choice a lot, that, banks have choice and consumers have choice, but we've got evidence from the banks only this morning saying that they don't have a choice when it comes to offering your product. We've got evidence from small businesses that they don't have a choice in accepting digital payments. Do you think you're more able to charge and sort of be non-negotiable on your fees because the banks don't have a choice in offering your products?
And to be clear, sorry, if I can jump in, sorry, Mr. Dillon. So Mr. Laxale put to the banks, could you drop the Apple Pay offering or words to that effect? And they just said no, they couldn't. I mean, that is a sign of market dominance. Along with the additional examples just provided then of that. So sorry, can you just answer, Mr. Given that context, I think it's important to have that in answering that question, which is around the negotiation of the fee per transaction, I imagine it was, right?
Yeah, just like, are you able to sort of be non-negotiable? I mean, a lot of complaints from you mentioned small banks. Small banks complain about the lack of ability to negotiate with you. You say you're helping small banks, but they've got a different story. You've got CBA complaining at the lack of negotiability in your skills, in your fees. Are you only able to be pretty strict on your offering because you're a must-have?
I don't see it that way. I think if you think about the value that we're creating and delivering to the banks and the fees that we charge, there are very small, there are very modest costs to what the banks are actually paying. I think if you go back to when we launched Apple Pay, we had no issuers. We were just a new entrant. Our fees haven't increased since then. Our fees have remained the same. And part of the reason is because we want to encourage banks to make their cards available to the users. We don't have any interest in creating a platform that, from an economics perspective, is not attractive to the banks. So we have that interest. So we have never increased our rates, despite the fact that we continue to invest in Apple Pay and offer new features. So the fees have stayed the same. We continue to invest in it.
If your fees are the same for every bank across the world, is my understanding.
Yeah, can I ask, does the Bank of America pay exactly the same transaction fee for Apple Pay as the Commonwealth Bank of Australia?
Again, that's business sensitive information. I don't want to disclose that information.
Sorry, Mr. Dillon. No, it shouldn't be. Sorry, if I can push back on that. Like, if you've said your prices haven't changed, banks feel like they can't negotiate a different outcome. Does an Australian bank pay the same amount to use Apple Pay as some of the big banks in the US? I mean, again, there's no commercial... You don't have to tell me the number, you just have to tell me if it's the same.
I don't know the answer to that. What we do have is a standard global fee structure. And beyond that, I don't have details about what specific banks or how much they've paid us. Obviously, we can discuss this, further outside this forum. But in this forum, I can't reveal any sensitive information.
The Vanderbilts are back. I just take that view that you've got such market power. I think it's extraordinary that you cannot tell us the amount that you charge per transaction. Can I ask, in just concluding, has the RBA asked you how much you charge per transaction, and have you given the Reserve Bank of Australia that figure?
We have shared information with the RBA, and what they have found is that the mobile wallet fees are a very small part of what the banks pay. It's just 1.75% of issuers' total costs for debit cards and 1.2% for credit cards. So yes, we have shared that information.
Okay. Righto. Well, look, we've probably got a stack of other questions on notice. You've been very generous with your time. Thank you for appearing today. The Secretariat will be in contact with you in relation to any matters arising out of today's hearing, and you should anticipate there will be questions on notice from committee members. You'll be sent a copy of the transcript of your evidence, and we will have an opportunity to request... you, not us, you will have an opportunity to request corrections to transcription errors. Gentlemen, thank you very much for your time.
Thank you. Have a good afternoon.
You too. So our next witnesses from Australian Payments Plus.
Chair, I'm happy to. I need to go in like 5 minutes, so I'm happy to not ask questions. I've got another committee.
Yeah. No, oh, yeah. That's right. You were saying. Yeah. Totally get that.
Which I can't avoid. Sorry.
So what are you proposing is then? I'll open up. So you're not going to be here. So Aaron, Sally, Julianne, Matt, and then that'll round it out. Hi there. Sorry for the delay. We have just had so much to cover off. So we appreciate your forbearance with our 15 minutes delay, which I've been assuring members all day I'd get back on track, and it's been a real whirlwind. Welcome, representatives of Australian Payments Plus. I welcome you to give evidence today. For the Hansard record, can you please state your full names and the capacity in which you appear before the committee?
Yes, I'm Lynn Krause. I'm the CEO of Australian Payments Plus.
And I'm Adrian Loveney, and I'm the Chief Product Officer at Australian Payments Plus.
Terrific, thank you. Before we proceed, I should advise you that although the committee does not require you to give evidence under oath, this hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as a contempt of Parliament. The evidence given today will be recorded by Hansard. It does attract parliamentary privilege. I now invite each of you, if you want to, as an organisation, make an opening statement before we proceed to questions. And if you can, if you're able to keep it brief, I think you'll find we go through the questions and answers, and it might actually cover off some of the issues you want to raise.
Excellent, great. And we will keep it brief, but thank you for the opportunity to be here today and to make an opening statement. Good afternoon to the Chair and the members of the committee. Australian Payments Plus, or AP Plus, is a member-owned organisation that operates in the public interest. AP Plus was formed by the merger of Australia's domestic payment schemes, including BPay, FPOS, and the New Payments Platform, also known as the MPP. The merger was authorised by the ACCC in late 2021 and was completed in early 2022. In essence, that merger was about creating a unified Australian entity that would allow the country to compete more effectively in digital payments and also drive future payment innovation. By creating AP Plus, this has put Australia in a better position to efficiently deliver world-class, modern, critical payments infrastructure that enables money to move safely, efficiently, and at scale, benefiting the whole economy. Since 2022, AP Plus has delivered for the Australian economy in a number of ways, and I would just like to highlight 4 particular achievements. First of all, on FPOS. FPOS is Australia's domestic debit network, and it does play a critical role in keeping card payments affordable, competitive, and resilient for the Australian economy. Debit cards now account for over 75% of all card payments in Australia. By providing a comparable and cost-effective alternative to the international debit card schemes, FPOS puts downward pressure on the cost for merchants through least cost routing. In fact, the RBA data shows that merchants who have enabled least cost routing are able to achieve a 20% saving on their debit card transactions. Just as importantly, FPOS strengthens Australia's payment sovereignty. It ensures that we are not reliant solely on international card schemes. By maintaining a domestic debit network alongside the international schemes, FPOS helps to ensure that Australia retains control, choice and resilience in the processing of everyday transactions, from groceries to fuel to essential services. The second thing to highlight is the role of the New Payments Platform, or the MPP. Most Australians will know the MPP through services like OSCO and through PayID. The MPP is national payments infrastructure that now processes around 1.5 billion payments a year, with most transactions completed in under 3 seconds. Today, nearly 1 in 3 account-to-account payments in Australia are made via the MPP. And for businesses and for government, the MPP is more than speed. It's data-rich, it's real-time payments that can improve cash flow, reconciliation and fraud controls. And that's why we see nearly a third of large Australian corporates already having plans underway to migrate to the MPP. That real-time data reach capability is increasingly important for major reforms, such as Payday Super, where timely, traceable payments will support the delivery of policy outcomes. AP Plus continues its investment in the NPP to ensure it can support Australia's growing economy. The third area to quickly highlight relates to our role in the future of money. As payments become faster and more digital, the way money and assets are settled is also evolving. And the key question for Australia is not whether this change will happen, but whether it is built on trusted, regulated infrastructure. That is why AP Plus is participating in the RBA's Project Acacia, which is exploring how digital money and tokenized assets could operate using existing payments and settlement systems, including the NPP, rather than creating parallel or unregulated rails. And the final area where AP Plus is making a difference is in relation to digital identity. In 2023, we launched Connect ID, Australia's first accredited digital identity exchange, enabling people to verify their identity using organisations they already trust. Australians need safer ways to prove who they are without repeatedly oversharing sensitive personal information. Connect ID securely supports a wide range of these real-world activities. And just like FPOS and the NPP, AP Plus's role is to offer Connect ID as national infrastructure and allow Australians the choice to enhance the privacy and security of their personal information. To close, we believe AP Plus is having a positive competitive impact. We know that strong domestic payment schemes drive good outcomes for Australia. And despite our size, AP Plus is here to compete head-on and transform payments in Australia. We provide cost-effective and competitive payment services that are modern, resilient, and safe. Thank you for the opportunity to be here today, and we look forward to answering your questions.
Thank you. I'll just kick off, because you've referenced NPP a number of times. How far away do you think NPP is from the scale required to compete with cards?
So NPP today, we are currently about 30% of the overall account-to-account market. We're seeing almost 90% penetration in the person-to-person through PayID.
That's 90%.
Yep, 90. The opportunity for the NPP, though, really rests in businesses and government usage. And so we are on a journey to support the migration of large bulk files and other payments that currently go across the BEX platform onto the NPP.
Right. Scheme fees being a big issue today. How many scheme fees does FPOS have?
FPOS has 2 scheme fees, you'll be happy to hear. We have 1 scheme fee for acquirers and 1 scheme fee for issuers. And I'd also like to add that both of those fees were reduced last year.
Terrific. Consumer protections on A2A, are they equal to cards?
They are not equal to cards. FPOS has the same consumer protections as the international card schemes, but to date, account-to-account does not have the same consumer protections as a card scheme.
Do you believe there are enough checks and balances for non-bank NPP entrants, given companies can access it through fintech avenues? For example, I don't know if you were concerned that Binance was recently given access to the system but shut off a few days later by an industry participant. So do you think there are enough checks and balances?
Yes, there are a number of ways for organisations to connect to the NPP. So we have 15 participants who connect directly to the NPP. All of those participants, bar one, are ADIs. Sorry, all of those participants are ADIs. We have one connected institution who is not an ADI, and they have restricted capabilities on the NPP. But in addition to that, there are over 100 identified institutions, and what that means is they connect through someone who is already connected like an ADI. Now, all of those connected participants and identified institutions have to meet the rules and obligations of the scheme, and we do rely on the participants who connect directly to ensure that all those participating are meeting their obligations.
Okay. Do you think NPP pricing should be regulated?
We set the wholesale pricing for the NPP, which has dramatically reduced since 2019. It's moved from 39 cents to 4 cents a transaction. We don't have any involvement in what I guess the margin is that is put on top of that by participants.
Okay, thank you. Colleagues, any other questions?
I was just going to ask, do you think there are any barriers at the moment to drastically increasing take-up, particularly at a retail store level at the moment?
The last few years, we have been really focused on enabling what's called least cost routing, which allows merchants to have a choice to route to the lowest cost network, which based on the RBA data, many times is to FPOS. So there has been a lot of work done by gateways and payment service providers to enable that least cost routing ability and that choice for merchants. In addition, there has been work over the last 18 months with Apple, Google, and Samsung to ensure that FPOS presents on an Apple phone, which previously it did not. And that meant it was overriding the merchant choice to choose the lowest cost routing. So we have made substantial progress. The Reserve Bank have been very supportive and have made it very clear that they assume that least cost routing should be available in all forms, and we are seeing that make a difference.
Excellent. I can keep going.
Yeah, and then I'll go, after you, I'll go to Sally Situ, and then I'll come back.
Sure. So going back to the point you were making about protections, how much do you think concerns about things like refunds and dispute management is being a bit of a restraining force on the growth of direct-to-account transactions, or is it just that the means are a bit more, there are more steps involved in getting that done?
Adrian, would you like to answer this one?
So we typically see the sorts of protections that you're referring to in the card system, and so FPOS has built out those protections to ensure that it competes with Visa and MasterCard, which has similar protections. There are protections in the account-to-account system, so if you made a mistaken payment and you accidentally sent it to the wrong person, or in certain instances of kind of fraud, there are opportunities for those payments to be reversed or returned, but you typically have different sorts of protections available in the card-based system as you do in the account-to-account system, and that's the same generally around the world.
Do you think that's a decisive factor for just consumers and businesses buying the coffee, going to a restaurant, buying a birthday cake, whatever they're doing? Is that, or is it just because it's so convenient to just pull out the Apple Pay and beep, and not really think about it?
I think you're referring to a number of the other features. I think where account-to-account systems tend to be used less at point of sale. Firstly, Australia's traditionally been a heavily carded market. Secondly, the prevalence of mobile phones and customers' familiarity with tap and go. Thirdly, the kind of speed and also the cost, and the debit card network, and in particular the one that FPOS runs, is extremely competitive in terms of costs. Account-to-account payment systems tend to be less mature when they're used at point of sale. There are some notable exceptions to that. So we see Pay2, which is one of the NPP products being now used by Amazon at point of sale, and many organisations would, or some organisations like Qantas, encourage the use of Pay ID when you purchase a relatively expensive kind of airline, but they're interested in instant payment, fast settlement, and they're also interested in a payment system that's relatively inexpensive compared to the card system.
So the strives in consumer behaviour then are more on kind of internet purchases, concert tickets, accommodation, things like that, because it's no more difficult or involved than doing it one of the other routes, but we've kind of just developed habits around Apple Pay and things like that that mean that changing that, irrespective of what people's primary considerations are, that's now our habit, so getting around that's difficult, so we're just embracing it as FPOS? Is that right?
I agree. I think at point of sale, particularly when you're standing at a checkout with 4 people standing behind you, the ease of use, the speed, the familiarity, the ability to use a mobile device or a plastic card really comes to the fore, and that's why card systems are used. At an online purchase, where you've got a bit more time, then you start to see account-to-account systems used more typically in that space.
Oh, thank you.
Ms. Situ.
Thanks, Chair. I wanted to just clarify on your scheme fees. Are there any, for FPOS, are there any differences between what you would charge big businesses versus small businesses, or is it flat?
We have a fixed scheme fee for both issuers, and we have a fixed scheme fee for acquirers.
And that's regardless of volume, all of that?
Correct.
Sorry, if I can just jump in there. So you don't offer so the way that others get around the point that Ms Situ is raising, is to provide rebates. They still charge the fee. Do you provide rebates to higher volume customers?
We do have some rebate arrangements, yes.
Right. And what's the... Sorry, Ms Situ. I just thought what you opened up was a really important question. I just want to say quickly, what's the rationale for those rebate operations?
Yeah.
So typically, we would rebate customers who process larger scheme fees with us because of the value of the transactions that they process. But smaller institutions would receive less rebate. So it's not a difference in terms of their end user pricing, but there can sometimes be a difference in terms of the bank or the PSP.
Thank you. Sorry, Ms Situ.
No, thanks for the follow-up question. I wanted to go to the points that you've made about least cost routing, and I think there is broad agreement that it is a good way to drive down prices. However, it does seem that a large number of merchants are still on a blended rate, which combines the credit fees and the debit fees into one rate. So they're not experiencing the reduction in the transaction cost for debit. I just wanted to get your views on how we can make that experience better for merchants so that they are getting the benefits from a debit transaction.
It is a challenge, and thank you for the question. I think in an environment where a merchant has been able to pass that blended rate on through surcharging, they haven't had to really focus on that differential price between debit and credit, or the fact that debit cards could be subsidising the cost of credit card acceptance. And so we do believe in a world where surcharging is no longer relevant, transparency of fees is going to be really important for merchants to be able to understand the different pricing and to understand what's behind that blended rate. I think we will also expect to see a change in some of the product offering that gets offered to merchants as a result of that transparency.
One final question is this point about transparency, which many people have now raised. I really struggle to figure out how this transparency would arise, given that in this instance, when I've asked you about the FBOS fees, you initially said that there was one flat fee across small businesses, but then there's a rebate that's offered on top of that. So. And this is an example that is played out in different parts of the payment system. It is really hard then to see how the fee that it would be, the advertised fee, is the transparent fee if there are other inducements.
Thank you. Yes, I think it is a complex system where transparency is hard to always be able to have visibility of. We do, as AP Plus, publish all of our wholesale fees. They're all on our website, and we have several times now in conversation with the RBA agreed that we'd be prepared to share our fee structures subject to our competitors also doing the same.
Right. Thank you.
I think maybe if I could just add to the point that Lynn made, and I agree with you, the opaque nature of scheme fees and interchange fees is a factor here. And you are right that even though our scheme fee structure is relatively simple in that we have two scheme fees, and we do offer some rebates for the intermediaries or the banks that sit in between us and the end customer. What the RBA is also proposing, as we understand it, is to publish information about the prices that different PSPs might make available so that merchants can compare them. Bank A is offering this sort of merchant service fee, or a PSP from overseas is offering a different sort of merchant service fee. We've tended to see these schemes operate in different markets. around transparency of mortgage rates and personal lending rates. And while we don't know exactly what the RBA is planning, we do think that the sorts of transparency that they're proposing in relation to merchant fees will help merchants find a better deal and in some cases a lower cost deal if these reforms are introduced.
Thank you, Chair. I was going to ask, in your opening statement you talked about when least cost routing was enabled. Why would someone not enable least cost routing?
I think most payment gateways are working on enabling it. I think it's really just a timing of when they have that capability ready.
So who doesn't enable least cost routing at the moment?
Are you aware of what requires?
So the RBA publishes details about the enablement and the activation of least cost routing on its website. There are sometimes many parties involved in the value chain. So you might start with the acquirer, and then there might be a gateway and a PSP. So it does require all of those parties along that value chain to have activated that least cost routing in order for it to be made available to the merchant. But the RBA does publish league tables or comparison tables, and I think they update them every 3 or 6 months. That shows the extent of rollout of least cost routing by bank or by payment service provider, and we think that that's an important step.
So given the complexity of the value chain, if I'm a merchant at the, in the end phase, and we've been talking about coffee shops today, so let's say I'm that coffee shop, if there is but one person in my value chain that doesn't enable least cost routing, at this end, I'm not getting any benefit of it, and I probably don't know. Do I know?
That would be right, yes. If it's not enabled all the way through the value chain, then it wouldn't necessarily be available to the end user. But we would expect, and the RBA would expect in terms of its data, that would also be reflected in the price that you would pay. And so you might search around for a different payment service provider that does offer least cost routing, which the RBA would say would generally result in a 20% lower price.
So if I'm a busy merchant, how do I know that? Does someone tell me? Do I have to look it up? Like I'm working every day behind the counter
and this is one of the challenges, why we've seen such an emergence of the bundled plans or the simple one price plan, because it is a lot for a small business or a merchant to understand. I mean, there are organizations, and I think you'll hear from some tomorrow, like CUSBOA, who are doing work to be able to support merchants with making these choices and understanding the different choices that are out there. But you're absolutely right. Yeah. It is complicated for a small business who doesn't work in this space to understand the fees that they are being charged.
Just changing gears a little bit, there's been a lot of discussion today about multinationals' investment in the payment system more broadly. Obviously, your bailiwick is investing in payment rails every day of the week. Do you believe that there is a role for those larger companies based overseas to invest in the payment system? And if so, what would that ideally be?
It's a really interesting question. Obviously, there is a significant cost to running payment systems, to keep them secure, to keep them resilient, and to keep making sure that you innovate so that they are right for the way that Australians want to pay. We currently obviously don't have any investment from overseas investors. I think what we'd more importantly like to see is, I guess, a level playing field with regulation so that we are competing directly and on the same sort of terms as international players. I don't have any specific thoughts, though, about taking their investment on.
Well, I guess the example we were just talking about before, we caught up with Apple before, yes. And they are obviously, through the Apple Wallet, a part of the payment system and how everything works around it. And the question is, if they're part of the system and reaping the benefit of the rails that have been put in place, then how could they contribute to its upkeep?
So I think...
No,
I would really like to explore this issue because How was the NPP investment financed?
So the MPP was financed by the 13 original participants, including the RBA.
Right. So when you say participants, can you give us a sense of who, outside of the RBA, those participants were?
The 4 major banks, and there were several of the international banks that operate in Australia, as well as some PSPs.
Just rremind me again. It's just a cavalcade of
payment service providers.
Okay.
Apologies.
Any of the card, Visa, MasterCard, they tip in?
No.
Amex?
No.
Apple?
No.
Google?
No.
Right. So you can kind of understand why they've all got a gripe with the fact that they put money into this. I mean, having put money into that and set up the MPP, do those card like Visa, MasterCard, Apple, Google, do they benefit from the existence of the MPP?
Would you like to talk about the services?
Yes. Yeah, get him working more because you shouldn't answer all the questions.
None of those organisations that you mentioned connect directly to the MPP.
Oh, that's fair enough. Well, yeah.
They may do so in the future, subject to regulatory reforms. The government's introduced a payments licensing reform that could potentially see some of those organisations connect directly to the NPP, but none of them do at the moment.
So if they do connect to that, would they be expected to make a contribution?
Yes, they would.
Yes.
Yeah. So we have had 2 additional joiners since the NPP was first established, and those 2 joiners have paid a joining fee, establishment fee, that is in reference to what the original participants put in when they built it.
Right, okay.
So it's not a free access system.
Okay. Righto, thank you. Just because I'm a believer in the spirit of bipartisanship, the member for Casey, apparently they had an electrical outage in his area and the internet's down, that's why he's not online. So he asked me, would I be able to ask these questions on his behalf? One is, how does maintaining domestic payment rails like the NPP ensure that Australia's economy remains functional, even if geopolitical tensions or commercial disputes affect international providers? Question 1.
We see it as critical to our role. So both the MPP and FPOS are deemed critical infrastructure here in Australia. And we think it's really important that Australia continues to have its own way to pay, particularly in the event that services aren't rendered anymore to Australia by international players. So our focus is on keeping our infrastructure safe, secure, with proper contingency and proper resilience plans in place. So we think it's vital for Australia to have that. At the same time, having our own domestic way to pay also does provide competition to the international players.
Is there interoperability between MPP and SWIFT?
SWIFT is actually the operator or the basic infrastructure of the MPP.
Right, okay. But I mean, SWIFT is an international network, from what I understand, enabling movements of money. So SWIFT has come in to operate NPP in Australia.
They have built the basic infrastructure of the NPP. That's correct.
Okay.
And still play a role today with us.
Okay. The second question is, with the rise of least cost routing on mobile wallets, merchants can finally route transactions via the domestic FPOS network. How critical is it for the RBA to ensure that international wallet providers do not impose technical barriers that disadvantage this local lower cost option, and how good is it that a Labor chair is asking the Liberal members questions? Actually, I just added that one in.
Yeah.
But sorry, the other stuff about the RBA and the wallets.
Yeah. I mean, we think it's extremely important. So the RBA have been very supportive of least cost routing, and we are now at 50% coverage of mobile phones, so there is still a way to go, but we have a good working relationship now with Apple, Google and Samsung to enable that. I think the question is what comes next. So there's click to pay, which you may have heard of. There's also the movement towards agentic commerce. And so it is equally important that if there's any new form factor that takes off as a way to pay, that least cost routing is enabled from the beginning so that we're not in the situation that we have been the last few years, which is trying to play catch up to enable it on a phone, which is becoming the predominant way that people want to pay. So we think least cost routing and preserving that is extremely important.
Okay. Finally, there's been a lot of material covered off today. a lot of points made by various witnesses. I don't know if you've had a chance to hear much of what was said. Were there any particular things that were said that this is an opportunity for you to be able to respond to some of the points that have been raised? Is there anything that you don't have to, but if you wanted to take the opportunity to respond to some of the points raised in earlier testimony, you're by all means welcome to do so now?
I think the only thing that we would say is we believe that, in relation to, the inquiry and the RBA's study, we believe that there are a series of policy settings that working together can achieve great outcomes for Australia. As a company that works in the public interest, we don't pay dividends. We use all of our revenue to reinvest, and we welcome a more level playing field and regulation here in Australia, which we understand that the RBA will be exploring as they look at their new powers under the PSRA.
Thank you very much. Thank you for appearing today. The committee secretariat will contact you in relation to any matters arising out of today's hearings. I think we've covered off all questions, but there may be questions on notice. You'll be sent a copy of the transcript of your evidence, and we'll have an opportunity to request corrections to any transcription errors. This concludes our hearing program for today, and I want to thank all witnesses and members and the secretariat for their time and assistance. I declare this public hearing closed.